Doing here, GSK has settled, so that's something we watch. Repsol, disappointing with its trading statement, at least according Morgan Stanley and Jefferies, and HSBC certainly in focus after other media reporting some cost cutting, which we kind of knew about, but we'll keep an eye on the share price. Guy.
Okay, so here we go. Single stocks are going to be really important, as Anna says. Records in the United States, not much of a read across, though, here for Europe. So it's time for the opening trade. We're expecting a flattish picture. Yes, the FTSE 100 may outperform GSK, to Anna's point, the single stock story that we're going to be watching so carefully there. I wonder whether the action really at the moment is in the bond market. That move above 4 on the US 10-year, I think, is significant. Where does that ultimately take us? But here we go. We're up a little bit. I think that probably is a flat market start that we're looking at there. The stock 600, absolutely flat. Even the FTSE 100, which was expected to be 2/3% higher, is struggling to make some headway here. The CAC is already opening down 0.2%. So at an index level, not much going on. We're waiting, we're watching, but there's some churn below the surface. Critty, what's going on?
Well, you are seeing a little bit of movement here when it comes to some of your heavyweights, your sensational six. If you look at them here, Novo Nordisk, from an index perspective, is your biggest contributor to the upside. It looks like tech, or biotech, I should say, pharma, is kind of helping with the move higher. To the downside, though, it's a little bit of a mixture. I'm seeing Airbus certainly take a hit off of those deliveries, down about 0.9%. And then I'm seeing a slew of other companies, from cars to private equity firms to a little bit of everything. A mixed picture in today's session, Anna.
Yeah, absolutely. So the worst performing sector, autos and parts, and we've actually, in terms of the companies moving around there, Renault is one of the worst performers, but down just over 1%. But really, that's a reversal of the trades of yesterday, isn't it? We saw that sector did pretty well in yesterday's session, and today less so. Chemicals is the best performing sector this morning, and Givaudan is one of the, maybe you mentioned this already, Givaudan out with some guidance, I think, earlier on, and that stock up by 2.9%.
Yeah. But no clear signal, I don't think, coming out of the session that we can discern at this point in time. It feels like the action is elsewhere. Stocks making record highs in the States yesterday, but where does the catalyst come from here, I think, remains an open question. We're waiting for that CPI number out of the United States a little bit later on. French stocks, I think it could be interesting to see what this tax story looks like and how that's going to impact. Is that already priced in to a certain extent? I think probably it is. There's an expectation that we're going to be seeing tax hikes for 2 years. I think probably everybody believes that is maybe fanciful thinking. 2 years tax hike, they tend to be longer than that.
Yeah, well, I think it's a crucial piece that you mentioned. And in today's session, of course, you're seeing Airbus see one of the biggest heavy volume when it comes to the downside move. Safran, of course, is a part of that trade as well. But you mentioned the budget, and you mentioned that the bond market may see more action than the stock market. I think you're seeing that this morning as well, with some of those bonds yield, at least across Europe, higher by about, they were initially higher about 2 to 3 basis points. Now they've pared back just a little bit to about 2 basis points. There's a lot going on. Is it the budget story? Is it the Fed story? Well, we heard from Mary Daly yesterday. Take a listen on what she had to say.
I think that 2 more cuts this year, or 1 more cut this year, really spans the range of what is likely, in my mind, given my projection for the economy. But it's really important to put caveats with that.
Joining us now is Benedicte Lowe, Equity and Derivative Strategy Europe over at BNP Paribas Markets 360. I'm so sorry, I completely butchered your name, but we're thrilled to have you here. Walk us through the story. Are we looking more for the volatility in the bond market or the equity market?
So So what we've seen in the equity market is that vol has picked up over the past few weeks on the back of some geopolitical tension, but at the moment is struggling to realize. So you see there's some pressure on the downside as the carry is not realizing, whereas on the bond side, I think the picture is moving from the expectation of a lot of Fed cuts, ECB rates cut, and that is also moving. So you're seeing more volatility that is warranted more so on the bond market at the moment than on the equity markets.
Does that create a dislocation, though? I mean, I think we've been waiting so much for, in the last, I would say, 2 years, where you start to see bonds and stocks operate in the opposite fashion, a trade-off of what kind of exposure you want given. Do you look at, say, the geopolitical risk or the volatility or even some of the micro action in stocks relative to, say, Fed pricing, budgets, et cetera, driving the bond story? Do you think that correlation is closing?
Yeah, well, on the equity side, the volatility story has been one of not really performing year to date. We've seen that things have not broken, and when things don't break in the market, then it's hard to hold on to that volatility exposure. So we are expecting for volatility to perform to really have whether a sharp drawdown in the resilience of the labor market, or expecting inflation to pick up and the Fed reaction function to change. Otherwise, we might stay on that environment where vol doesn't really perform.
That's interesting. I'm thinking about volatility takes me to the China question, because I know that a lot of people who watch European markets, of course, have a lot at stake when it comes to the Chinese story. We're waiting for more detail perhaps on Saturday, so over the weekend we might get some of that. Where do you see the impact yet to play out of what China is doing?
Yeah, so we've seen a substantial change in the reaction function of the Chinese government. Over the summer, there was some disappointment for equity market, where the focus was really much more on the national security than on the consumer. We've seen that this has changed at the end of September, where the Chinese government has really emphasized that it wants to help the consumer. And that will have direct feedback into European equities, especially the China-related and the consumer-related stocks. At the moment, we haven't seen really that strong outperformance of European stock on the back of that stimulus. And I think one of the reasons for that is that in the past, there's been some disappointment on the back of some measure announced by China that was not thought through the whole economy. So I think the market is expecting to see what is the fiscal measure implemented. Are we going to see that boost throughout the economy on the monetary and on the fiscal side? And also around the US election, I think there's still some worries about what the result of the election would be and what that means for equity market. And then we see a path actually for equity to reach 5,300 within the European Union.
Do you have strategies for European stocks, around the US election? So obviously we know a lot about tariffs, or we've heard a bit about tariffs from former President Trump, and we know he has plans in that regard if he is elected another time. Do you have strategies that will that play around the election? Because some investors want to look through this and sort of set it to one side, and others want to be actively involved.
Yeah. So what we've noticed is that there's a typical pattern going into the US election where the months leading into the US election, you have an underperformance of the stock market and you have a vol that gets bid. So you have this seasonal pattern. Basically, some manager, they take some chip off the table, reduce their risk exposure, leading into the US election. And then once we've got the result, market can deal with that certainty. They know who's the candidate, who's the president, and then market tends to perform better. So that's kind of the roadmap that we're having going into US election. Potentially some weakness ahead with vol getting a bit more bid, and then stronger reaction after that. Now, as for the candidate between Harris and Trump, we would still have to see what the exact program that would be happening. But I think the idea around Trump would be more positive for US domestic assets, a bit less positive maybe for European assets, so maybe some cyclical underperformance in Europe. Whereas on the Harris victory, you could have outperformance of European stocks versus US stocks.
Good morning.
Well,
Big vol spike in August. Moderate vol spike in September. Get up to around 20 on the VIX. We're kind of 20 now on the VIX. As you see how the rest of this month unfolds, does vol go up or does vol go down? Does the VIX go up? Does it go down?
So our message has been to be buying some vol on the dips. So we're saying that volatility is likely to remain flawed around current level because there's just so many catalysts ahead. Okay. We've got the US election, but we've also got the macro that is at this inflection point. We've got the earnings season that is about to start tomorrow in the US and then next in Europe. So we've got all of these catalysts. So we think that the higher vol levels are reflecting this wall of catalysts that we have, with the fact that geopolitical tensions have risen over the past few weeks. So we think this is warranted by the outlook that we're seeing for stocks.
Do you think there is still this view in the market, though, that you want to be short vol?
I think ahead of the election, that would be really tricky to have. And I think the discussion that we're having with people around the street is that ahead of the election, you really want to keep that cautious stance, especially with geopolitical tension where there's still risk on headwinds.
What could it unfold? August, the vol spike was big, really big. Could we go back to those kinds of levels around the election?
It's not exactly the roadmap that we have in mind. This was really also a question of low liquidity that took everyone by surprise. Sure. There was like the unwind of the carry trade. There was really a lot of things happening, and that kind of led to a real spike in volatility. Also, the VIX level at 60, that was more a reflection that the bid-ask was so huge on that price. It doesn't mean really that people traded around that price. So this is not the roadmap that we have, but still we're saying it could be really the case that this stock goes around 25, 30 is more the level that we have in mind, more so than the spike at 60 like we saw in the August sell-off. Okay.
What's the hedge then? If you have these views on volatility, what is the hedge to navigate the next 30 days?
Yeah. So what we saw looking at previous election, the 2016 and the 2020 election, is that actually if you want to play the election, it was more interesting to play, let's say, a straddle. You don't delta hedge it, because what you tend to see is that vol gets bid ahead of the election, but it doesn't necessarily realize after the election. So you want to have that view, not so much on the delta. You don't want a delta hedge view. You don't want to hedge the vol view, but you want to have that position because stocks tend to trade in one way or the other. They have strong directionality, not so much close-to-close market volatility. So you want to have that delta, that straddle, but no delta hedge.
And how are you approaching the CPI print today? Talking about volatility, these things used to create a lot of it, but they don't create so much anymore. Labour market data seems to be the focus. Yeah. How are you approaching this CPI print?
Yeah, I think if you had asked me the question 2 weeks ago, I would have said it doesn't matter as much. The focus is now on the labour market. But since the print of last weekend, I think the focus is now also back on the CPI, because we're seeing some resilience in the labour market in the US. So really the focus now is turning, are we going to get a resurgence in inflation? And that changes the whole reaction function from the Fed. And given that equities are near all-time high in the US, they are close to multi-year high in Europe, the risks are a lot more skewed to the downside if we get a pickup in inflation from here.
If we do see a pickup in inflation, this talk, I'm reading notes talking about kind of yields going back to 5%, 6% maybe in the United States. Yeah, exactly. Kind of how much could the market in totality change in equities change if we start to see yields actually moving back up? Now, the overall trend may be still lower, but we could get some quite big movements in the meantime as we kind of watch inflation and watch the labour market carefully in a kind of no landing, very soft landing kind of scenario. If we go back to those kinds of levels, how do I hedge that kind of risk?
Yeah, the yield going back at 6% is not what we have in mind, but if that does happen, that will for sure be a negative, be a headwind for US equity, especially now that we are coming into kind of not weaker earnings, but companies are struggling on the margin side, so that will for sure have a negative impact on them. So yeah, potentially underperformance on the back of that, but I don't think that's the playbook we have.
What's your degree of certainty at the moment? When you talk to people, how uncertain, that's the word I hear all the time at the moment. What do you think about these markets? Uncertainty. Don't know. Is that, to what extent is that reflected in what you're doing at the moment in terms of the positions that you're seeing being put on?
Very much so. I think there's a lot of uncertainty. I think people are struggling to see really what could be the catalyst to break higher on Europe, but also in the US being close to all-time high. So I think this is the perfect moment when you want to put some hedges on, when you want to look at volatility. You don't want to own only that delta position. Yeah. You want to play that trade via option just to limit your risk on the downside if your view doesn't play out. So really optionality is the key in that type of market.
Benedict, nice to see you. Thank you very much indeed for stopping by to see us. Benedict Lowe, equity and derivatives strategist at BNP Paribas Markets 360, European equity derivatives strategist. Let's talk about what is happening at the Core 6 this morning. This is what the markets look like. Uncertainty again seems to be writ large across the European markets at the moment. We're struggling for a sense of direction. Single stocks giving us a little bit more this morning, but as you can see on the downside, we do have some of the car stocks. Ferrari's off the pace a little bit this morning. ASML softer as well. Schneider down. Even some of the defensive names like Nestle, the staples, are a little softer as well. Where we are seeing some upside action is in Novo Nordisk. It's interesting to see we're also seeing some movement in GSK. Let's get the single stock story. Joe is here with that.
So GSK is the best performer in Europe today, Guy. It was up around 7% at the open, now up 5.7%. Remember, settling around 70% or more of the claims on Zantac overnight. That news came around $2.2 billion they are paying to recover this issue, and that is removing a key overhang from the stock, according to analysts. That's the best gain since 2022, almost 2 years for GSK today. The best performer that we've got this morning. Going the other way was Repsol over in Spain, slipping very slightly on some weakness in both their production and their refining margins following a trading update yesterday. Then we did also have a big share buyback breaking over in Germany this morning from Deutsche Telekom, and that one was gaining as well, around 1% at the open. We'll see where it is now. There we are, up 1.4% for DT. Remember, T-Mobile in the US is their biggest business, and that is the main driver of the gains. Then a little bit of a decline over in aerospace. It's actually come back up now. That was lower when I first looked, but that is actually gaining a bit of weakness, I read, in the orders in terms of the A320s, probably more Guy's area than mine, but that one did look a little bit weak according to some analysts, but the stock coming back up today. Then we had a discounted share placing on CVC over in the Netherlands. GIC Partners offloading a few €100 million of the private equity company overnight, but that stock holding pretty steady. In terms of the analyst ratings, this one is playing into what Benedict was discussing moments ago around the US election. JP Morgan's got a really punchy note out saying that the risk around tariffs on metal is not priced into the market. They reckon that mining and metal stocks could see 10 to 20% downside if there was potentially a change in the presidency and therefore more tariffs in terms of the trade between the US and China. So that one is downgraded. We also had the downgrade of Sika. That's one stuck out. It's a $50 billion company. Only one other sell on that one, chemicals over in Switzerland. And then one of the worst performers today is Knorr-Bremse over in Germany. Boffa also doing the damage on this one, citing declines in the truck and rail market for the German brake manufacturer. And that one is falling 2.3% on the DAX index today.
All right, Joe Easton from our equities team, we thank you so much. We're going to keep an eye, of course, on those stocks and how they trade throughout the rest of the session. In the meantime, we're just going to give a little love, I think, to the bond market as well, because you are starting to see a move higher, perhaps following what we saw in yesterday's trading session over in the States as well. Yields higher across Europe, not to the same extent as we saw in the States, but certainly taking their cue.
A move north of 4% on a US 10-year is something you really want to pay attention to.
Yeah.
How much higher could we go? Certainly the trend would point us in the direction of moving back up towards sort of 5%. You could even get as high as 6%. Depends if Trump wins the election. Obviously the migration story is absolutely front and center there. The expectation is he's going to spend more and also potentially impact the US labor market. That all sounds very inflationary. It is a story here in Europe as well. This migration element is something that we need to factor in as well. The migration story is something that has a direct lead through the labor market into the inflation debate. Are we living in a structurally higher inflation market environment if we are going to restrict migration?
It's been really interesting to watch it play out in Germany, and two different sides of the same conversation. So on the one hand, the politics dictating more focus on restricting migration and a focus on legal versus illegal routes of migration. But on the other side, the Chancellor going off and doing deals with specific countries to bring people in as long as there are rules for how long they can stay and the like. So really interesting to watch this play out. In terms of the bond market story, Chrissy, interesting that yields, I think, on the UK, a little bit more movement there today. Really interesting story from our colleague Tom Rees talking about or quoting a Citigroup economist, a Citi economist, saying that gilts, we were referencing this earlier, gilts risk a buyer strike if borrowing surges. And this is to do with the headroom she might create for herself, Rachel Reeves, at the budget. If she creates that headroom, does she go out in the bond market and try to use it? And what appetite does the bond market have at that point?
The Citi data is being used as the basis for the IFS report that we've just seen, which is suggesting that you could see that buyer strike, that concern around like what demand would ultimately look like for gilts were she to decide to go out and spend even some of this headroom on infrastructure projects, which she can't give clear guarantees on the growth impacts. And that's the real challenge here. Does the market believe that if you invest for growth, if you invest for productivity, if you invest in infrastructure, it is going to lead to higher growth? And that's the challenge she faces in terms of the communication.
And you'd hope that the world has a patience to wait for growth, but some of these projects do take time, don't they?
And we're really good at delivering them on time and on budget.
Extremely good at that. Coming up on the programme, shares in GSK soar after the UK drug maker agreed to pay up to $2.2 billion to settle its Zantac liability cases. We will bring you the details. It's certainly having an impact on the shares, up by more than 6% this hour. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup.
This is a three
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Welcome back. 21 minutes into the Thursday session. This is what it looks like. Mixed, I think, at a headline level. Certainly at an index level, you're not seeing very much. Below the surface is a little bit of activity. There's some single stocks that really stand out. Volatility is coming down today, which is interesting as we head into the big weekend, potentially, that we're going to see out of China, plus the CPI data out of the US a little bit later on. Let's keep an eye on what is happening with Milton as well and the impact that it's going to have on Florida. But there are some really interesting single stock stories that stand out today.
Yeah, absolutely. Let's go to the pharma sector. Shares in GSK soaring this morning after the UK drug maker agreed to up to $2.2 billion to resolve almost all US court cases over allegations its old Zantac medication was contaminated with a suspected carcinogen. GSK has denied liability in any of the cases, but it's agreed to this payout. Let's bring in our health reporter, Ashley Fairlong, who follows this company for us. Ashley, good morning. So, good news clearly reflected in the price this morning. What does this mean for GSK?
It's a really significant moment, and I think that shouldn't be underestimated. We've seen the stock uptick this morning, but more broadly for GSK, this really allows them to focus on their pipeline, which investors are quite optimistic about, as well as their drugs on the market at the moment, including their 2 vaccines, which are doing really well for RSV and for shingles.
Why are we not getting a bigger reaction in the share price? Because in some ways, this is way off what could have been the worst-case scenario for GSK.
Exactly, and this is also towards the lower end of estimates that analysts had expected. And I'm not really sure why we haven't seen that reaction just yet, but I think investors have wanted this for a long time. They've wanted GSK to settle, and this is definitely very welcomed, will be welcomed by the market.
Let's take a step back, though. What actually led to the settlement? What was the game changer here?
So this year we saw in Delaware, where was ongoing, most of the cases were happening there. We saw a judge in Delaware say that the science related to whether Zantac caused cancer could be heard in that court. And GSK appealed that decision, and then the Delaware Supreme Court decided that appeal, they would actually hear that appeal. That was quite an unusual move, and that normally doesn't happen, the Delaware Supreme Court actually saying they're going to hear an appeal. And what we understand is that then led plaintiffs to actually come to the talks about settling. And it seems like GSK was very open to that, and they seem like they've got a pretty good deal, according to the estimates that we previously had been sort of expecting, potentially much higher settlement figures.
And just to underscore, GSK is not admitting any wrongdoing here.
GSK has consistently denied that Zantac causes cancer, and they're not admitting any liability. They've always said, and Emma Walmsley has very recently, in an interview with Bloomberg, was saying that they will do what is in the shareholders' interest always. So this is clearly what they believe is in the shareholders' interest.
To pay this out. Thank you very much, Ashley, Bloomberg Health reporter Ashley Furlong, with the details there. So that's one sort of bright spot in stocks, but there aren't so many of them. The stock 600, sorry, the FTSE 100 is outperforming, and GSK is a heavyweight, so that's part of that story. But broadly, we are flat. We are really flat.
Well, we're waiting for some catalysts. What those catalysts look like remains to be seen. Is it going to be China? Is it going to be what happens with Milton? Is it going to be the CPI or the PPI print out of the United States? Is it going to be the US 10-year going further north of 4%? It's hard to really put your finger on exactly what is happening here. It's interesting the vol is rolling over a little bit in Europe this morning. We are going to talk a little bit about the car sector in just a moment. That is an area of huge interest at the moment. This Stellantis story, I think, is really interesting in terms of what it's telling us about what the European car sector needs to do next. We're starting to see rumours again of a Renault merger. There's all kinds of things going on. Plus, we've got this Tesla event a little bit later on. Is that going to transform the car sector once again?
Right. Well, yeah, Elon Musk certainly had grand ambitions on that front, doesn't he? The Stellantis story is interesting because they're talking about a shake-up of management, but we don't even know under which CEO, because we've already been reporting here at Bloomberg that they are looking at options for replacing Carlos Tavares as the CEO. He, in the meantime, is going about doing what he likes to do, which is cut costs. So we'll see whether he manages to hold on to that top job long enough to implement any strategy there.
Yeah, Stellantis shares down about 1% this morning, by the way, and which is interesting because we're talking about this China overhang. We're talking about how that hits the auto sector. Yeah. We also talked about how it hits the plane sector as well. Airbus, of course, was in focus, especially as a broader kind of French stock theme as well. It opened lower. It was one of your highest volume movers. Now it's one of your best performers to the upside in the French index, higher by about 0.5%. So I'm curious what the turnaround is there.
It's hard to put your finger on exactly what this is being driven by. The stock basically gapped lower first thing, bounced quite considerably, is now down. If you take a look at it on a 5-day basis, it's pretty much where it was before. I think what we got from Airbus last night was largely expected. We are looking at deliveries that are struggling to make their delivery targets. We've already known that. They've downgraded their numbers once.
Aviation in focus. Autos then still in focus. There's no respite for besieged automakers here in Europe as Stellantis eyes that management shake-up we were just discussing. Horst Schneider from Bank of America joins us. We had numbers out from BMW. Sales in China also disappointing. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is the opening trade. We're about 30 minutes into today's session. Seeing a little bit of mixed action, some slight underperformance on the continent. The FTSE 100 remaining fairly stable. We'll see how that shakes out, specifically as we digest what's going on in terms of the French budget, but also in terms of automakers. And this is a really interesting conversation. We're, of course, seeing it hit what's going on in Germany's bottom line. It's also hitting that of Spain, especially as just in the last 7 days or so, the EU has imposed a 45% tariff on importing Chinese EVs. I asked the Spanish economy minister about how that affects their negotiating process, their bottom line. Take a listen to what he had to say.
We're not the US, we're not China. We need our own way in this discussion. So the first element in the EU perspective, or from the EU's perspective, is that we have to bet for a multilateral rules-based order. That's what actually has worked for the EU. We are an open economy that benefits from this. But it's 2024, it's not 2004. So we need avoid being naive in a sense, and we need to provide for our companies to compete on a level playing field with other firms that want to actually sell their products in Europe. And this is the starting point for the analysis that has been done by the Commission, where they actually put in place the tariffs that would level out this playing field with respect to the Chinese EV producers. So we thought that this is a good starting point, and therefore we were supporting the Commission in this initial endeavor, but we're not there now. We are 2 steps after this initial point, and what we're saying is that we need to keep on negotiating. We need to keep all avenues for dialogue open to find a conclusion, a negotiated conclusion, which is actually valid for both parties. It's important also for us, not only in terms of being able to protect a key strategic sector going forward, but also thinking medium term to avoid an escalation of protectionist measures, which would be a lose-lose for both areas.
With all due respect, Minister, wasn't that the case 3 months ago as well? What do you feel like the dialogue has shifted in terms of between Spain and China in particular? Are you feeling pressure from Beijing? Why the sea change?
No, again, I think what has changed is that we're not at the starting point in this case. So the starting point was, listen, let's have an estimate of what would be those tariffs that could actually level out this playing field. And from then on, we need to start negotiating with Chinese producers and Chinese authorities, and that's where we're at now. So we have a good starting point, but both parties need to keep engaged in this discussion. That's what we're saying, and that's, I think, what is key going forward. The tariffs will actually get into place after the vote, but this is not the end of the road. Again, for us, it's important to remain constructive and to keep all negotiating avenues open. It's not an element of pressure. It's an element of thinking short term, but also medium and long term, and avoiding these lose-lose scenarios.
Spanish Economy Minister Carlos Cuerpo speaking exclusively to us over in Madrid there. It's a really fascinating conversation because 3 months ago, there was a real consensus in the EU around these tariffs. Germany has since split off. Spain has since split off, among others as well. And it's become a real area of fragmentation. And it really comes down to the bottom line here. What wasn't said in that interview was that Spain has joint ventures with China. Cherry, for example, has been investing quite significantly. At the same time, China's put retaliatory tariffs on pork. $1.5 billion worth of imports, Spanish imports in pork, go to China. The Spanish economy, the minister there, is facing a real threat to their bottom line.
Well, it's really interesting that this is not a story that stays in the car industry, is it? We've already seen that with French brandy, and that seemed to be an area that was in focus. And it does then threaten to escalate within the car sector, but it's not only about cars, and that's what we're seeing play out from various different European capitals.
If you're the Chinese here, what do you do? Let's look at this from the other end. You look at Europe, you see division. You presumably want to make that division even worse. You want to push countries that have taken a more benign line towards tariffs against you and make them look as if they are winning in this debate. Push the French hard. They've been they've been pushing for the tariffs. Do you want to create further splits within the European Union with the way that you respond to the tariffs that have been delivered thus far? You can only expect that will be the tactic.
If that is the strategy, it is absolutely working. And you can absolutely see that in the way that even Spain has kind of reapproached the way they're addressing tariffs. It's no longer a stick approach that if you're going to hit overcapacity, we're going to respond with a tough measure. Instead, they're saying, we're going to start here, but we're going to try to wiggle our way out. We're going to try a little bit of diplomacy, and we'll see how effective that is.
You wonder whether this is just a warm-up act, though, for dealing with the Trump administration 2.0 and how that would ultimately affect some of this negotiation. It's going to be fascinating.
It's a fascinating one as well, because we talk about in the idea of ASML, is Europe stuck between U.S. and China? And right now, they're trying to make the case that we're not always influenced by what's going on in the U.S. We're having our own negotiations.
Amazing to watch and see how this one plays out. Talking transatlantic tensions, let's talk a little bit about Stellantis and what is happening with this car company. A footprint in Europe, a footprint over in the United States. The company's CEO, Carlos Tavares, is reportedly planning a deep management reshuffle. Remember that he's trying to regain control of this business. Weeks of setbacks. The company has come out with a really damaging warning in terms of profitability going forward. There is a story that we've reported that potentially his contract will not be renewed next year. Just to give you some numbers here, 6 months, you look at the auto sector, Stellantis is the worst performing stock within that sector. It is down by 52% over the last 6 months. There's only one stock in that sector that is in positive territory, and that is Ferrari. Horst Schneider, head of European Automotive Research at Bank of America Global Research, joining us now around the table. Where did Tavares go so wrong?
Well, it needs to show if he really went wrong. Maybe he just had bad luck at the wrong point of time. We need to see. But in the end, of course, I mean, you need to consider where he's coming from. So he took over Peugeot in 2014, and he restructured the business. But then also, a key element of increasing profitability at Peugeot was increasing prices. So he invented the mantra, value over volume. And he tried to apply that as well in the US. And it worked during Corona, supply shortage. And he thought, okay, in the US it works too. And then he had to figure out it doesn't work. And he was stubborn for a long time, basically this year, and was sticking to the approach. We do not want to take prices down because that hurts profitability the most. A price decline feeds through straight to the EBIT margin. And therefore, he tried to resolve somehow the situation, and then he had to pull the pants down, right, with a profit warning, kind of, and acknowledged in a way it doesn't maybe not work, right, and then he's stuck in a little bit frustrating situation maybe, because it's not easy what to do. They try to reduce now inventories, but then
so
ultimately...
What does his successor need to do? Let's say somebody else comes into this business.
That's my problem. I'm not sure what the successor could be, because I still think he's the best manager for this company. I still think he's the best CEO that the auto industry had for a long time. So therefore, all the people around him, I can't see that they become really a good successor.
There's not an obvious name that sticks out here.
Exactly.
If I could just broaden things, so Stellantis, fascinating to think about what happens with the management there. In terms of the broader story, though, for these European car makers, I mean, the slump in EV sales that we've seen seems to be, that has been the news all year, hasn't it? That expectations have not been met around EVs. Just this week, we've seen 2 companies bidding for lithium assets, underpinned by assumed demand within the EV sector. So what's going wrong here, Horst? Is this just, it's completely the right idea, it's the right future, but it's just not being executed well at the right price? What's happening?
Well, I'm driving a Tesla, so therefore I believe that it is the future, right? We need to reduce CO2 emissions. We have got a climate neutral target by 2050. So therefore, the politicians are in a kind of dilemma, because the consumer does not yet want the product, but they know that the last ICE car should be sold in 2035. So when you look at the year-on-year growth rates we need to achieve, you think at the moment it cannot work, it cannot happen. Ultimately, what needs to happen is that the prices come down. The prices are too expensive, and we have got here a kind of consumer electronic product. So that means the lifetime of a consumer electronic product is probably 4 years. Of an ICE car, it's usually, 10, 12 years? And that's the problem.
I drive a very old Golf. It's 9 years old.
Yeah,
it's also a good car.
No doubt. Well, that's interesting. So if it's all about the price, if the consumer has rejected it, maybe it is to do with price. China has an answer to that, don't they? With cheaper cars. I mean, BYD, we saw at the beginning of this year how seriously they are taking this export mission by actually, bringing out their own ship to carry huge numbers of cars around the world. They are not in this for the short haul. This seems like a long-term strategy. Where does this take us, Horst? Because Europe wants cheaper cars, but the European Union doesn't want them to come from China.
So have we got an hour? I could start talking. Complex question. I mean, no doubt the Chinese have got an edge on batteries. They've got kind of 15 years advantage, and 15 years. So basically, you cannot wipe that out. You cannot catch that up.
Tariffs aren't supposed to last that long, are they?
So therefore, and they are cheaper. They have got this cheap access to raw material. What you mentioned also with lithium, that now companies basically buy stakes in other lithium companies. But China is just ahead. So therefore, I'm not sure if you can catch that up. And the problems are manifold, right? So it goes with batteries. We talk here about the car import the tariffs, but in the end, it's also about batteries. I mean, look at the Green Deal, Europe. They tried to establish a battery industry in Europe with subsidies, and the import tariffs for Chinese batteries is 1%. Yeah, and basically we get dependent on Chinese batteries. They can do whatever they want in 5-10 years' time, because we are dependent on Chinese batteries. And therefore, I think in the long run, I think it's typical for China. 2 steps forward, 1 step back. So somehow they're going to take market share here, right?
But is there a loophole to that? If we're talking about in a bid to thaw some of these tensions, there's a move, we were just talking about in the context of Spain, a move to have Chinese infrastructure invest in Spain, in Germany, in Europe, et cetera. But then there's a question of, do you import fully assembled vehicles, or do you import the parts and then assemble them in Europe, and therefore they're a European vehicle? It's a debate that's very popular in the States in terms of what counts as an American vehicle if it's made in Mexico and assembled in the U.S. How nuanced does this debate get at the EU level?
Well, from a macro perspective, political perspective, I think what is much more important is the supply coming from China. Because on the one hand side, companies like Stellantis and also Renault, they say, oh, tariffs might be a good idea. But then at the same time, they say we need much more Chinese supply because it's so much cheaper.
Yeah.
You have got, if I just add up the job losses now in German auto industry, it mainly happens on a supplier level. I would say we are above 50,000 jobs that are being cut in the next 18 months or so.
So these are not at German car companies, these are suppliers too.
Suppliers as well. Look at ZF Friedrichshafen, Continental, Bosch, they all cut jobs. And therefore I think in the long run, that's how China gonna achieve the targets as well. It's on batteries. The CATL has got much better batteries, even than the Koreans. They are cheaper, and you need the batteries because we realize that the consumer does not want to pay the high price. So therefore, we need to get to lower car prices, and we only get that with Chinese batteries, and therefore we need their supply. And then they maybe automatically also can sell the cars here.
But does that loophole work to separate that from a manufacturing and assembled? It doesn't feel like that's the bit that's getting regulated in terms of kind of the made in Europe sticker. Is that loophole working in terms of getting that supply without still kind of paying for it?
I think the Chinese, they do the just pourvoir to assembly here vehicles. I mean, you said it, right? They have got enough capacity in China. They could satisfy all the demand in Europe with the Chinese capacity. So they only do that here because it's required by the politicians. But in the end, we maybe just talk about the CKD production. So they still get most of the parts pre-assembled from China. So therefore, I think they don't produce in Europe because they want to, because just they have to.
Yeah.
Can I come back to your Tesla for a minute? Got a big event coming up tonight. Elon Musk apparently is going to announce the robo-taxi. Is that where the value is going to be? You look at Chinese car companies, it's a volume story, it's a battery story. Tesla's trying to make this a software story. Again, is this something that Europe can compete with? What do you expect from the event? And can we turn Volkswagen or another company like that into a software company as well? Because they're really struggling with that too.
I have another question back to you on your question. Do we have a European smartphone company?
No, we used to. Well, we used to have a phone company, but that didn't go so well.
And here history repeats. We talk about the classic innovator's dilemma, right? So Europe,
Volkswagen's Nokia here, is it?
I don't want to say that. I've got to buy on Volkswagen, so therefore I shouldn't say that. There's an element of national pride maybe also here. No, but I mean, it's extremely difficult. I think it has got to do that we don't have maybe the skill sets in Europe. We don't know how to develop a software. Yep. We start from scratch here, and again, then we have got companies in the US which doing that for years and decades, and they just have got an advantage, right? And that's also what we see tonight maybe with Tesla. I mean, Tesla de facto is doing something in its vehicles that the Europeans still aim to achieve, that any legacy OEM aims to achieve.
The Chinese are 15 years ahead in batteries. How far is Tesla ahead and other companies like it in terms of AI and software application? How big a gap is there?
Well, I think it's probably 5 to 7 years, I could imagine. 5 to 7 years.
We are really behind here in Europe.
It's not just Europe, it's every legacy OEM. I think a GM and Ford, they're not much more advanced. I think it's a legacy OEM issue. So we, in Europe, here the companies, they focus on buying back shares, paying dividends, yeah? But they don't think about it, how can we compete with the Tesla and the other companies, right? I think that's the biggest mistake. And then the regulation comes in and says, okay, we should take the targets back. But ultimately, the companies, they should spend more on investing into technology. And here I would give Volkswagen some credit because they invest. They are criticized for that they spend too much. Yep. Yeah. Maybe they spend at the wrong places and they are too much behind, but at least they try. It's a trial and error approach. And I hope for Volkswagen, I hope for Germany, that they fix it, that with Rivian and the JV, something comes out that they can compete. But I say, I hope, I don't know.
You talked about how we will hold on to cars for a lot less time as a result of them being tech products, Horst, versus the old days when they were less tech. I mean, what do people buy cars on these days? How much of this decision is driven by the technology? Because this seems like an enormous shift.
I think in China it's much more tech-driven. There the people really buy the car because it's techy, good infotainment. In Germany, in Europe, it's still more like, okay, I need to go from A to B, and I need a reliable car. It needs to look good. So that in Europe still has to change. I think when we talk about autonomous driving, the roots are basically in China and in the US. And Tesla may disrupt with NVIDIA the US auto industry, and Europe is somewhere in a sandwich position. Because ultimately, I think in Europe, the US companies, they want to take European as a market and want to make the business here.
Okay, thank you very much, Horst. Thank you for joining us. Thanks for bringing us the story around the auto sector. Fascinating conversation, one that we'll continue. Horst Schneider, head of European automotive research at Bank of America Global Research. Coming up, Hurricane Milton makes landfall in Florida. We will bring you the latest on the storm's path of destruction. We'll continue to monitor that story, of course, very early hours still in the United States. We will leave you, though, this part of the program with live shots of the BOJ Deputy Governor, Ryozo Himeno, who is speaking currently, delivering keynote remarks at a Bloomberg event called Navigating the New Japan. That forum is being streamed live on Bloomberg.com and on LiveGo if you're on your Bloomberg terminal. This is Bloomberg.
About 2% inflation target for 2 consecutive years assumes that the underlying inflation rate will also be around there, and that inflation expectations will be anchored at that level as well. The realization of the outlook can thus be associated with the realization of the goal mentioned in the last sentence of the statement, which is sustainable and stable achievement of the 2% inflation target. Statistics for the full fiscal year 2026 will be
about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to the opening trade. Hurricane Milton then moving across central Florida as we speak. That's after the Category 3 storm made landfall near Tampa, just south of Tampa, in fact, leaving millions without power. Joining us now, Bloomberg weather reporter Mary Hoy, who has been tracking the path of Milton. Mary, so it made landfall at Siesta Key, just south of Sarasota. That's important in terms of insured damage, I know. What else can you tell us about the path of this hurricane?
currently Milton is at a Category 1. That's 2 notches down from the Category 3 that it made landfall at earlier in the evening, the previous day, local time. Even then, though, Milton continues to pack damaging winds, devastating rains, and destructive storm surges through much of the western central coast of Florida. And as Milton continues to track eastwards, now it's about 45 miles southeast of Orlando. It's about to emerge off of the east coast of Florida right around sunrise local time, but it will leave a lot of damages in its midst.
Certainly something we're keeping an eye on. Bloomberg's Mary Hui giving us the latest on Hurricane Milton. We thank you so much. Now, she was saying, of course, there are going to be repercussions, not just for the damage that's there. We're going to see the impact in catastrophe bonds, but also in, of course, the Floridian agricultural sector as well. That could potentially feed into some of the data that we're going to get down the line when it comes to payrolls, when it comes to impact, when it even comes to food prices. You look at the fertilizer read-through. Traders, of course, watching for all of that ahead in the data points ahead. But for today, it's all about U.S. CPI, with further deceleration widely expected and markets pricing in a 25 basis point Fed rate cut in November.
Right now, we see the market, and it's repriced materially, but we're still implying 50 basis points of cuts for this year. And I think when we look at it, whether it's the strength of the underlying economy or the stickiness on the inflation front, that feels a bit too high. So I'll go out on a limb and say we only end up seeing 25 basis points of cuts again for the rest of the year.
For more on this, we're joined now by Bloomberg's Valerie Teitel. All right, Val, you are seeing a year-over-year estimate of 2.3%. What kind of impact does that have in terms of an already pretty volatile bond market?
Look, I think today's number is going to confirm that inflation is still on a downward trend. We would need a really spicy CPI number for people to start raising their eyebrows about that too quickly. Year on year, yes, it is supposed to tick down from 2.5% to 2.3%. And then on the month-on-month number, it's supposed to get a 0.1 reading, which is going to bring us closer and closer to that Fed's 2% target.
Love an overlay chart. If you look at where we are now with inflation versus the 1970s, we'll see if we can bring this one up again. You've got a re-acceleration of inflation. People are beginning to talk about this again. I've got a bond market that's got a 10-year at 4%. We're north of 4% again. I'm seeing charts that are telling me it could go as high as 5 or even 6%. How big a risk is here that the bond market has got this move lower in yields wrong and actually everybody runs to the other side of the boat?
Look, I don't think we're going to get that kind of pivot from the inflation data. I think it's first going to trickle in through perhaps another labor market print where we see a re-acceleration in the labor market. You know, that is a volatile event that is going to be hard for markets to trade. But I think the real Fed pivot, let's say, to a pause, to a quarterly pace, to a skip, could perhaps be with the labor market re-acceleration. So we kind of got hints of that in the last print, but we would need a bit more detail for the Fed members to start to get worried that it could then reignite inflation through wages.
The message we've been getting from the Fed of late, Valerie, has been this sort of "we're not in a hurry." Is that just because they did 50, so they felt they had to say that, or do we read something into that kind of messaging?
Well, look, in the minutes last night, it made it very clear that there were a lot of members who were against the 50 basis point cut. If you kind of read through the lines about what several and some, you know, if you add all the numbers together, it does seem like that the consensus was very much against Powell. So maybe, you know, he had to step out on a limb to get that 50 basis point jumbo cut done. So, you know, the language maybe that we've heard from the Fed members probably is just mirroring what they were saying in that meeting rather than being a change of tone.
Valerie, thank you very much indeed. Valerie Teitel on what we're looking at with the Fed. Look, there's plenty coming up. ECB accounts coming up a little bit later on. We call them minutes, but I think they're called accounts. US CPI, got the French budget coming up a little bit later on. We've got this Tesla event. There's a few events coming up that I think could provide a little bit of volatility for this market.
Yeah, the bond market very much in focus. You talked about it, whether it stays above 4% or continues to stay above 4% off the CPI report. But to me, it's all about euro dollar. Do you start to see the currency market trade off of this budget? Is that the reason?
The French budget.
The French budget.
Right, yeah, the French budget in focus. Meanwhile, we continue to watch Hurricane Milton, now only Category 1 only, as it's over landfall, apparently near the east coast of Florida. We're just seeing this National Hurricane Center alert coming through near Cape Canaveral. We have plenty to focus on as we go through the day, from the macro from the monetary policy story around CPI in the United States to some of the fiscal news here in Europe. This is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
welcome to Balance of Power.
This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Hurricane Milton makes its way across central Florida, carrying it with extreme winds and flash flooding. We'll bring you the latest throughout the morning. European stocks and futures muted after the S&P's record high yesterday. U.S. inflation data later today set to define Fed policy in the coming months. And Michel Barnier's make-or-break budget. The French Prime Minister is set to unveil his plans to narrow the deficit. We'll have the details, of course, on what to expect. But first thing is first, let's take a look at the European markets map. Again, a lot of focus is what's happening stateside with that inflation print and the clues that we get from that on what the Fed does next. A lot of the focus is also on the huge volatility and gyrations that we saw in China. For the moment, we did see them bouncing back quite a lot, and this is because some of the things that they announced last month actually came into practice today. Look at the CAC 40 down to 0.3%. The DAX, similar moves. We also have a great economy minister interview from Spain that credited. We'll bring you that as well. Now, this is the bigger picture. Of course, it's cross-asset. We not only want to look at FX with euro-dollar, but the 10-year yield could warrant another move depending on what that inflation print shows us, 4.0746. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Hurricane Milton is making its way across central Florida, where nearly 3 million homes and businesses are now without power. We'll, of course, be live in Tampa shortly with the latest, but also to discuss what this means for the U.S. We're joined by Ross Matheson, Bloomberg's EMEA News Director, and we'll look ahead to U.S. CPI and talk China with Rachel Evans, our Managing Editor for FX and Rates in the U.S. and here in Europe. So thank you both for joining us. I mean, it's a big hurricane. This comes on the back of actually also Hurricane Helen that was quite devastating. I mean, what are the implications for the U.S. economy, but also politics?
Well, obviously, it remains to be seen how bad the damage is. Very early indications, perhaps
thankfully not as bad as had been expected, particularly around the insurance front. So possibly it may not be as a costly hurricane as we thought, but either way, very, very damaging. You can see the expectations still for a storm surge up to 5 feet. That's still a lot. So we're talking about a lot of damage coming on the back, of course, of Hurricane Helene, which caused an enormous amount of damage, months of work to rebuild roads, houses, and communities, and a lot of questions about disaster funding, how far that stretches, and then, of course, just the nature of the response from officials and how that plays into the political sphere.
Yeah, I mean, when you look at, politics, of course, they'll be probably looking at the Fed. We have, Rachel, that big inflation print today. I mean, I say big because the market is really on tenterhook to try and figure out what the Fed does next.
Yeah, and I think it's interesting that we have kind of the hurricane picture as the backdrop, because that does have implications for the supply chain, which then has implications for inflation. And just kind of given we've had this massive repricing in the market over the last week as a result of kind of that labour market data being stronger than expected, it really has traders on tenterhooks thinking that inflation could be about to rear its head again. So they're looking to stuff that could impact the supply chain. Geopolitical drama in the Middle East, of course, is another inflationary impulse. So I think there's going to be a lot of focus on whether we see these prints come in line or showing some easing, which would be reassuring, but not necessarily reassuring enough to think it's fine, we're going to have more big cuts coming. But to the counter side of that, if we do see inflation sort of even moving a little bit higher, that could reignite, what's been quite a painful sell-off in the Treasury market.
Rachel, do Fed officials look at China and the gyrations and stocks moving up and down and worry about that?
I think to a degree. I mean, they are always concerned about stability. They obviously have a dual mandate that's very focused on the US economy. They're looking for US labor and they're looking for sort of US inflation. But to the degree that they have market instability to deal with, that is something that they are cognizant of when setting policy. And you do see in all of their statements that they look at kind of that bigger geopolitical kind of picture to kind of determine how comfortable folk are going to be with a decision, particularly if it's one that's going to likely surprise people or be something that would move the market significantly.
Roz, when you look at the hurricane, I mean, again, it's a natural disaster. It's a naturally occurring event. But, does the Biden administration deal with it differently because we're so close to the election?
Well, obviously, you can see that Joe Biden cancelled his trip to Germany to stay at home. We've seen, US officials, including, Kamala Harris, the presidential candidate, being very present, equally Donald Trump, trying to show he's very present. And we've seen some incredibly strong language from Joe Biden, really forceful after Donald Trump's comments about, Hurricane Helene, where he was making claims about how much aid people would be getting and claims, that are said to be false about where aid was going. I mean, Biden said there's been relentless, irresponsible, reckless disinformation and lies from Donald Trump. Really strong language from Joe Biden on that. We can see Republican officials on the ground are working with FEMA, the disaster agency. They seem to be saying, we just, pile in and get this done together. There doesn't seem to be that, partisan stuff coming in, whereas Donald Trump obviously using it as a campaign issue. No matter what you do in a disaster, it's never fast enough. It's never enough for everybody. It's messy. It's a pretty, a situation where it's hard to get stuff done fast. So no matter what you do, people may not be happy with it. And so really, the upside is potentially for Donald Trump here, even if everyone's working hard, in the aftermath of this, because he's just got the advantage of claiming they're not doing it quickly enough.
And Rachel, I mean, I guess as we get closer to the election, we also try and figure out exactly what it means for dollar strength, the dollar weakness, depending on some of the trade policies. I mean, the policies don't seem clear enough yet to really make a call on FX.
Yeah, and I think, we've seen kind of from the Harris campaign, there's perhaps a lack of clarity around some of her policies. From the Trump campaign, he's talked a lot about tariffs, but then there's this question mark about how much he actually implements, how much of it is talk versus action. So the market is kind of in a bit of wait and see mode. You're looking to see who gets in, whether they get, the backing of different parts of Congress, how much power they have as a result of a potential sweep. And then do we actually see some of these policies kind of implemented? On the whole, they seem to be relatively inflationary policies as well. So that would suggest higher yields. That would suggest a stronger dollar, as the Fed wouldn't be able to cut as much.
All right, Rachel, thank you so much. Roz and I will, of course, get an update on the hurricane right now. So let's get straight on the ground, because we're returning to our top story, Central Florida, where Hurricane Milton is making its way across the state. The Category 3 storm made landfall on Wednesday evening with winds now traveling at 85 miles per hour. So for more on this, let's bring in ABC's Rena Roy, who's in Tampa. Rena, what's the latest?
Yeah, well, Francine, you can see behind me that it is a lot quieter out here this morning, but for hours the winds were whipping and the rain, it was pouring down here. More than 18 inches falling in St. Petersburg alone. Milton making landfall as a powerful Category 3 storm just after 8 p.m. in Siesta Key, packing 120-mile-per-hour winds and spawning deadly tornadoes and catastrophic flooding. The predicted storm surge up to 13 feet, flooding densely populated areas on the coast, including Fort Myers. Tornadoes devastating hundreds of homes, multiple fatalities also reported at a senior community near Fort Pierce on Florida's East Coast. The governor says 9,000 National Guardsmen have been mobilized to respond to the storm, along with 1,400 search and rescue first responders. There are also 50,000 linemen on hand to help restore power to the millions who are now without electricity. Francine?
But, Irina, the hurricane has been downgraded at this hour. What does that mean in terms of potential damage?
Right. Well, we know that it is a Category 1 right now, as you mentioned, with 85-mile-per-hour winds. We actually just got an update. I'm looking at my notes just a couple of moments ago. So it has gone down significantly. It is now entering the Atlantic Ocean. It took about 8 hours to cross the peninsula.
Rena, thanks so much. Rena Roy there from ABC News. Of course, stay safe out there. Roz, when you look at some of the political turmoil that could be on the back of it, as you say, there's not a good way to deal with, natural disaster. It's always messy. People on the ground need things faster than any administration can probably give. But the Biden administration is also dealing with a number of, wage negotiations, a number of walkouts. Does that also almost directly translate into the election November 5th?
Well, in a way it does, and in a way it doesn't. I mean, when it comes to some of these disputes, like the port dispute basically got shut down pretty quickly. It didn't get resolved, it just got punted to whoever is going to be president come January. That's a nice present for them as they come in, because it's going to come back again. But obviously we've got the long-running Boeing dispute, for example, and that's affecting workers and as well as the company. And so when you're a candidate, you've got to be careful about where you lie in your comments, because obviously you want to support the company potentially if it's losing money as a big employer, as a big manufacturer in some places to resolve these things, but also you need to show support for workers in their push for better conditions, because they're a voting base. And so you have to be very careful. You can see with the Boeing dispute, for example, both Kamala Harris and Donald Trump were quite clearly, making comments supportive of the workers in this case, because again, they are a key voting base. So you can see, all these issues playing into the question around economic policy, and to the point that Rachel was making a minute ago, there's a lack of clarity still about what Kamala Harris would do at the helm economically in terms of her own policies, and how she would manage that, a little untested in those areas. And, in these moments, she's potentially a bit vulnerable there. And so, of course, it does play in. But again, the focus really is still on those key swing states.
Yeah, Roz, thank you so much. As always, Roz Matheson there, Bloomberg's EMEA News Director. Coming up, a conversation with Tina Lee, 1 year after taking over as Chief Executive of Citigroup UK. That exclusive interview is next, and this is Bloomberg. From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
other authorities.
Could face bigger challenges.
Britain's next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Welcome back. Now our next guest is in charge of the UK operations of one of the world's biggest banks. Tina Lee became Citi's UK chief executive a year ago and is one of the most powerful women in banking. Well, Citigroup employs thousands of staff in London as well as several thousand more across Britain. Well, she joins me now to discuss London's future as a hub for financial services and the outlook for the banking sector and, of course, the upcoming Global Investment Summit. Tina, as always, thank you so much for giving us a little bit of your busy schedule. Now, the government has its Global Investment Summit on Monday here in the UK. It'll be one of the first times that international investors really get to know this new administration. Do you think they've done enough to try and attract investment to the UK?
Look, it's early days. I think they've absolutely set out their stall, and it's right that they have put investment and growth at the heart of their strategy. The question is, how do they do it? And what is the role of government in terms of really unlocking private capital? And that's both international capital and domestic capital. So having the opportunity to have this Global Investment Summit next week, I think, is a great opportunity really for the government to set out its stall and really put a little bit more flesh on some of the ideas around, for example, the National Wealth Fund and particularly the role of the UK Infrastructure Bank and the British Business Bank in terms of working with the private sector to de-risk some of these sort of longer-term investments that are so needed in the UK.
Are you optimistic about the prospects of the UK economy, but also, outside investment?
I am actually. I mean, look, this year we do expect there to be quite sluggish growth in the UK economy. We've only had one interest rate cut so far this year, even though we're expecting another one later on in the year. But we do expect the pace of those cuts to accelerate into 2025. So that does create a positive backdrop for growth. And at the same time, really what we're hearing from clients, and this is both international and domestic, is what they really value is the political stability that has been brought to the UK after the general election, but most importantly, wanting to see predictability and policy stability to allow them to invest in long-dated opportunities.
So, Tina, do you think that, the October 30th budget is a really big test for the government? As, again, the Labour Party hasn't been in power for a long time. So what I'm hearing from big international investors is that they want to see really what it's about. And it's the first time we get a proper test.
That's absolutely right. So all attention is really focused on October 30. And we've already seen there's quite a lot of speculation with regard to what is going to be in the budget. We have seen gilt yields rise, over the last week as there have been some concerns around increased investment spending. But certainly I think the government has done the right thing in terms of just setting out their intention around the right guardrails, the fact that that investment is not going to come all in one go. It's going to be phased across the electoral cycle. And most importantly, that they intend on working closely with both the OBR and the National Debt Office or the National Audit Office, because that will reassure both domestic and international investors.
What are you most excited about in the UK? I know there needs to be more IPOs at some point, hopefully. Is London the right place for that?
I think so. I mean, for me, the UK is the gateway to the world. And actually, when we look at the IPO market here in London, it has actually performed pretty well compared to previous years. So we have seen a significant increase in IPOs, admittedly from a low base. It's up about 50% so far this year. But most importantly, those IPOs have performed very well. So I think there is a backdrop with the rising FTSE and the interest rate environment that actually means the backdrop in terms of the macro environment is actually looking broadly positive for 2025. And certainly when we speak to the C-suite and to our corporate clients, they continue to look for opportunities to invest. So that is key. So corporate balance sheets are strong. There's been a lot of financing which has gone on in the debt capital markets, both for M&A financing, hybrid capital refis, liability management exercises. So that means that we don't see much stress in the system, which I think is also important.
You've been in charge of Citigroup UK for a year. How's it been? I mean, there's been a lot going on at the bank.
There has. There's always a lot going on at Citi, but the year has flown by, and I really remain so excited about the opportunity in the UK. You know, where I've really been focused on is really taking advantage of Citi's global network. We're in 96 different countries, but really focusing on those key trade corridors for us. So we're looking to grow business between London and New York. Of course, US is our home market, but also in fast-growing regions such as the Middle East and in countries such as India. So for me, it's not just about our banking business, but it's also about how can we deliver one Citi through our markets, our wealth, and of course our world-class services franchise.
Gina, thanks so much. We'll talk a little bit more about that, and we'll also talk about some of the risks out there and really what clients are asking you on how to deal with that volatility. Tina Lee, Chief Executive of Citi UK, stays with us. We'll also talk possible bank consolidation. This is Bloomberg.
Fixed Income Fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
Welcome back, everyone. Still with us, Tina Lee, Chief Executive of Citi UK. Tina, thank you so much for staying with us. Now, we're basically 1 year on from the biggest reorganization of Citigroup, with the Chief Executive, Jane Fraser, putting a number of things in place. And you were talking about how you're also taking advantage of some of the unique challenges but opportunities that you have. What's been the biggest difference?
So we have really simplified our management structures. It sounds very mundane, but things like fewer committees, fewer meetings, fewer management layers. We've reduced management layers, in some cases down to sort of 12 from 15, 16, 17. So that means we're able to really speed up decision making much better and drive accountability. So that really has been, I think, the biggest change.
Will you hire people in the UK now that you've do you have it where you want it to be?
We're pretty much at the right size. We will continue to hire selectively as we always have done. So we've recently had our new head of our commercial bank for the UK join. He joined last week, James Morris. And of course, at our most senior levels, we've been able to hire some really world-class talent, with Viz Raghavan joining as head of banking, Tim Ryan in terms of technology. So it is less about actually hiring significantly. We will always be strategic around needing to fill roles. But at the same time, we have a really deep bench at Citi, so it's also around giving people within our own organisation the ability to step up.
Tina, when you look at Europe, I mean, the banking world was like alight with speculation, and then I guess almost confirmation that there could be a merger, although the Germans don't want it, between Commerzbank and UniCredit. How does that change the banking landscape and your world?
So, I mean, the European banking sector has been highly fragmented forever. And there has been lots of discussion over the years around the need for banking union, capital markets union. So certainly from our perspective, I mean, we have a significant presence in Europe in many different countries. So for us, really, any developments that require or actually allow for a greater free flow of capital across the region, we would welcome, because that allows us to deliver our cross-border capabilities more effectively. So we look on with interest.
But is it a litmus test of whether there's appetite for political banking consolidation?
I think it's certainly going to be an important moment for European banks, and I think it's interesting both, some of the comments that have come out from Mario Draghi in his most recent report around competitiveness in the EU, around regulation, and again the need to drive capital markets union. I think all plays into this next phase.
When you look at, I guess the banking landscape here in London, I know you're committed to Canary Wharf, but also maybe looking at other places. What do you think happens to Canary Wharf?
Well, as you know, Francine, we are committed to Canary Wharf. We're in the middle of a significant renovation of our iconic City Tower. That's going to be completed in the middle of 26. So when that's done, we will have 10,000 people in London, the majority of which will be at the wharf. So I think it's a great environment to work in, and I think what Shobi is doing with regard to that mixed use, I think is to be welcomed. We also have 4,000 people in Belfast, so that has grown from the low 200s about 20 years ago. So again, that is a region that we are very committed to.
Tina, thank you so much, as always, for coming on. Tina Lee there, Chief Executive of Citigroup UK. Now, coming up, as interest rates fall and investors return, we discuss the outlook for the property sector with Jonathan Goldstein. He's the Chief Executive of Kane International. He's also on the board of Chelsea Football Club. That conversation is up next, and this is Bloomberg.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep winning World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Hurricane Milton makes its way across central Florida, carrying with it extreme winds and flash flooding. We'll bring you the latest throughout the morning. European stocks and futures pretty muted after the S&P's record high yesterday. U.S. inflation data out later is set to define Fed policy in the coming months. And Michel Barnier's make-or-break budget. The French Prime Minister is set to unveil his plans to narrow the deficit. We'll have the details on what to expect. So back to our top story. Hurricane Milton has battered Florida with heavy wind and rain. Now, more than 3 million people are also without power. Let's get more on, of course, some of the financial consequences. Investors in catastrophe bonds are preparing for substantial losses. So we're joined by Gautam Naik, Bloomberg's ESG editor. Thank you for joining us. So what are the likely scale of losses for investors in these so-called cat bonds?
Hi, good morning. So it looks like the cat bond market has avoided the worst-case scenario. As of now, I've only seen one estimate, and insured losses could be anywhere from 20 billion to 60 billion. That's mainly because Milton hit further south in the Tampa Bay area around Sarasota. If there's a $20 billion loss, insured loss, then it looks like the cat bond market may not even take any hit. But if it's up to about 60 billion, it could be a 4% decline.
So how has the market evolved, Gautam? I mean, it seems bigger, but as there are more dangerous storms becoming more common, does it change the way that, prices are set going forward?
Yeah, absolutely. So already reinsurance prices are quite high, and insurers are having to take the brunt of the current damage that storms, but also other natural disasters are causing. It looks like that there will be a further increase if there's significant losses from Hurricane Milton. And the cat bond market itself has grown quite a bit. Last year was a record level of issuance. It looks like this year's on track also to hit a record level of issuance. It's an indication that insurers are increasingly and reinsurers are increasingly trying to pass on some of this natural catastrophe risk to Wall Street.
Gautam, thank you so much. Gautam Naik there, Bloomberg's ESG editor. Now, investor interest in returning to Europe's real estate sector with the onset of rate cuts and bottomed out valuations. Now, higher rates and shifting work dynamics had plunged the industry into turmoil, with many landlords forced to sell assets. To discuss the outlook for the sector, I'm joined by Jonathan Goldstein, the chief executive of Kane International. Now, the firm operates in the UK, Europe, and the US and manages more than $16 billion in assets. He may also sit on the Chelsea Football Club board. Jonathan, thank you so much and welcome, of course, to The Pulse. Now, is U.S. capital starting to flow back into some of these real estate assets as they become more attractive, or certainly as they're stabilizing?
I think you're absolutely right. Firstly, good morning. Obviously, the last 24, 36 months have been challenging for the real estate industry, but we're really beginning to see signs that core capital is coming back to the marketplace. Rate shifts, people really feeling that the Fed cut, the Bank of England cut, has begun to see a progression towards lower interest rates, has brought capital back to the market. We're seeing it all over the space. And that's giving confidence back to existing owners, but also to investors. You'll still see this real strong focus on the credit aspects of the industry. People have really focused on that in the last 5 years. But as rates decline, obviously the return on capital in those areas comes back. And that, again, will drive more people into making more investments and give greater stability to the
So where's that money being deployed? Is it specifically in the UK because politically it's certainly more stable than what we've seen in the past?
Yeah, I think that's right. I think, the UK, government, the changing government has provided at least a 5-year outlook of stability and a lack of noise that we had in the previous, 10 years. And I think, you're seeing next week there's a big international investor summit on Monday in London where, the government has brought together some of the great world leaders in business to try and show that Britain is back and Britain's back in business. And I think that is going to lead to another inflow of capital. We've seen it across the UK from Amazon, from Blackstone, from others in the course of the last 12 weeks. And I'm convinced that that will continue as we continue down this road of a softening in interest rates and greater economy, a view that the soft landing will happen, that there won't be recession, and that will give increased investment and increased confidence in the UK.
Jonathan, when you look at student housing, in which Kane invests, it's been doing pretty well compared to the rest of the sector, but there's concerns about visa, about tuition fees going up. How do you see that developing?
Well, again, I think the previous administration was sending mixed messages to people. Did we want people here? Did we not want people here? And I think now that we look forward in a more stable environment, people will see the UK as a great place to come. We've got some of the great educational establishments. We've invested substantially into the sector and continue to do so. In fact, we're doing another transaction this week, actually, in Bristol, because we're seeing great growth in this marketplace as people wish to be in the UK. And I think it's this consistency of message that enables people to both invest and to see the UK as a trusted partner again, which I think is hugely important.
But the budget seems crucial, October 30th. I mean, and I guess the path to narrow the landing path is extremely tight to make sure that investors continue coming back in.
I think you make a great point.
What do you need from the government?
I think you make a great point. I think that the government has a very difficult balancing act, in its hands. And I think it needs to ensure that obviously it raises the revenue it needs to do, that it taxes in the right way, taxes in the right areas, but also ensures that business feels incentivized to carry on investing in the UK. And I think all the messaging we're hearing is that they're hearing that message, they're understanding that message, and I'm convinced that the budget will be appropriately balanced so that people will still feel that the UK is a great place to invest.
When you look at real estate in Europe, there were concerns about valuations, or maybe some of the sellers wanted too high a price. Has that adjusted itself?
No, it hasn't. I think Europe is slow. Europe has been slow in certain areas. Certainly Germany and France have been very soft. Obviously, if you go further east into Poland, it's still affected by the geopolitical issues in the Ukraine and the knock-on effect into Poland. So I think Poland, I think Europe has, been slower to react. We're beginning to see stronger signs in the UK and in the US than we are in Europe. But, I think, look, the greatest challenge we have out there is geopolitical. We obviously have the ongoing, terrible atrocities in the Ukraine, and obviously the Middle East is a very challenging area, both of which pose real threats to the global economy. And I think from an economic perspective, an investor perspective, obviously one would want to see, and from a humanitarian perspective, people would want to see those resolved as quickly as possible.
But we heard from Jamie Dimon and Ray Dalio this week, and actually they were not so convinced that interest rate cuts were continuing, partly because of inflation, partly because of all these geopolitical risks. Does that change, where you see your sector going if interest rates have to go back up in the next 12 months?
No, I think absolutely. I think the consequence of the Fed cutting their rates was that people were no longer talking about a rate cut, but they actually saw one in effect. And therefore, people could actually feel the impact of that. The big outlier out there is if interest rates were to reverse back the other way. If the result of increased inflation or the result of geopolitical situations was to cause a rise in interest rates again, I think that would cause a seismic shock to the industry. I think, we found in 2023 that people went into the year believing the interest rate cuts were coming. And I think people, spent the whole year being disappointed, and that created a sense of gloom around the industry. I think if we went back into that environment in late 24 or 25, I do think there'd be a lot of downside risk.
Jonathan, talk to me about football, because it's of course, you're on the board of Chelsea Football Club. Is there anything going on at Earl's Court that actually Stamford Bridge could move there?
Look, we've discussed this before, you and I. The development of a stadium in central London is a very complex operation. Chelsea hired he's now the head of the management board, Jason Gannon. He developed SoFi in Los Angeles, one of the world's great stadia. And he's really focused now on a day-to-day basis on bringing the right solution to the club. The shareholder group is really focused on ensuring that Chelsea remains, a world-leading football club, both in the men's and the women's teams. And in both the men's and the women's, they've started the season really strongly. And we will bring the right result for the supporters as we come forward, because we want to ensure that Chelsea is at the top of the game globally.
So that's a maybe for Earl's Court, or do you think you've missed the boat?
Well, I don't think I want to sit here and rule anything out. What we're very keen on is ensuring that we have a world-leading stadium going forward.
Is it still fun being part of a football club?
It's always fun. Football's a great sport. Chelsea is a world-leading club. And we're all very proud to be associated with it.
Do you see more money coming in from the U.S.?
Well, I think we're seeing it at the moment. Everton Football Club's just traded to an American. I think, and obviously that's good to provide stability to Everton after some turbulent years. And I think that's a trend that will continue over the coming years.
Do you think it changes the game?
I think at the heart of it, this is a sport that's owned by the supporters. And I think the minute you forget that and you lose contact with your supporter base, then I think the sport's in trouble. And I think one of the great things about the Premier League over the years, with all the broadcasting, with all the globalization, it's still a supporter-led, business. The passion that you see in Premier League games is second to none. And I'm sure that will continue over the years.
Jonathan, thank you so much for joining us. And congratulations also on an ever-expanding family.
Thank you very much.
We had good news this week. Jonathan Goldstein, their chief executive of Kane International. Now, Bloomberg understands that Bernard Arnault's family is nearing the purchase, talking about football, of a majority stake in second-tier football club Paris FC. Now, the billionaire who controls luxury conglomerate LVMH is set to invest in the football team alongside Red Bull. Paris FC is currently the leader of France's Ligue 2, one step below the top league. Coming up, make or break, France is set to announce its budget later today, with the pressure firmly on the Prime Minister, Michel Barnier, to reduce the country's budget deficit. We'll bring you the details next, and this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
We need to keep on negotiating. We need to keep all avenues for dialogue open to find a conclusion, a negotiated conclusion, which is actually valid for both parties. It's important also for us, not only in terms of being able to protect a key strategic sector going forward, but also think in medium term to avoid an escalation of protectionist measures, which would be a lose-lose for both areas.
Well, that was the Spanish Economy Minister, Carlos Cuerpo, speaking exclusively with Bloomberg's Kriti Gupta in Madrid yesterday, where they discussed trade measures with Beijing as well as Spain's budget and economy. Now let's turn our focus to Germany, where the economy is heading for its second straight annual contraction. The government has revised down its output projection for 2024, the latest sign that Europe's biggest economy is struggling to shake off a prolonged period of weakness. Well, Germany's economy minister says a slow recovery is likely to take root next month. Well, later this evening, France will also be unveiling its annual budget. The Prime Minister, Michel Barnier, is facing a number of economic challenges, with many having different theories on how best to tackle them.
The French economy has been kind of getting away with fiscal murder for a very long time.
This cabinet seems to be committed to continue the pro-competitiveness agenda.
I expect the government to be very, very serious on diminishing public spendings, because it's absolutely necessary. And if you concentrate only on taxes, you will only weaken the economy.
The question is not what government we will have in France, but when it falls, when it collapses. And it could take some months.
I wouldn't speak about austerity measures. I would speak more, as I said, on responsibility, accountability to people.
We need to straighten the ship very quickly if we don't want to get into much more troubled waters.
I'm quite confident that they will do their best to tackle what is on the table.
The goal is to convince all the observers, market participants, investors, savers, that they can trust that indeed France is going in the right direction.
Now, for more on all of this, we're joined by Bloomberg's Caroline Conan from Paris. Caroline, good morning. Now, the French budget will finally be unveiled tonight. What can we expect?
Austerity in order to restore credibility. We know that Michel Barnier is looking for 60 billion euros. 2/3 will come from savings, 1/3 from tax hikes. In terms of savings, what do we know so far? The new finance minister, Antoine Armand, has said that about half of the 40 billion euros of savings will actually come from freezing or capping the budgets of the ministries at the state level. Some public servants will not be replaced. Some public services will be merged. There will be less incentives for apprenticeship, for R&D, for example. The social security will also contribute with less payments, for example, for sick days, and also an impact on retirees with the indexation of pension on inflation delayed for at least 6 months. Then, in terms of how is he going to find an extra 20 billion euros of revenues? Well, of course, tax hikes. Tax hikes, we've talked already about this exceptional tax on big companies generating more than 1 billion euros of revenues. That should target about 300 French companies. And some of the big names out there like LVMH, Engie, Vinci, Bouygues could actually be affected, according to Morgan Stanley, up to as much as 5% of their net income. So quite significant impact. Finally, in terms of wealthy individuals, well, if you are part of the 0.3% richest French people, those who are a couple without children earning more than 500,000 euros a year, then the income tax will increase.
Are these measures, Karine, going to be enough to bring the deficit down and please Brussels?
It remains to be seen, because you know that Brussels has already placed France under this excessive deficit procedure. And even with all these 60 billion euros of savings, the deficit is only going to get back to 5% of GDP next year from more than 6% this year. French debt also is said to continue to rise to as much as 115% of GDP next year. And French debt has consistently risen over the past 25 years. It was 60% only, for example, under President Jacques Chirac. We'll actually almost see the reaction immediately, because we're getting an assessment from Fitch credit rating agency as soon as tomorrow night. Remember, they already downgraded France last year. And also, of course, it remains to be seen how long this Barnier government actually survives. It already survived its first vote of no confidence on Tuesday night, because the National Rally of Marine Le Pen didn't support the motion of censure from the left wing. But of course, everything is in the hands of Marine Le Pen, and we'll see exactly how long she waits until she pulls the rug.
Karine, thank you so much. Karine Conan there with the very latest on the French budget. Now, Bloomberg understands that Stellantis chief executive Carlos Tavares is planning a deep management reshuffle in response to the automaker's disastrous profit warning. Now, Tavares may present his proposal at a board of directors meeting in the U.S. this week. The car maker is struggling with waning demand and high inventory. Then shares in GSK are soaring this morning. That's after the UK drug maker agreed to pay up to $2.2 billion to settle its Zantac liability cases. Now, the settlement will resolve almost all 80,000 U.S. court cases over allegations its old Zantac medication was contaminated with a suspected carcinogen. Well, GSK has denied liability. Coming up, a bit of turbulence for Airbus after its orders and deliveries dip more than expected. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow.
And these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Airbus deliveries fell 9% in September to 50 aircraft compared with the same month last year. It comes as rival Boeing faces its own problems, including a strike by workers, which has shut large parts of its manufacturing. Now, we're joined by Sid Philip, our global aviation reporter. So, Sid, good morning, first of all, but what do these Airbus deliveries in September mean for their full-year outlook?
Good morning, Francine. So for Airbus, I mean, this is another sort of sign that their full-year target, which they had to cut in June, they had previously planned for 800 deliveries. They reduced it to 770. And even now, that may be a stretch because of the fact that their supply chain is so backed up that they can't produce enough aircraft. And that's been a really big toll on their sort of deliveries and their outlook for deliveries.
Sid, why has Airbus not been able to capitalize on the troubles that Boeing's had?
So Airbus has really struggled with supply chains from the sort of run-up after the pandemic. Suppliers cut back staff, they cut back workers, and they've been sort of had to scale up production since the pandemic. And that's still not back to where it should be. And so Airbus has had to change its targets multiple times, including its long-term targets for raising production and their short-term targets in terms of annual production. And the problem for Airbus is that even if one part is missing, they can't put a plane together. So they've talked about how engines and interiors are a big sort of pain point for them at the moment, and that's sort of holding back deliveries at them.
How is their position different to Boeing, though?
So Airbus is in a sort of different position than Boeing because, I mean, on one hand, Airbus is struggling with supplies, whereas Boeing is sort of struggling on multiple counts in terms of they have issues with production, in terms of the strike that they have at the moment with their workforce, which is now entering its 4th week. You've also got the FAA restricting production on the 737 MAX following the blowout in January, and then they have sort of other issues with cash flow and everything else. So Airbus should have been able to capitalize on Boeing's woes, but unfortunately they can't even deliver aircraft even to their own customers in the quantities that they promised.
Sid, thank you so much. Sid Philip there with the very latest, of course. On Airbus yesterday, we spent a long time talking about Boeing. Now, we have a big day, a big markets day, actually, today because we have inflation data out of the U.S. a little bit later on. Pretty much stocks are kind of steady today. I guess they settled into this holding pattern ahead of the U.S. inflation data that should provide a little bit of clues on the Fed's policy path. Now, U.S. consumer price data is expected to show that inflation is moderating further, and that would support the Fed's anticipated easing in the coming months. In the wake of the surprisingly strong job growth for September that was reported last Friday, the gradually slowdown in price pressures, though, suggests that policymakers will opt for possibly a smaller interest rate cut when they meet next month. So overall, we're looking also at, for example, the 10-year yield. We had a big repricing last time, so let's look cross-asset about what the 10-year yield is doing at the moment. Again, minutes of the last policy meeting showed that a majority of FOMC minutes supported a 50 basis point cuts, but again, there was a preference among some officials to cut rates at a more gradual pace. So we'll have plenty more, not only on the U.S., but we'll have a lot more, of course, on China. These Chinese stocks jumping around after the release of details on stimulus measures, with China's central bank setting up a swap facility to provide liquidity to international investors to buy stocks. Up next, a Bloomberg Brief, Danny Berger in New York, and this is Bloomberg.
suppose I want to buy a computer, but I want to have AI in my computer. I want to be really up to date. Do you have AI in your computers yet?
No, not yet, but it's coming soon. And we think this is going to be one of the largest transformations in the PC industry in decades. What will be possible starting this summer is to run large language models in AI PCs, which means that what today all of us are doing in the cloud, where you use any of the applications that you can, you will be able to do it locally. And what this means, which is why we think this is important, is it will be much better from a cost perspective, because running models in the cloud is expensive. It will be better from a security perspective, because you will be able to use the model with your own data locally without having to upload your data to the cloud, and you will be able to do it anywhere in the world. And also for applications where speed is important, where latency is important, you will be able to do it locally much faster. For example, in gaming, where the game needs any resource the computer have, it will be a much better model. So it's going to be a big change starting this summer.
At the same price, too?
Slightly higher price, but if we look at the increase of price versus the increase of value, not comparable.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, only on Bloomberg TV and radio. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. 44th record high. Stocks take a breather this morning ahead of the start of third quarter earnings. The bar for pausing is the countdown to CPI with an FOMC that says it's in no hurry. And Hurricane Milton sweeps through Florida, making landfall, leaving 3 million homes and businesses without power. We are live from Tampa later this hour. It's the October surprise that nobody wanted. It is a devastation in Florida. We're going to be covering that throughout the hour. Elsewhere, we are waiting to see whether CPI delivers another form of surprise. That'll be coming in about 3.5 hours. In the meantime, equities taking a break from the gains from another record high, 44th. The risk was on fire yesterday in a good way. 44th record high. Spreads for IG go into the tightest since 2021. We're down across the board. It is small caps that are leading the losses this morning, down 0.4%. Bonds elsewhere, we did see yields higher after a more hawkish FOMC. It did seem that there are more participants who argued for a 25 basis point cut, but Powell leading the way. The front end, that is gaining somewhat this morning, basically unchanged. We are above 4% across the year. Your 10-year yield highest since July, 4.07% is where we stand. Dollar also taking a breather this morning, but actually slightly higher, but it's been higher for 8 straight sessions, its longest winning streak since 2022. So you had FOMC minutes yesterday. You also had plenty of Fed speak, a lot of Fed speak this week. Among that, there was San Francisco Fed President Mary Daly. She was talking about what she sees as the path forward for the rest of the year.
We are just where I believe we need to be at full employment, not growing too fast, not growing too slow. And I am now quite confident that inflation is on path to hit our 2% goal. I think that 2 more cuts this year or 1 more cut this year really spans the range of what is likely in my mind, given my projection for the economy. But it's really important to put caveats with that.
Well, caution is certainly in the air ahead of the CPI data. 3.5 hours is when it will hit. Even though it's expected to show a deceleration in inflation, Fed speakers have been emphasizing the need for gradual policy. You heard there from Mary Daly, 10-year yields backing back up above 4%. Joining us now is Simon Dangor, head of fixed income macro strategies at Goldman Sachs Asset Management. Simon, really wonderful to speak with you this morning. Do you think that caution is warranted? What do you make of the backup in yields?
Hey, Danny, thanks so much for having me on the show this morning. I mean, the backup in the yields makes some sense, given that the starting point we had going into the September payrolls that we got last week was really priced for some caution that we were moving more quickly into a deterioration in labor market conditions. And I think with what we got last week, some of those concerns have gone away. But we'd expect that yields will find some support here and investor demand will come in, particularly if we get something on the more benign side in the CPI report later today. Ultimately, we've now priced out a lot of that weaker growth scenarios, and we're still facing a central bank which is likely to cut rates a couple more times this year. We heard that from Mary Daly. I think we'd be more in the camp that it's 2 rather than 1, and underpinned by the fact that the underlying picture of inflation continues to look constructive.
Simon, how do you understand where the bar is? You think it'll likely be 2 more cuts, 25 basis points, I'm assuming. How do you understand how high the bar is to not go twice and to pause either November or December?
I think it's important to contextualize the starting points of rates, which I think means that the bar to going at least twice more in 25 increments is set reasonably low. If you look at lots of classic Taylor rule formulations for the Fed, and of course Powell has often referred to these, they still leave policy rates somewhat high, even after the 50 basis point cut that we have last month, compared to those Taylor rule specifications. So we think as we're in that phase, the next couple of cuts are something that have reasonably low bars. We thought it was interesting to see the minutes yesterday evening from the Fed. Clearly there was some caution around some of the members around going 50, and that really showed through in the dot plot. I'm not sure there was a ton of new information from the minutes from that perspective, but clearly the chairman is driving the bus here, and he's very focused on this risk management calculation, shifting from being very inflation focused, which was of course the picture for the last couple of years, to being much more sensitive to the labor market environment. We think in spite of that stronger jobs number that we got last week, the broad calculation of the Fed, or the characterization of the Fed, that any further weakening in labor conditions is unwarranted remains the case, and that will underpin this low bar to additional cuts this year.
So if the bar is low, market's pricing in, let's say, 20% odds just about that they don't hike, or they don't cut rather, if I can get my words correctly, that they pause in the next meeting. How do you understand how big of a buying opportunity this is? Simon, for so long, over the past few months, we've heard there's reinvestment risk, you need to buy bonds, yields are coming down. Simon, they've gone up, they're back above 4%. They've been going higher since before the last meeting. Is this the golden opportunity to get back in when yields are attractive?
I mean, everyone's dying for a directional call right now. We think certainly in a portfolio context, the value of owning duration alongside risky assets has improved. And that reflects what's gone on with the underlying inflation process, which is going to keep the Fed in an environment where they can respond to weakness if we see it. Of course, that should be bad for risk assets. We think we're in a world where bad news is bad news. And therefore, in a portfolio context, adding some duration makes sense, particularly in the front end of the curve. But we're very focused, and particularly in our global strategies, on opportunities in relative value space. Because when you look across the world, different central banks are facing really quite different fact sets. If I think about here in Europe, the growth picture is considerably weaker than what we see in the US. Inflation has been disappointing in Europe this year in terms of how much progress that it's made, but we see under the hood more positive signs that we would expect some softening in that picture in the course of the coming months. And of course, if you look at, let's say, for instance, household savings rates, they paint a picture whereby policy conditions in Europe seem to be much more clearly tight than what we see in the US. So expecting the ECB to cut next week, expecting that they cut again in December, but really the juice might be into what's priced into 2025, where the risk is that they deliver much more than what's priced in. So thinking about these opportunities in a global sense, what's priced for Europe, what's priced for the Bank of England as well, relative to the US, is where we're trying to take more risk at the moment.
As you're judging European sovereign bonds versus Treasury, Simon, how much does fiscal policy come into play? You have a United States that, regardless of who's president, there's likely to be more spending. And where you are in the UK, a serious conversation about taxes. France is trying to set a budget. How does that differential play to you?
I think it's an important feature of thinking as well about the sort of risk distribution around these different rates markets. I mean, the debate in Europe is in many respects about how do we consolidate against an environment where over the last several years, the growth picture has been quite weak. Whilst in the US, of course, the growth picture has been better, but the view has been, how far can we sort of push what we can get away with in terms of fiscal policy? We'll see what we get next month in terms of the outcome from the election, but really under all the combinations that we might receive, no one's really advocating for a lot of fiscal constraint. You know, one of the things that's coming onto our radar screen as an interesting thing to add to portfolios is inflation-linked bonds. They've been very unloved over the course of the last couple of years, that made sense in the context of the Fed trying to drive inflation lower and focusing on those upside inflation risks. That's now shifted with the central bank focusing, as we discussed, on more balanced risks and risks to the downside against this backdrop of a reasonably resilient economy. And the fiscal authorities are likely to be continuing to push on more fiscal in the United States. So we see what's priced into the inflation market as reasonably undemanding, particularly as you go out the break-even curve. Of course, ultimately, when you think about places like the US, fiscal risk should probably play out as much in terms of how long-term break-evens are priced as anything else, and that looks like an interesting entry point portfolio for portfolios. Of course, as well, when you look at what's going on in the Middle East, having some inflation protection in portfolios is a nice buffer if we were to see the scenarios play out where oil prices move more meaningfully higher.
Simon, we're going to have to leave it there. Really wonderful to catch up with you this morning. Great to get your thoughts. Simon Dangor of Goldman Sachs Asset Management. Let's give you some other top stories now that are trending on the terminal this morning. Donald Trump has laid out his latest tax proposal. This time, he says he would end U.S. income taxes on Americans living abroad. That would require congressional approval, though, to happen. The Committee for Responsible Federal Budget estimates that Trump's tax proposals would likely cost $10 trillion over the next decade. Sales of German-made autos are plunging in their biggest market. BMW sales slumped 30% in China. For Mercedes, the figure was a fall of 13%. Germany's car industry has just delivered a wave of profit warnings before those figures. Younger drivers in China are increasingly turning to homegrown brands that are perceived to have more advanced technology. Hedge funds have been cashing in on the recent rally in Chinese stocks. They sold a record number of them yesterday, according to Goldman Sachs. Funds didn't just unwind their longs, they also added shorts. Chinese equity market volatility is at the highest since 2016 right now, after traders in the country returned from a week-long holiday. Coming up, Milton strikes Florida. We're going to go live to the ground from Tampa to discuss the damage as it moves inland. And later in this hour, as we count down to CPI, we're going to catch up with Citi's Andrew Hollenhorst on what he expects from today's print and why a 50 basis point cut is still going to come this year. All that to come on your brief.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
look at how we're faring when it comes to Asian markets.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Space, the next frontier of the tech sector. On Friday, Bloomberg Technology is live in LA for a special episode from Rocket Lab, featuring conversations with founders and investors of the companies plotting humankind's future outside of Earth's atmosphere.
We're going to get hands-on with the future of space technology, from rockets to robots.
Countdown to 11 a.m. Eastern, 8 a.m. on the West Coast, only on Bloomberg Television. Context changes everything.
We've already directed the Department of Defense to be ready to provide active duty service members to support Florida after the storm surge if Governor DeSantis requests the help, which I expect he might, just like we did in North Carolina.
That was President Biden speaking before the hurricane made landfall. Let's go straight now live to Tampa, Florida, where ABC News reporter Rena Roy joins us. Rena, we really hope you're staying safe there, along with anyone else who is left in Tampa. Just describe to us what's happened so far, what the ground looks like, and the damage that's been done.
Yeah, well, Danny, you can see behind me that it is quite quiet here this morning. Things have calmed down, but for hours, rain was just pummeling this area. The winds were whipping. More than 18 inches of rain falling in St. Petersburg alone. Milton making landfall as a powerful Category 3 storm just after 8 p.m. in Siesta Key, packing 120-mile-per-hour winds and spawning deadly tornadoes. The predicted storm surge up to 13 feet, flooding densely populated areas on the coast, including Fort Myers. Tornadoes devastating hundreds of homes. The governor says 9,000 National Guardsmen have been mobilized to respond to the storm, along with 1,400 search and rescue first responders. There are also 50,000 linemen on hand to help the now more than 3 million customers who are without electricity. Danny?
Of course, now comes the storm surge, now comes potential flooding risk. In terms of what going forward, the response, what resources are available, what does the aftermath of this look like, Rena?
Right. Well, we know that the hurricane has now started entering the Atlantic Ocean. It took about 8 hours to cross the peninsula. So conditions have cleared out when it comes to that rain and that wind. So crews will be able to start getting out there as the sun comes up. They'll be able to start assessing the damage and seeing who might need help out there. As I mentioned, there are a lot of resources on the ground from the local, the state, the federal level. They are all working together to figure out what this state really needs to move forward in the coming days and weeks.
Rena, thank you so much. And again, we really hope you stay safe out there. That is ABC's Rena Roy. You can track the storm's path, map Storm Go on your Bloomberg terminal. Again, we're wishing the best for anyone else out there. Really just devastation and devastating pictures we're looking at a region that was already hit hard by Helene. Okay, coming up, we're going to take a look at what else is making headlines around the world, including the first call between President Biden and Prime Minister Netanyahu in over a month. All that to come on your brief.
invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
As we spend some time here on the broader presidential race,
Let's focus in on European politics.
Makes you wonder how politics might play out.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news, a look at what's making headlines around the world. Most pages leading with Hurricane Milton. The New York Times has this, that Hurricane Milton has destroyed the roof of the Tropicana Field Stadium. Just to give you an idea of how strong these winds have been, it is home to the MLB's Tampa Bay Rays. DeSantis had said before the storm hit that they would be converting the stadium into a 10,000-person base camp for post-landfall responders. It is not being used as a shelter, but images across social media of the roof of that, the fiberglass going throughout the wind. Okay, next up on the Wall Street Journal, TD Bank is facing a $3 billion penalty and growth restriction in the U.S. on a U.S. settlement. It involves a cap on U.S. retail banking assets. Now, those penalties follow a settlement with regulators over failure to catch money laundering. An announcement is expected on Thursday, that according to our very own sources. And we have this on our front page. Netanyahu speaking to Biden as Israel's Iran retaliation is looming. It was the first conversation between the two leaders since August. The call throws into focus Biden's limited ability to influence Netanyahu. Of course, one of the main ministers was going to come to the U.S., canceled that trip. Vice President Kamala Harris apparently was also included in that call. Joining us for more detail is Bloomberg's Jomana Bersecci. And Jomana, of course, this comes after Yoav Galan was supposed to be in the U.S., and that trip was delayed. It also comes amid the awkwardness of that Bob Woodward book saying that Biden and Netanyahu had tense conversations. So what do we know about this one?
Yeah, well, this was the first phone call the two leaders had had in over a month. The White House put out a readout of a call which stated that the two had discussed many different topics, but namely Biden had condemned Iran's ballistic missile attack on Israel from last week, affirming the U.S.'s commitment to Israel's defense, also saying that Israel has a right to protect its citizens from Hezbollah. This is, of course, in reference to the conflict now that continues to expand in Lebanon, but then the U.S. also saying that there is a need to minimize harm to Lebanese civilians, especially in densely populated areas in Beirut. They also discussed the need to renew diplomatic efforts to release hostages held by Hamas and the humanitarian situation in Gaza. But what was not discussed a lot, or at least there wasn't a lot of detail disclosed, was vis-a-vis the potential Israeli reprisal to those Iranian ballistic missile attacks. And you've got to think there that that is on back of some security concerns heading into what could possibly be quite an imminent attack, but also due to the complexity of the operation. What we do know is that the Israeli Security Cabinet is meeting tonight at 8 p.m. local time, and earlier today yesterday, the defense minister, Yoav Gallant, said that Israel's strike on Iran will be lethal, precise, and especially surprising. And we also know that over the last couple of days, the U.S. has tried to exert diplomatic influence to prevent Israel from potentially striking on nuclear infrastructure and oil infrastructure, which could be quite disruptive, as we know, to global markets.
Jomana, we've also seen the Iranian foreign minister doing a diplomatic tour of sorts within the Middle East. He was in Saudi yesterday. What do we make of the significance of that?
Yeah, so this was very interesting, very notable indeed. The Iranian foreign minister has been doing a trip around the region. He was in Lebanon and Syria over the weekend, but then he went to Saudi Arabia yesterday. Some images were put out by the Saudi Arabian foreign ministry showing him having discussions with the Saudi Arabian foreign minister and the Crown Prince Mohammed bin Salman. And perhaps it serves to underscore the fact that some of these Gulf Arab nations do want to stay neutral in case of things really blowing up between Israel and Iran in the coming days, but also significance in the context of Iran and Saudi Arabian relationships, because it was only in 2023 that there was a mediation of sorts. By the way, that was brokered by China. And it was only in the last couple of years that the two have actually been engaging in diplomatic dialogue. And the reason this is relevant, Danny, is because some people say that should Israel choose to target Iranian oil infrastructure, one way that Iran could respond is by hitting oil infrastructure of U.S.'s allies in the GCC, and one of them, of course, would be Saudi Arabia. There is a precedent to that because Aramco facilities did get targeted in 2019. But we are in a different environment today, and that is why the meeting that took place between the Iranian foreign minister and those key officials within Saudi Arabia, I think, are quite notable from a geopolitical standpoint.
And we are in a moment where we are more than a year on of this conflict, Jomana. It has spread across the Middle East. We know Israel has appeared to up their campaign in Lebanon, with Hezbollah saying that they would back a ceasefire. Where do we stand on any sort of resolution to the conflict or even just lessening of it?
Look, the background to this, Danny, is Lebanon has been in a state of political stalemate for the last couple of years, a state of political paralysis. And many within Lebanon are saying that given the situation now and given the relative decapitation of Hezbollah, it's an opportunity for the government to get itself together and come out with a united stance on what should be happening next. And we've heard language from the Lebanese Prime Minister in the last couple of days saying that they are committed to implementing this so-called Resolution 1701, which states that Hezbollah put down their arms and move up away from the border. But the question is whether these declarations are going to be enough to satisfy what on the Israeli side want to achieve, which is to fully restore security on their northern border. And at this point, it doesn't appear as though those ceasefire discussions are going anywhere as it pertains to Lebanon and Israel. And for the time being, the ground incursion continues, so do airstrikes, and then rockets also being fired from southern Lebanon into northern Israel.
Jomana, thank you so much. That is Bloomberg Horizon's Middle East and Africa anchor, Jomana Bercecci. In the meantime, oil continues to move higher this morning, up by 1.5%, off of the highest that it's been this week, but NYMEX crude around $74 a barrel. Okay, coming up, we're going to take a look at today's CPI. Coming in about 3 hours' time, we're going to catch up with Citi's Andrew Hollenhorst. All that to come on your Bloomberg Brief.
2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, you know, with lots of supporters, a really mind-blowing level of innovation against emissions. And, you know, in the last 9 years, that's gone better than I would have expected. So only now could you even, you know, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. You know, in the meantime, some people who care about this issue are really out, you know, trying to think, do we need permitting reform? You know, do we find, what new ideas haven't we found yet? You know, how do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Rain World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Manis is on a well-deserved break. Let's set your agenda. It is the 44th record high. Stocks, though, taking a breather ahead of the start of third quarter earnings. The bar for pausing is the countdown to CPI with an FOMC that says it is in no hurry. And Hurricane Milton sweeps through Florida, making landfall, leaving 3 million homes and businesses without power. As we survey the potential devastation from Hurricane Milton, we go now to these markets. S&P 500, NASDAQ 100, and Russell 2000 futures all moving lower this morning. Russell 2000 losing the most with yields pricing higher yesterday after plenty of FOMC speak. Speaking of which, yields this morning, for the most part, they are calm. We're above 4%. 4-year, 10-year yield, the highest level since July. The front end coming back down slightly this morning, but still above 4%. The dollar, for what it's worth, is ever so slightly weaker this morning, but it is on its stronger for 8 sessions. That is the longest winning streak since 2022. Let's get back to our top story, though, this morning. It is Hurricane Milton moving off the coast of eastern Florida and into the Atlantic. Milton came ashore as a Category 3 hurricane, knocking out power for millions. President Biden spoke before it made landfall.
We've already directed the Department of Defense to be ready to provide active duty service members to support Florida after the storm surge if Governor DeSantis requests the help, which I expect he might, just like we did North Carolina.
Joining us now is Bloomberg's Brian Wingfield. Brian, what do we know at this moment in terms of just how much damage there has been as the hurricane made landfall?
Hi, Danny. Well, Floridians are now just waking up to assess the damage. The storm center has moved off the coast of eastern Florida, but it's still a Category 1 hurricane with winds of about 85 miles per hour, and that's still pretty severe. It came ashore, as you said, last night as a Category 3 storm. We've got a lot of flooding damage, a lot of rain, maybe even more rain possibly than initially anticipated, and more than 3 million people are without power in Florida right now.
And then it's not the only risk. It's not like the risk is over. It is still concerns of storm surges, of a flooding. Going forward, Brian, what are we going to be looking out for in terms of what poses that biggest threat for Floridians?
That's right. So when this storm was approaching, everyone was concerned about the storm surge because, you know, Florida is relatively flat, and if the sea comes up onto the coast, that can really swamp coastal areas pretty badly. So we're going to want to assess what has happened in that regard and also see how much rainfall is causing flash flooding and things like that. Florida's an agricultural state, so we want to pay attention to what's going on there. And also, a lot of real estate is at risk on the Gulf Coast.
Brian, thank you very much. Yeah, those images there just really shocking, including the blowing off of the rooftop of the stadium, just showing you how strong some of these winds were. Brian Wingfield, thank you so much. Okay, as we assess the damage of that hurricane, we have some economic data to get through today. One of the other big stories, CPI, it's coming out later today, 8:30 a.m. New York time, so just in about 3 hours' time. San Francisco Fed President Mary Daly spoke on what she sees as the path forward for the rest of the year.
We are just where I believe we need to be at full employment, not growing too fast, not growing too slow. And I am now quite confident that inflation is on path to hit our 2% goal. I think that 2 more cuts this year or 1 more cut this year really spans the range of what is likely in my mind, given my projection for the economy. But it's really important to put caveats with that.
Meanwhile, Dallas Fed President Lori Logan also weighing in yesterday, saying a more gradual path back to a normal policy stance will likely be appropriate from here. I'm thrilled to say joining us now is Andrew Hollenhorst, Chief U.S. Economist at Citi. Andrew, thank you so much for joining this morning.
Thank you.
So you certainly have that, balanced gradualism. That seems to be the word from the FOMC. You still think there's a likelihood we get a 50 basis point cut in December. So where is the bar for 50 basis points? What needs to go right or maybe wrong for that to come?
It's really about what happens with the labor market from here. Now, we've seen a huge shift in markets where a couple weeks ago, before we had the recent jobs report, all of the focus had moved to the labor market. We'd seen this slowing in the labor market, and the focus had moved away from inflation. Now, with the stronger jobs numbers that we had out last Friday, I think the market is going to be looking at these inflation numbers. I don't think inflation is the story, though. I think fundamentally the labor market is still the story. Now, we're going to have a really cloudy, to use maybe an appropriate term, labor market report for the month of October. We have these hurricane effects. We have strike effects. That's going to make it hard to figure out where the signal is relative to the noise. So it may take a couple more jobs reports to really understand where this is going. Once we see that, we think we'll see more slowing in the labor market. That could get the Fed back to that 50 basis point cut. But absolutely, right now, this is a market that's going to be looking for, is it 25 basis points or is it going to be a pause at some point from the Fed?
Just to go back to the idea of the hurricane, the complicatedness of the data. Not only is it that's the data report they're going to have in their hands before the next meeting, but it's also going to be shortly after an election. What does that mean for the Fed's response to have a data that's a fog already in an atmosphere that is a fog?
Yeah, so I think you kind of go back to what Mary Daly said in those comments that we just heard, where she said the economy is kind of where they want it right now. So that's going into this cloudy period and this election. They kind of feel like they have inflation on the path to 2%, and they have the labor market exactly where they want it. If the economy is where you want it, you want to be moving to a neutral stance in terms of your policy rate. Now, there are big questions about where exactly that neutral level of policy rates is, but I think what we've also heard from Fed officials is that nearly every Fed official thinks it's significantly lower than where they are right now. So the direction of travel is still lower. I think the question is, how quickly do they want to move there?
So I don't want to harp on last Friday too much, but we kind of have to. So if they're still likely to go 50 at some point, if the labor market is still the top concern, how much of an anomaly was Friday then?
Yeah, so I mean, we have to talk about it, right? This was a potentially game-changing number if this is what's going on. Now, the issue with the number that we saw last Friday is we had the unemployment rate coming down. We had very strong payrolls. It looks broadly strong across the board. But that really stands in contrast to some of the other labor market data that we have. Earlier last week, we had the JOLTS report, and that has the hiring rate, that has the quit rate. Those are moving to some of the lowest levels that we've seen for the hiring rate in over a decade. We haven't seen hiring that low. So I think what we have to reconcile in the data now is, can we call it a strong labor market, or can we say the labor market is where we want it when we have hiring rates that are at a decade low? If that hiring rate starts coming back up, that would be the true soft landing. But that's not what we're seeing so far in the data. And that's why we think we'll see more weakness in the upcoming labor market data. But again, it's this issue of signal and noise. We had 2 weak jobs reports, 1 very strong jobs report. We need a couple more to figure out where we are.
So in this atmosphere of trying to figure out what is signal and what is noise, and the data being confusing, causing the market to swing back and forth, does it then put on increased importance to, for example, bank earnings to come this week to get a sense of where this economy is?
Yeah, I think that's something we're watching also. What's the corporate story here? We know that interest rates are coming down, and we were talking before about the Fed having moved policy rates to restrictive levels, the whole idea is to slow down the economy. The whole idea is to soften the labor market. So are rates coming down fast enough now to give an impetus to the economy, to cushion the economy? I think that may actually be a challenge, because if you look at 10-year Treasury yields, they've come down, but now they're back up again, right? We have mortgage rates that are going up again. So it's not that clear how you're going to turn around this slowing that we see in the labor market.
On the mortgage rate part, because yes, they have climbed higher. I just wonder what that does to the psyche, and again, the ability to continue to bring inflation down. If you have a situation where they cut 50 basis points and the net impact was mortgage rates higher and a tighter financial conditions.
Yeah, it's a really interesting scenario. We're watching what's going on in the housing market. We've seen a significant slowdown in the housing market. It looks like the housing sector is in contraction now. As interest rates come down, that should stimulate the housing sector, but we really haven't seen that demand pick up. And now, to your point, mortgage rates are higher again, so we could even get more slowing there.
Okay, so maybe not the greatest thing. I know CPI isn't, again, the main focus for you, but it is today. I know you have your core forecast is ever slightly so hotter than the consensus, 0.25%. Core is about to be 0.2. I just wonder how you get there, what that comes from.
Yeah, there are a few special factors that are leading to that stronger reading for CPI. And remember, we have core CPI and then we have core PCE, and the Fed tends to follow core PCE. We think that's going to be a little bit softer. That's what we saw last month. But remember, last month we printed 0.3% month-on-month core CPI, and it wasn't a big deal because everyone was focused on the labor market. I think today, if we print a stronger number, you will get some market reaction. Now, the November FOMC meeting, we're already pricing less than 25 basis points, pretty significantly less than 25 basis points, so a significant probability that they don't cut in November. You could see that pricing push further if we get a stronger CPI reading this morning. Now, do I think that that's fundamentally appropriate? No, I think they're going to cut 25 basis points. I think it's a pretty high bar for them not to, but that's just where the market is right now.
Is there a figure that could come in CPI that, I mean, it sounds like the bar is low to frighten the markets, but what would be the bar for CPI to change things for the Fed and maybe make you change your call from 50 basis points of cuts in December to 25?
Yeah, I think we need to see a couple stronger inflation readings. Remember, we've had 3 softer readings now. We have core PCE inflation on a 3-month moving average basis that is running below the 2% target. The one concerning factor actually is shelter inflation. That is what has stayed elevated. But we've heard from Chair Powell, we saw in the Fed minutes that Fed officials are ready to look through this stronger shelter inflation. They're saying rents are coming in slower now. As long as those rent increases are slower, they're confident that shelter inflation is going to come down. So I think we really need to see a couple months of upside surprises, and not just in headline, not just the fact that oil prices are higher, gasoline prices are higher, but that you're seeing that in the core, you're seeing that in the super core, and services excluding shelter.
Just in you saying we need a couple months of more data, it feels like, it's a world awash in data and it's been more confusing than ever. Yeah. And you keep getting these swings and narratives that are really driven by the data. What is your confidence that we won't continue to get those swings and that some clear pattern will emerge and we won't have kind of these one-offs that can shake things up?
Especially with these weather disruptions, I think we realistically are waiting a couple months before we have clarity on this. And that is typical when the economy is slowing down because you will have mixed data. You'll have weaker jobs reports, and then you'll have stronger jobs reports. And the market is going to swing wildly from recession concern to reacceleration concern, which is kind of where things are now. So I think we are in that environment, and it will take convincing evidence, which is a few more months of data.
Yeah, I mean, it's crazy, again, that narrative swing happens like literally in a couple days now.
Yeah.
Andrew, thank you so much for joining us. Again, CPI is coming 8:30 a.m. Eastern. That is Andrew Hollenhorst of Citi. You're watching Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon, in Sudan, and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the parties. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's your Bloomberg Brief. Danny Berger here in New York. So we are less than a month away somehow from the U.S. election. I have no idea where the time has gone, but in this week's election brief, we're going to be looking at sectors that will have the biggest impact under a Harris or a Trump presidency. We are joined now by Nathan Dean, Senior Government Analyst of Bloomberg Intelligence. Nathan, thanks so much for joining this morning. Look, it probably makes the most sense to start with tech, because a lot has happened over the past few days. Mark Cuban, the surrogate basically for Harris, saying that Lina Khan should be gone from the FTC. The Democratic Congresswoman from New York, Alexandria Ocasio-Cortez, tweeted this yesterday: anyone who goes near Lina Khan and there will be an out-and-out brawl, and that she is a promise. She proves this administration is fighting for the working people. It would be terrible leadership to remove her. Nathan, as we understand the path for technology forward, you've done a really great job of basically running screens, what companies will and will not be impacted. How are we thinking about big tech as we head into the election?
So I think the current viewpoint is that no matter what happens in the election, at least for a short term, you're going to get status quo in terms of antitrust scrutiny and this heightened awareness of what's going on in the tech industry. Now, to Lina Khan's point, or Representative Ocasio-Cortez's point, we think that if Vice President Harris wins, Lina Khan probably will stick around for a while at the FTC. The reason being is that more than likely than not, or at least what the polls are suggesting, is the Republicans are going to take the Senate. And if it's the case, they're going to be able to jam up a lot of her appointees. And, at that point, if I'm Vice President Harris, why would I not want to spend, let's just keep Lina Khan where she is. So we think that type of scrutiny is going to continue. The big question mark, though, is if President Trump wins, because Senator Vance, the vice president candidate, came to the Bloomberg office a few months ago and called Lina Khan the best thing that Biden has ever done, and even insinuated that President Trump should keep her on. Now, I don't think that's going to happen, but if this idea of economic populism gets into the White House, you could see a tech industry that has the same level of scrutiny, when a lot of folks out there, I think, are presuming that you may get a big business-friendly type Republican president. We just don't know. But what we are telling our clients is that, these court cases are going to continue. Probably if President Trump wins as well, you don't think you're going to see a dramatic change, but you need to be prepared for this tough scrutiny of the tech sector to remain for at least 4 more years, because it looks like it could happen.
Well, it's not even just tech that J.D. Vance had been aligned with Democrats on. I mean, he partnered with Elizabeth Warren on legislation around banks, trying to trumpet not just small tech, but small tech too. How should we understand the future for financials then, Nathan?
Yeah, so it's really coming down to this rule called the Basel III Endgame. Now, this is a proposal from the Fed, the OCC, the FDIC, which, as currently outlined, would increase capital requirements around 9% for the Bank of America, JP Morgan's, the big banks. The small regionals, you're looking around a 3 to 4% increase. Now, if Vice President Harris wins, this rule can continue. We think a reproposal is likely, probably next year. You're looking at finalization in 2027 or so forth like that, maybe the tail end of 2026. But if President Trump wins, this rule is probably indefinitely delayed. And the reason why this is important is because the Americans are the last piece of the puzzle to this. Europe has already implemented this via the Basel IV Accords, and the United Kingdom in particular has delayed implementation while the American regulators try and figure out what's going on. So if President Trump wins, those American banks probably won't get hit with that 9% capital increase, but you could see a race to the bottom across the globe as the global Basel framework, at least the last remaining piece of it, begins to unravel. So certainly interesting things to play, and this is one of the bigger catalysts of the election. Will it happen or will it not?
Nathan, if we could just round it out with the Inflation Reduction Act and what renewables will be doing. This is one of those sort of clean plays that people like to talk about in terms of the difference between Harris and Trump. What are you telling clients to watch out for in that sector?
Yeah, so this is going to happen in probably the tail end of 2025, and it's going to come as part of the tax reform debate we see here in the United States. If you remember, the Trump-era tax cuts for individuals expires at the end of 2025, and both Vice President Harris and President Trump do not want to see that increase for most of Americans. And the reason why the Inflation Reduction Act is here is because it's going to cost Congress somewhere between $3 to $4 trillion to extend those tax, that tax relief. And the Inflation Reduction Act could be a place for Republicans to go after in terms of cutting, tweaking, or help paying for it. Now, our base case scenario is because of a lot of the CapEx that's coming into the United States, into the renewable industries, so for companies like First Solar, combined with the fact that a lot of politicians at the state level in states like Alabama, Georgia, and Louisiana are liking these plants coming in and being built, we think the IRA is somewhat cemented, even if President Trump were to win. But you're certainly going to see a lot of headline risk, and maybe about the emissions or EV standards and so forth like that. You're certainly going to see a lot of headline risk as people just ask the question, can we cut the IRA to help pay for this tax reform? Ultimately, we don't think it's going to happen, but certainly something we have to pay attention to.
Nathan, we really appreciate it. Nathan Dean, Senior Analyst for Government and U.S. Policy at Bloomberg Intelligence. Really recommend looking at his work on the Bloomberg. Okay, in other election news, former President Trump is addressing Americans living abroad. He has a new tax proposal. The Republican nominee writing in a statement, quote, "I support ending the double taxation of Americans overseas. Currently, expats must file taxes to the IRS when they where they live in the country. Of course, that would require congressional approval for something like that to be passed." Okay, it is the start of earnings season. Delta will be reporting this morning. Investors will be watching where demand stands. Of course, there was that CrowdStrike glitch in July that led to thousands of canceled flights over the 5 days. Whether that's having any impact, let's get straight to Benedict Campbell, who leads our global coverage of the aviation industry. Benny, just set out the expectations for us for Delta this quarter.
Yeah, you really set it out there already. We have a tale of two stories here, of two sides. We have the positive development in terms of pricing, in terms of demand, and that's something that will feed through to the numbers. So the environment is actually looking pretty good for the aviation industry at large, and for Delta in particular. The fuel prices are relatively low right now. That's helping them. The load factor, so how many people are on a plane, that's edging up to about 90%. So all of those metrics are actually looking pretty good. But then on the other side, and you mentioned it there, we have the CrowdStrike debacle that happened in July, and that hit Delta harder than the competition. And those are the two sides that will be featured in the report today, and people will see how much of a surprise might the CrowdStrike incident still have. Most of the numbers seem to be factored in, but there might be some lingering issues there.
Benny, what are we expecting in terms of demand? Last quarter, I think many had been caught off guard with some of these airlines, despite it being the strong, booming summer travel season, reporting some demand that didn't quite live up to expectations. Is it going to be the same this quarter? Have things sort of cleared out? Is demand doing okay?
It feels that it's a little stronger now. There was the whole debate about, are we at an end of revenge travel? Is this slowing down? And it was across the board. It wasn't just airlines. It was also theme parks. It was hotels. It was long-distance travel in particular. A lot of it depends on sort of the state of the economy. Did people feel confident to put those savings and that extra money towards that trip that is usually fairly expensive? But for the time being, it does look as if things have held up fairly well across the industry. Delta is typically the first airline to report ahead of its peers, so they're a bit of a bellwether. So there's a read both for the industry, the aviation industry, but also more broadly for the economy. That will be interesting to watch.
Benny, we really appreciate it. That is Bloomberg's Benedict Campbell. Again, Delta earnings coming today. Coming up on this show, though, more economic data, more Fed speak. We're going to set you up for your trading day on this Thursday. You're watching Bloomberg Brief. Stay with us.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day on this Thursday. CPI, the main event coming in about 2.5 hours, 8:30 a.m. Eastern. We'll also get the latest jobless claims numbers alongside them, plus a whole lot more Fed speak. We're going to hear from Lisa Cook, Tom Barkin, and John Williams. And then Tesla will be unveiling its much-awaited robo-taxi, 7 p.m. in California, 10 p.m. in New York is the timing of that event. Speaking of which, let's look at some stocks on the move. Tesla, it is the moment of truth for them. They're up 1.33% this morning. They're getting a boost ahead of that robo-taxi event. Pfizer to the downside, down more than 1.5%. Former executives decided not to be involved in Starboard Value's activist campaign. They've taken a stake against the drug company. CVS, meanwhile, Barclays has upgraded the stock up 1 1/3. They are putting it as an overweight, $82 price target, citing margins and cost. All right, that is it for your Bloomberg Brief this morning. Stay tuned for surveillance and CPI numbers coming at 8:30 a.m. Eastern.
want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating. And then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Presuming that the inflation data comes in relatively in line, right? But there's a pretty clear path for the Fed to cut.
You're seeing inflation moving closer to the target. In that environment, you have to be closer to neutral.
They can continue a sequence of rate cuts, and they have a lot of room to cut interest rates here.
Inflation is really looking like it's getting back under control, that kind of the battle against inflation has been won.
The inflation question is back on the table.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
We're live from Tampa later this hour as Hurricane Milton batters the state of Florida. The latest headlines just moments away. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg surveillance starts right now with equity futures pulling back just a little bit on the S&P 500. We're negative by 0.1%. Coming into CPI Thursday after posting a 44th all-time high of the year on the S&P 500. On the NASDAQ 100, we're down 0.1%. In the bond market, 2-year, 10-year, 30-year, 4 handles across the board on a 10-year, approaching 4.1%. Yields up across the board in yesterday's session, going into CPI, Bramo, later this morning.
Which raises the question to me, how much is this market poised for a rally if CPI comes in lighter than expected? If there is a downside surprise and inflation is no longer on the table, have we basically priced out some of the euphoria around excessive rate cuts and then opened up the door to a reigniting of all of that all again because this is the year of cycles?
The risk to the markets definitely seems like CPI coming on the upside. Remember, before that blowout jobs report, everyone was saying, ignore CPI Thursday. You don't have to care about it. This is a single mandated Fed. Mohamed El-Arian comes on and said inflation is not dead. He says that blowout U.S. jobs report is yet another good reason for the Fed to maintain their dual mandate approach.
Had a ton of Fed speak in the last 24 hours, a sprinkle of Fed minutes as well. Some participants observed that they would have preferred a 25 basis point reduction at the last meeting. Was this a Chairman Powell 50 basis point cut or what?
Well, it seems like he definitely jammed this through. There was a little bit more dissent than maybe it seemed on the surface, with just one official dissent. That said, my takeaway from this was catch-up. This was basically, we should have gone in July, we kind of messed up, we're going to bake this in, but don't expect anything more. I was just going through some of the Fed speak. Not only did Mary Daly say that she only expects 1 or 2 more 25 basis point rate cuts for the remainder of this year, but even Neil Kashkari in the past few weeks has said, as we go forward, I expect on balance we will probably take smaller steps unless the data changes materially. Even him.
Next stop for this debate, 8:30 Eastern Time, CPI in America, inflation just around the corner. Coming up this hour, here's the lineup for you. Coming up, we'll catch up with Bill Waddle of AccuWeather as Hurricane Milton strikes Florida, Brian Levitt of Invesco as stocks hit fresh record highs ahead of CPI, and Tom Naran of RBC ahead of Tesla's robotaxi event. We begin this hour with Hurricane Milton moving across central Florida after making landfall near Tampa as a Category 3 storm. storm. The state facing winds of 85 miles per hour, with flash flood emergencies in effect in nearly 3 million homes and businesses without electricity. Bill Waddle of AccuWeather joins us now from Sarasota, Florida. Bill, welcome to the program, sir. Just walk us through the latest developments and what you're seeing play out overnight and through this morning.
Good morning to you. Yeah, tough night here in Sarasota, Florida. It is dark because the power is out except for emergency generators. We had roughly 3 feet or more of storm surge in these streets. Some places we know it was higher. We're talking about a lot of water damage that has made it into businesses here in downtown Sarasota. Right here, you're looking at an air conditioner unit that used to be on top of one of these high-rise buildings. So in those overnight hours, the storm surge waters did recede, but I could tell you some dangerous situations. We saw drivers caught out in the middle of it. They let their guard down in the eye of the storm. They had floodwaters to their SUV up to the headlights, even going over the hood at points.
Bill, can you just give us a sense of where the storm is, how much damage has already been incurred, what we know and what we don't know as we track the progress of the storm and its aftermath?
Absolutely. We're going to have a lot more information in the next few hours once the sun comes up. We're dealing with emergency responders going around, a lot of debris in the road, so we can't really get a full assessment of the damage just yet. Again, as Milton continues to push inland across Florida, we're seeing more of those storm surge impacts, obviously, central Florida, now the east coast of Florida. I can tell you this has been a tremendously costly 2 weeks here in the United States. AccuWeather experts are estimating that the total damage and economic loss from Hurricane Helene in the United States, remember, less than 2 weeks ago, $225 to $250 billion in total damage and economic loss from Helene. Now our experts are in the middle of that process. We're doing a rapid analysis. We should have more information in the next 24 to 48 hours on the economic impacts from Milton, but our crew at the AccuWeather Global Weather Center telling us Hurricane Milton going to be most likely another $200 billion storm when it comes to the total damage and economic loss.
Bill, we heard from Governor DeSantis last night, and he said that this is the largest mobilization of the National Guard in the history of the state of Florida. What else can you tell us about the state and federal response when it comes to the recovery effort?
Absolutely. We can tell you Florida typically handles hurricanes pretty well. Those utility crews, those first responders, everyone jumps in to help. They are well trained. They're used to hurricanes in Florida. I got to tell you, these past 2 years, this has been a difficult situation in the United States. We have overlapping weather disasters. We've been on the road for more than 2 weeks straight now. We just came to this area last week. We were in the mountains of North Carolina where we saw all of those utility crews, federal responders, state responders, and of course all the nonprofit groups trying to help. So what's happening right now is an ongoing weather disaster up in the mountains of western North Carolina from Helene. So many resources there trying to help families that were completely cut off, so many businesses impacted. Some of those resources stayed in the Carolinas, but we know others, they deployed here to Florida to pre-position. But again, we're dealing with 2 weather disasters in the U.S. in the span of 2 weeks.
The 1-2 punch we all feared. Bill, appreciate the update, sir. Stay safe. Bill Waddle there of AccuWeather on the latest. Brian Levitt of Invesco joins us around the table here in New York. Brian, good morning to you.
Good morning.
We're looking ahead to economic data this morning at 8:30 Eastern time. We're looking back at payrolls from last Friday, blowout payrolls report, and we're attempting to look ahead to more of the same. I just wonder how messy the data is going to be after the 1-2 punch we've seen across several states in America, Hurricane Helene onto Hurricane Milton.
Yeah, some of the data may be messy, but I think the larger themes are still in place. And I know that there's a lot of focus on today's CPI report. The reality is I continue to believe that the inflation story is largely behind us. It's passé. If you look at the Fed's preferred measure of inflation, very much in the comfort zone. If you look at the inflation break-evens, which give you the bond market's expectation of inflation, relatively benign. I mean, the inflation story was one of large stimulus and a pandemic that caused supply challenges. I don't think it's something that is re-emerging. Rather, it's a market that's responded to some good economic activity.
And it's responded as follows: a 2-year back at 4%, a 10-year back at 4%. How are you thinking about the influence of the bond market on the equity market at the moment?
I'm okay with that. I would rather see better economic data and less rate cuts than bad economic data and a lot of rate cuts. You know, the bond market's been moving in this 3.5% to 4.5% range, give or take this year, depending on the direction of the data. Now, if you think of 4%, is a general proxy for what nominal growth will be in this country, 2% real, 2% inflation. So that seems like a reasonable value. As things deteriorate in growth, you come down a little bit. So I think we're probably at the upper end of that range again. Yeah, we had a good payroll report, but if you look at survey data, it's somewhat mixed and doesn't seem like an economy heading into a recession, but doesn't seem like one that's reaccelerating either.
Which raises the question, did the sell-off in the bond market that we've seen over the past few weeks actually raise the specter of a pretty big rally if you get a downside surprise in CPI? In other words, does inflation start to matter a whole lot more again?
Maybe in the short term. But I would say in the long term or in the intermediate term, it's going to be more about growth. And one of the ways to think about it is just look at the correlations between stocks and bonds, which have, become negatively correlated again. So it's become a good news is good news, bad news is bad news type of environment. And so I'm focused on the growth side of this story. When I see a good payroll report or a CPI report that's even a little bit above of what the expectation is. To me, I'm thinking that's a good nominal growth backdrop. That's good for corporate profitability. It doesn't increase concerns to me significantly that this Fed can't ease or the Fed may have to raise rates again or inflation's coming back. Again, I think that's a 2022 story.
So you like treasuries here in terms of where they're at and the value that they're giving. That's what I'm getting from you. We just heard Bill Waddell talk about a potential $450 billion in recovery funds needed to pay for what's going on in Florida. This isn't going to be the last. A lot of people saying these storms coming a lot more frequently. And aside from just the storms and paying for all of this, it raises the question of how much more spending needs to happen and whether that spending can really be tolerated by a treasury market where the auctions are starting to get messier.
Well, they may be getting a little bit messier, but we haven't seen the Treasury break from nominal growth potential. I mean, people view Treasuries as perhaps trading like a credit. They don't. The Treasury market largely trades on the direction of the economy and what the Federal Reserve is going to do. So I'm not concerned that additional spending will cause rates to jump because we're concerned about the creditworthiness of the U.S. It's a rate that's going to continue to move in line with inflation and with growth. And, it's sort of like every time rates come down, you say to investors, well, you've been sitting in money markets, you should have locked in. This is like the third or fourth bite at the apple they've gotten. People used to beg me for 4%, right? And now this is the third or fourth time they've had the opportunity to take advantage of that beyond 30 days, maybe think about it for 5 years or 10 years. So I think investors should take advantage of it.
Hurricanes are not just going to be expensive, but the fact is they can also increase fuel costs. We are seeing this risk in the oil market, not just domestically, but also internationally, what's going on in the Middle East. What kind of impact do you see from the price of oil, not just on inflation data, but potentially also its relationship with the bond market?
Well, we know energy prices tend to rise late cycle, right? So that's a phenomenon where you get these moves in energy prices, and that's when the consumer rolls over. But let's think of the starting point. So the starting point is the U.S. is producing or is drilling more oil right now than any country in the history of the world ever, right? Some 13 million barrels per day or more. And we started this environment, or we've, the expansion of the Middle East war into Lebanon, Israel, and Iran, and these hurricanes with oil in the 60s in the United States. So we've moved up into the mid-70s, but certainly not the $120 that we were looking at when ahead of the global financial crisis. I drive around my neighborhood, gasoline's, $2.75, $2.80. So we're not at a level that's, prohibitive. In fact, that's part of the soft landing story. Consumer net worth at an all-time high, gasoline below 3. But yes, if this were to skyrocket significantly, I don't think that's an inflation story. That's a tax on the U.S. consumer story. But U.S. drilling hopefully prevents that.
So what's your biggest risk then to the soft landing scenario?
The biggest risk would be a rollover in economic activity. I mean, we've had interest rates high for a very long period of time. And, usually when the yield curve inverts, you wait 18 months for the Fed to have to normalize the yield curve and you go into a recession. And this time, that has not happened. The bankers were tightening lending standards. Now they're not. Corporate bond spreads are very benign. So it doesn't feel like a recession, largely because most American households have fixed rate mortgages. So the increase in rates hasn't hit. Now, those are famous last words, right? Anytime you're 2 years after a tightening cycle, you're saying no recession, you say, well, I guess we got through this. So that would be the risk. I'm laser focused on the growth side, not on the inflation side. But right now, the evidence suggests it's an economy that's pretty resilient.
Let's finish on earnings. Important 24 hours. Delta, JP Morgan, Wells Fargo, Bank of America, Savita Subramaniam. The bar isn't high. Do you agree?
Yeah, the bar isn't high. It's, the expectations are fairly low. We're likely to surpass expectations on earnings as we tend to do. And again, it's a good nominal growth backdrop. Investors sitting here looking at the equity market saying all-time highs on the equity market, can I invest? We've had, 1,200 all-time highs since the S&P 500 went live. And, people say buy low, sell high. I say buy high, sell higher. And I think we're in a, or maybe never sell. I think we're in a bull market, and peak inflation, peak tightening, peak rates should be good for equities.
He's still bullish. It's Brian Levitt of Invesco. Brian, it's good to see you.
Good to see you.
Thank you, sir. Equity futures on the S&P 500, just a little bit softer on the S&P this morning. We're down 0.1%. Let's give an update on stories elsewhere with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Hurricane Milton is moving across central Florida after making landfall near Tampa last night. The storm is packing powerful winds. Flash flooding emergencies are in effect. Milton reportedly knocked out power for more than 3 million homes and businesses in Florida. It also shredded the roof of Tropicana Field in St. Petersburg, the home of MLB's Tampa Bay Rays. Apple TV Plus is coming to Amazon. The iPhone maker will begin selling subscriptions through Prime later this month, offering access to hit shows like Ted Lasso and Slow Horses on Amazon for the first time. Apple adds to the more than 100 streaming services offered on Amazon's channel store. And Ratan Tata, the former head of Tata Group, who transformed it into a global empire, has died at age 86. He was the chairman for more than 2 decades, starting in 1991. Tata rapidly expanded through major acquisitions that included Jaguar Land Rover and steelmaker Chorus Group. Tata had no children and no heir apparent to lead Tata Trust, which controls the conglomerate through its holding of Tata Sons. And that's your brief. John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, a promise to rescue and rebuild.
We've got your back. We've got your back. And Kamala and I will be there for as long as it takes to rescue, recover, and rebuild.
We'll get the latest down in Florida. Up next on the program, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
equities a little bit softer here. We're down 0.1% on the S&P 500. Check out the bond market going into CPI a little bit later on this morning. That data drops at 8:30 Eastern time. Bramo, a 10-year yield, a 2-year yield with a 4 handle. That move sticks.
A lot of people wondering whether this is just retracing some of the euphoria, a beginning of something else, and how worried people are about inflation. Is this really still a one-mandate Federal Reserve? It seems like the expectation is yes. How high is the bar to say, maybe not so much?
Never mind a one-mandate Federal Reserve. It might be a one-man Federal Reserve, based on some of the Fed minutes we've had. More on that a little bit later.
Well done.
Under surveillance this morning, a promise to rescue and rebuild.
We have 20 million meals, 40 million liters of water. At my direction, the Secretary of Defense, Austin, has pre-positioned search and rescue teams, helicopters, and high water speed vehicles as close to the storm as possible so they're ready to conduct life-saving missions. We've got your back. We've got your back. And Kamala and I will be there for as long as it takes to rescue, recover, and rebuild.
So here's the latest this morning. The president assuring Floridians of an unprecedented number of assets ready to help with Hurricane Milton's destruction. The White House also criticizing misinformation about the federal response to back-to-back hurricanes in the state. Bloomberg's David Gura joins us now for more. David, good morning. It's good to see you. Is the state of Florida getting everything it needs this morning?
You know, I think we're going to see, as the sun rises and we assess the damage there, what it needs, and indeed, is it going to get that from the state and the federal government? But we've had assurances across the board from the administration and from state leadership that they are going to. But this is a very tricky situation, suffice to say, just having these two storms back to back. Having the drain on resources from the federal government and the state government is going to be a real test, I think, for both institutions.
Biden seemed very agitated yesterday and a lot of misinformation. At the same time, though, you do have the running mate of Donald Trump, J.D. Vance, putting this opinion piece out in the Wall Street Journal, basically saying that Harris and Biden are treating the situation like a public relations problem, not like a real problem. Is there any truth to any of that?
I look at these things in complements. So you say misinformation. I think that's what we saw, a lot of disinformation as well. I mean, these allegations that FEMA is out of money or that people in North Carolina are only going to get $750, that's the maximum. These are kind of deliberate lies on the part of a lot of lawmakers and politicians. That op-ed by J.D. Vance, I think, is pretty extraordinary in that it shows this real disconnect between what we're hearing from Republicans on the ground in North Carolina and Florida as well, that in fact the relationship between them and the federal government is actually quite good, that they're in conversation with national leaders, they're getting what they want, they're getting assurances they're going to get what they need, and yet you have this criticism from J.D. Vance, the vice presidential running mate, and others. So I don't think that there's a whole lot of truth to it based on what I've heard from those who are actually on the ground, seeing all of this relief effort put into place, but I think it highlights the fact that this is happening in this really extraordinary crucible. Yes, there have been these two storms, but also we're just less than a month away from the election. It has become a political thing, even if historically it hasn't been, and I think a lot of right-minded people would say it shouldn't be.
So let's talk about the politics. Biden yesterday was asked on his way out at the press conference about, does Governor DeSantis need to take Vice President Kamala Harris's calls? Biden didn't say yes. He basically said Governor DeSantis is doing everything and we're in contact with each other. And then DeSantis went on a bunch of news networks last night and said the same exact thing. Is Biden undercutting his vice president?
I think that the vice president is in this very tricky, I say tricky a lot, but a very tricky position in that the administration is trying to present this unified front. Joe Biden is still the president of the country, and he should be the one who's leading this effort. At the same time, with this situation, in the Middle East, she's kind of tagging on to all of these things. So if there's a call with a world leader, she's there having either a separate call or being party to that call as well. I think that's what's happening here, and I think that the criticism that she's getting from Republicans is not an invalid one. Why wouldn't you just speak to the principal, the person who's in power, the incumbent president at this point in time? Why would you speak to the vice president as well?
I guess the other issue, though, if she didn't call Governor DeSantis,
Absolutely.
the Republicans would say, well, why isn't she getting on the phone with this individual who's supposed to lead this incredible effort?
And indeed, that was the criticism in the J.D. Vance piece as well, is that she was in California on a fundraising swing. All true. Is that something she should be criticized for if he is in contact with the president? I don't know.
All I can say is I share your frustration that this is political at all, because there are people on the ground who actually need help. And if they get it, that's great. And that's what people are looking for. I am wondering, though, not necessarily with the politics of the moment, but the logistics, less than a month out. These are swing state areas. These are the hardest hit areas. How do you get the infrastructure back up to actually ensure some sort of orderly voting system at a time where there is incredible focus on these states?
So both these states are working on it. Let's start with North Carolina, where you had the Board of Elections a few days ago putting into place changes in a number of these counties, more than 15 counties in the western part of the state where this is going to be an issue. So they're changing rules around being able to obtain an absentee ballot, where you might be able to turn that in, what the hours might be for that. we saw the legislature in North Carolina doubling down on that, making those codifying those changes yesterday. Then in Florida, we saw kind of similar flexibility put into place by the governor earlier in the week. We'll see if he does more. The real issue there is that registration closed on Monday of this week, and there's this push to reopen that in light of the fact that so many people had to evacuate, were they able to get their registration done. There's now legal action in the courts to kind of get him to change that, but so far he hasn't.
We were just hearing from Bill Waddell of AccuWeather that potentially this storm could cause something like $450 billion when put with the damages wreaked upon the area from Hurricane Helene. Is there enough money? And I ask this sincerely because maybe that FEMA hasn't run out of money, but there is a question of how do you pay for this at a time where insurers are on the hook for some of it? A lot of it's uninsured because people didn't think that it was necessary to get the insurance for their whole home flooding out in areas that were not in flooded zones.
I think that this is going to become an increasingly sobering story. And again, I think once the sun rises and we assess the extent of the damage, we're going to get a better sense of that. But what FEMA has said, what the White House has said is there is money at this point in time for FEMA to handle all of this, but will it be able to handle it in perpetuity? God forbid there's another storm, what would that mean? So I think it puts into stark relief what we've seen as kind of business as usual in Washington today, which is budgeting is broken. We had this stopgap funding bill passed that gave FEMA $20 billion for issues like this, but certainly not as much as FEMA asked for. There was a movement to get lawmakers to pass more additional legislation for more money. We'll see if that happens, but again, it kind of highlights the fact that planning is not done in any semblance of a long-term, medium to long-term way in Washington today, and that's a problem for this agency and for others.
Do you think Milton will be the impetus to get Congress back in session before the election?
I don't. I hate to be cynical like that. I'm not laughing at the circumstances.
What does it take to get off the campaign trail?
I know, and I think that, as we get closer to the election date, I think that becomes harder and harder to do. So again, I think there will be rhetoric about that. Where is Congress? Why aren't lawmakers doing more? But I think fundamentally at this moment, as we push ahead to election day, it's going to be very difficult to get them to do that.
Wouldn't they look better on the campaign trail to get back in session?
I have to go back to D.C. 3 million people are without power. People are underwater.
Do something.
We need to do something.
All I can say, as you said, what would it take to bring them back? I don't want to see it. If it was not this, I don't want to see what it would be to take to bring them back to their seats in D.C.
Yeah, well said. David, it's good to see you.
Good to see you as well.
Thanks for the update. Thank you. David Gurr there of Bloomberg. One thing we do know, America can afford to fix it. A little bit later on this afternoon, $22 billion of 30-year bonds coming to market. I know you looked at the 10-year auction just yesterday.
Yeah, the internal is just a little weak. I mean, it was okay. It wasn't terrible, but it really just highlights how there is this feeling at some point. So I was speaking with Jamie Dimon. It's the reason why I was in London and not here for 3 days. And one thing that he said is, in some ways, he's worried that the Treasury market is going to become like the commodity market in the way that people will look at supply and demand dynamics as much as some of the other things that Brian Levitt was talking about, like the state of the economy. Essentially, people are going to be worried about the glut of treasuries that needs to be soaked up at each of these auctions. And we see that fear, we hear that fear, not really being expressed in yields.
Tiffany Wilding of PIMCO yesterday gave a nod to it. In her most recent research, this line jumped down. High budget deficits will likely persist, limiting the potential for further fiscal stimulus and adding to economic risks.
I mean, this to me is one of the big fears. Is there going to be a catalyst that causes some sort of reckoning in the bond market? So far, I got to say, the sort of question about how many people are going to wring their hands and worry about the deficit, it hasn't come to fruition.
And we talked to Tiffany about some of the policy proposals that are on the campaign trail. She's like, to be honest, that's just so slim where the policy is. The CBO yesterday talked about where our budget deficit is right now, topped $1.8 trillion. Why? Interest payments and, of course, Social Security.
There are trillions and trillions of dollars of promises on this campaign trail at the moment. Coming up next on the program, we'll catch up with RBC's Tom Narayan on what to expect from Tesla's robo-taxi event later on tonight. From New York, this is Bloomberg.
dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Big 24 hours coming up for earnings. In the next hour, potentially the next few minutes, looking for numbers from Delta. Then on to tomorrow, we'll get numbers from JP Morgan and Wells Fargo. Into all of that, equity futures right now pulling back just a touch from all-time highs after posting the 44th record high of the year so far on the S&P 500 in yesterday's session. We're down 0.2% as well on the NASDAQ. On the Russell, the small caps off by around about 1/3%. In the bond market, 2-year, 10-year, 30-year, we had $39 billion of 10-year notes come to market yesterday. Bit softer than expected. The 10-year yield pushing higher, holding on to those levels this morning, 4.0785%. I said we'd get numbers potentially from Delta, and Lisa, we get those numbers from Delta right now.
They're seeing the fourth quarter adjusted earnings per share of about $1.60 to $1.85. Basically, in a range, the estimate was $1.78. When you take a look at passenger revenue, it's a little bit lighter than expected for the third quarter, $13.1 billion versus rounded up to 13.2. Nothing major. I want to look in here, though, to understand what the pricing of exact tickets are, what they expect for the pricing trends. Right now, their revenue for the third quarter, $14.6 billion versus the expectation of $14.65 billion. So basically a light miss. But what do they see going forward in terms of their pricing power is what people are going to be looking for right now. Investors not responding well to just even a slight miss for really one of the leaders in the airline sector.
The stock is just a little bit softer. We're down by a little more than 3% in the pre-market. We'll come back to that story a little bit later. Under surveillance this morning, Hurricane Milton moving off the coast of eastern Florida after bringing 85-mile-per-hour winds and heavy rain. The U.S. National Hurricane Center saying Tampa Bay could see a storm surge of as much as 5 feet of water, while Anna Maria Island could see 7 feet. The destruction, not just by the winds, but as we often say, by the water, is the one to watch now.
Absolutely. And this, obviously, Florida, the federal government have been planning for because they knew this was coming. They knew it was going to be bad. Right now, it's now moving off the eastern coast of Florida as a Category 1 storm, but the destruction is there. That photo of the Tampa Bay arena with the roof blowing off, this is supposed to be some of these infrastructure that's in place to withstand this. Absolutely devastating. And right now, more than 3 million customers in Florida are without power. So even if they want to call for help, it's going to be very challenging.
Did you guys see any of the simulations of what 5 feet of water would look like?
Yep.
What 13 feet of water would look like? And basically that it would just wipe out all the houses. You can't move back into a house that's been flooded like that without worrying about mold, without deterioration of the insides. Think about all the people who did not live on the coast, who did not buy flood insurance because why should they? It was going to cost them thousands of dollars a year, who now suddenly find themselves without a home. What happens to those people? And there are a lot of questions now, given the cost of the recovery. Who's going to pay for it, and how many people are going to go through with it?
And how insurable some of these areas actually are, which is a conversation we'll have in the next hour or so. Let me get you an update on the latest from President Donald Trump, the former president, making a new tax cut promise in the final stretch before Election Day, vowing to end U.S. income taxes on Americans living in other countries. The pledge would reduce paperwork and potentially the tax bills for roughly 9 million Americans. Now, only one of us around this table has had to deal with this, and deal with this every single year for a long, long time. AMH How big is this for people living abroad as Americans?
Well, off the bat, it's a huge headache to have to file in dual areas. But depending on how much you make and how much tax you pay where you live, you might be exempt from U.S. taxes. So the United Kingdom actually has very high taxes, so then I didn't have to pay double tax in the United States. But say you're living somewhere else. Say you're living in the Middle East, a place like Abu Dhabi, where you don't have to pay some of that tax. You have to pay some tax back to the U.S. So for those voters, this could be huge, but the 2020 election showed that roughly 1.2 million ballots were sent and more than 900,000 of those individuals returned. The DNC, before Trump came out and did this, we're looking at 1.6 million voters abroad from battleground states. So it matters what states they're sending those ballots back to. Arizona, Georgia, Michigan, Nevada, North Carolina, Pennsylvania, Wisconsin. That's a big chunk of people.
Okay, that's exactly what I was going to say. This shows how strong the battle is for just specific individuals. I mean, you think about at a cocktail party what someone's complaining about, yeah, I hate that I have to file taxes. Maybe I should renounce so I don't have to file taxes to the U.S. because I'm living in X country. And he's like, I hear you. I hear you. Just put your vote in for me because I just need a couple more for this state. It just shows how narrow this is and that basically there are going to be no taxes if you keep going with this.
Relatively speaking, and unlike the other promises, this isn't a really expensive one. This comes down to paperwork. It's the paperwork as an American abroad that is increasingly frustrating to do every single year when you have to file for American taxes as well.
It isn't, to be honest. The first 2 years, I didn't actually realize I had to do that. So then I had to go back, write this whole apology to the IRS. And I was like, oops, forgot about my paperwork. But I promise I paid taxes where I was living, and a lot of them. But what is the knock-on effect if this were true? Do people just start moving to the Bahamas? Does that become their primary residence and they count how many days a year they spend going in and out? Potentially.
The latest promise from the former president of the United States. Let's get you an update on the auto sector. BMW, Mercedes, the car sales from both of those companies slumping in China in the third quarter. Weak consumer sentiment driving down deliveries of BMW and Mini-branded cars by nearly 30%. Bramo, the steepest drop in 3 years.
All right, this comes after already pretty terrible news and them ratcheting down their forecast with the European sales alone. This raises a question. I forgot who we were speaking to who said, never let a good crisis go to waste. This raises a question, can they make some of the overhauls that they need to structurally be in a better position going forward, given the competition from China and given what they have in terms of the landscape in Europe? And that's what I think people are frustrated about. What is that sort of restructuring? We don't even know what that looks like at a time where competition is growing and tariff threats just seem to be mounting.
The future of the auto industry could be very, very different. Tesla unveiling its highly anticipated autonomous taxi prototypes later on tonight. Tom Narayan of RBC raising his price target on the stock to $236 and keeping an outperform rating, writing this. We think robotaxis could generate $1.7 trillion of revenues globally by 2040, and we'll see several players capturing market share, including fleet operators, app providers, car makers, and software developers. Tom joins us now for more. Tom, welcome back to the program, sir. Giant step back. Can we just spend some time from 35,000 feet? Can you explain to us how different this universe will look in 10, 15, 20 years' time?
Yeah, certainly. You know, today, the auto industry is about a $2.7 trillion industry. It's essentially a box with wheels industry with about 10% operating margins. The robotaxi industry will be about a $1.7 trillion industry, but massively more profitable, right? You and I, when we take an Uber, pay about $1 to $2 a mile. It only costs about 30 cents to operate one of these per mile. So it becomes a software business, a subscription-based business. And the multiples that these companies will trade at will be tech multiples. So I have Tesla at something like 250 billion out of the 1.7 trillion. But you apply a tech multiple to it, and now all of a sudden it's more than half of my entire Tesla valuation. So it dramatically increases the valuation of the mobility sector, the auto sector, because it gives all of us as consumers greater utility. We don't have to own a car, get chased by the cops, deal with parking, don't get into accidents. It's really a transformational thing for society. I'm sure we'll hear a lot about that tonight. It'll help solve the urban housing crisis, no more parking garages, etc. really a breakthrough type thing for society. The real question, obviously, is when is this going to happen?
Well, let's talk about that, Tom. How quickly do you think we'll see the shift from consumers just pulling away from buying a single automobile and maybe buying a subscription to one of these services?
Yeah, I think this will be a very slow process. This is not years. This could even be decades. It will happen, though. We had Carlos Tavares from Stellantis at our conference a couple of years ago, and he said, you'll have to re-engineer cities entirely. He pointed out the example of the Champs-Élysées, where it's really a human decision of how to drive. And so cities will have to re-engineer themselves. Regulatory will be the big question mark that will need, and that's always a slow process. It will happen, but it will be years, maybe decades before we get kind of full ubiquity. But certain cities, you'll see it happen quicker than others.
Tom, I want to pick up on that, this question of the sheer technology of it versus the regulation of it versus the oversight, especially at a time where the host of data that you're going to need to make this happen, as well as the oversight and the potential manipulation of people's driving patterns, is going to become in cold relief when everything is a national security issue. How high are the hurdles? Do you have a sense of who's even working on trying to get some sort of regulatory framework and oversight into how this would operate, let alone whether it even could?
Yeah, I mean, I was at CES a couple of years back, and there were congressmen from, U.S. States who were speaking about this topic. So there is a political movement to get this happening, even in the U.S. It is a state-by-state issue in the U.S. But remember, we're saving thousands of lives, hundreds of millions of dollars in productivity, et cetera. So there is a political motivation to get it done, but obviously you have questions about liability. Does the automaker get the liability? Does the person driving get the liability? So the U.S. is somewhat complicated. Europe, it's even more difficult to get this on the finishing line. You have the European Commission, which is a multiple countries, have to all agree together. We all know how difficult that is. China, however, is, I think, we're ground zero where this will happen. We're already seeing it happen. Obviously central government can actually make this happen. So we'll see it happen in China quicker. My numbers have China with a much bigger robotaxi number than Europe or the US. Then it'll gradually happen state by state, I think, in the US. And then finally, we do think it'll eventually happen in Europe.
Tom, the person who's leading the charge here is a politically polarizing human being, Elon Musk, and he's making himself more so. And I wonder whether that puts Tesla in a better position or a worse position when it comes to still being the leader of the whole robotaxi movement in the future.
Yeah, I mean, you guys probably know that. I can answer that question better than I can. But what I would say is I don't anticipate him doing something completely different than what we've seen already, at least near term, from robotaxi fleets from Cruise and from Waymo. I expect them to announce tonight a fleet service similar to that with their vehicle. Those programs already have approval, right, in the U.S. By those certain cities and states. I could see that being a similar path forward. But I do want to stress the technology that Tesla has with FSD is different. It is AI-based. We have it on the roads in level 2+ in people's cars. It is very different, and it is better, quite frankly, than what a lot of level 2+ on the road that we have. And there is an arms race for NVIDIA chips, and Tesla has quite a lot. So, over time, I think people will look at the kind of proof in the pudding and see, obviously, the data that will bear it out. We have to see the safety statistics and what happens. But, it's an arms race for GPUs. Tesla has a lot of them. FSD is a great product. There's a lot of people working in this company, not just one individual. I think we all have friends who work there who are very interesting and dynamic people. And it's a dynamic company. First and foremost.
Well, no one said Elon Musk wasn't dynamic, Tom. You're very optimistic when it comes to the long term. Can we really narrow this to the short term? This event is delayed by 2 months. How high is the bar for Elon Musk and Tesla this evening?
Sure. I've said that near term, I don't actually expect this to be a big catalyst for the stock. It had run into the event. We had a delivery number that was in line, and the stock still kind of sold off a bit. I think there was some folks who moved into Tesla because of all the carnage happening from the the German OEM's profit warning, never let a good crisis go to waste. I think I was the person who said that with you guys.
Thank you, Tom. Sorry. Credit.
Yeah, no worries. And so a lot of that happened, and basically, the stock pulled back. So it showed you that the stock ran into the event. So I don't anticipate a big up move, but I do expect that people like myself will finally get numbers on how to model robo-taxis. I also think they could talk about Optimus, because on the invitation, it said "we robot." So I do wonder if we could hear more about Optimus. It's definitely not in people's numbers. So it could be a catalyst more longer term as we start putting these things, these higher multiple non-auto things in our models. We'll remember this day of, in the future and look back, as opposed to tomorrow seeing the stock price, demonstrably higher or lower.
Tom, how strong do you think some of the hands in this stock are now, given that Elon Musk himself said, basically, if you don't believe in autonomous driving, don't hold this name? That was basically what he came out with in the last 12 months. How strong do you think the hands are in this name, given the rally we've seen off the April low?
Yeah, but I think people are starting to believe. If not starting to believe, they have been believing in the past several months. I mean, you can't get to a market cap close to whatever $800 billion just on a car business. It just doesn't work. The math isn't there. You have to believe it's a tech company. And autonomy is one of the only ways you can really get there. I mean, not even with energy storage, not with regulatory credits. Autonomy is a real software subscription-based business. People clearly giving credit for it based on where the stock is, right? So I actually think folks are believers in it. We just need details more than anything, and not just PowerPoint slides. So we'll see the vehicle, I think, tonight. We'll see what it looks like. I mean, that in of itself is not going to get folks excited, but I think it'll give credibility that this is real and then this is happening and could happen. We could have a service maybe within the next 6 to 12 months.
We hope. Been promised that for a long time. Tom Duran of RVC. Tom, thank you, sir. Appreciate the update. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A quick check on Delta shares after just reporting earnings, down 6% in the pre-market trade. They reported passenger revenue in the third quarter that came in lighter than expected. Delta's disappointing forecast for profit and sales do point to a slower recovery from a tough summer travel season marked by oversupply of flight capacity. CEO Ed Bastian saying that the demand going into the year end looks strong, but Delta is bracing for a slowdown around the election next month. Apple is losing a key executive. Sources telling us that Dan Riccio is retiring. Riccio, a veteran executive and a vice president of engineering, reported directly into CEO Tim Cook. He spent 26 years at Apple and oversaw some of the biggest bets of the company. That included the Vision Pro headset and the failed bid to make a car. And one of the greatest athletes in history is calling it a career. In a post on X, tennis legend Rafael Nadal announced that he will be retiring at the end of the season. The Spanish icon helped define the sport's most dominant era alongside his peers, Roger Federer and Novak Djokovic. Aptly named the King of Clay, Nadal won a record 14 French Open titles alongside 8 other Grand Slams and 5 U.S. Opens, as well as an Olympic gold. The 38-year-old was ranked world #1 for over 200 weeks, finishing 5 separate years as the world's top-ranked player. Nadal will play for Spain in his final match at the Davis Cup next month. And that's your brief, John.
Danny, thank you. Emotional morning for Rafa fans. I'm one of them. 22 slams. I think what we've witnessed is the greatest era in tennis ever. And I think it's fair to say, possibly even the greatest era forever. When you look at the guys that were in this, the grace of Roger Federer, the mental strength of Novak, and the competitive nature of Rafa Nadal. Rafa, for me, was #1. I know that he's #1 in slams. I know that's Novak, but for me, I think he always will be.
Grace and power. And it comes at a cost. I mean, when we feel old, when I feel old and like I'm falling apart, just think about what it is, what it does to your body to do that for 4 hours, 5 hours, the grace, the power. And so at 38 years old, all I can say is my hat's off to you.
It's one of those things that makes you feel old. Feels like only yesterday, the teenager on the clay of Roland Garros with a sleeveless shirt.
Yeah, the sleeveless.
Feels
Huge
like
muscles.
yesterday.
Yeah, although at the same time, it's nice to know that other people are human too. That's all I can say.
Just amazing. Congratulations, Rafa, for a phenomenal career. Up next on the program, the growing cost of hurricane season.
We're just seeing rapid intensification that we haven't seen before in history. Insurance markets are no longer able to provide affordable or available insurance due to these increasing impacts? I don't know if we have answers for that yet.
That conversation up next, live from New York City. You're watching Bloomberg TV.
The names that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war, the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China. All of that is in our interest, and whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe. And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries, present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
How high is the bar this earnings season? Doubts are out just moments ago. The midpoint of guidance. Missing estimates. The stock is down, Lisa, by 6%.
Because basically what they're talking about is that they're not immune to some of the price pressures going forward. They are trying to reduce supplies so that they don't have to deal with the glut of seats. But Delta was the top tier of all the airlines. They were supposed to be more immune to this than the others because of their high-end customer. They are not. And that's, I think, why the shares are being punished. They've already gained. They're also the first to report. So basically, they're ripping the Band-Aid off of what might be a pretty difficult reporting season.
Setting the tone for the industry this morning, that stock is down by 6%. Under surveillance this morning, the growing cost of hurricane season.
We're just seeing rapid intensification that we haven't seen before in history. Given the size and impact of what Milton looks to do, I would imagine there's going to be a lot of people redeployed across the nation to support the state of Florida. As the insurance markets are no longer able to provide affordable or available insurance due to these increasing impacts, we're seeing this transfer of risk to the taxpayer, and that's going to grow, and I don't know if we have answers for that yet.
So here's the latest. Hurricane Milton sweeping across central Florida with wind speeds topping 80 miles an hour. The storm leaving more than 3 million people without power. Matthew Palazzola of Bloomberg Intelligence writing, Hurricane Milton remains on track to generate insurance claims in the tens of billions, with economic losses a multiple of that amount. We expect a wider than typical gap between economic and insured losses similar to Hurricane Helene. Matthew joins us now for more. Matthew, welcome to the program. Just talk to me about that gap, the gap between economic and insured losses, and how much wider that gap's going to be in years to come.
I think it's going to get wider and wider for years to come. What you're seeing is home insurance companies, they don't cover storm surge and flood, and for good reason. And what you're seeing is that is an increasing peril in these things. Hurricane Helene, Hurricane Milton here as well. So the economic losses, they can also include things like business interruption, but those will be, typically it's like half. And I think in this case, it could be like 3x.
Given that, who's going to get stuck with the bill?
So the taxpayers are going to get stuck with a lot of the bill on the flooding. There's a federal program, the federal flood insurance program, and then the local market in Florida is subsidized by those taxpayers heavily. The biggest home insurer in Florida is the state.
Florida has 9 new insurance companies. Do these companies stay there after this?
So what had happened is this company that I'm talking about called Citizens, they made a big effort to depopulate. So they made a big effort to try to get private companies to take these policies. And it was kind of successful. I will say this storm, from an insured loss perspective, did avoid a worst case. So if we had that worst case where people are talking about $100 billion, then I feel like a lot of those companies may have left or gone bankrupt, but they're probably okay.
If a lot of the recovery will be funded by domestic and local taxpayers, will Florida, famous for their low taxes, have to raise taxes?
It's possible. I mean, I don't get into state government activity, but the insurer, Citizens, has the ability to assess insurance companies in the state. So they can, if they can't pay the claims, which they should have the claim paying capability to do this, but if they couldn't, they would assess the insurance companies, which means the insurance companies would then raise prices again. And obviously, the insurance in the state is incredibly unaffordable as is.
Hurricane Helene was a wake-up call for a lot of people who figured out that previously areas that thought they were untouchable can be touched and can be hit very hard by this. Do we need to rethink who's vulnerable and who isn't across this country now?
Yeah, I mean, the federal flood insurance program is revamping its pricing and its models, but a lot of those models were from the 1960s and 70s. So we've not understood the flood risk well. The National Flood Insurance Program had this pricing system where they updated it last year, and 70% of the people in the program saw their prices go up because the prices were so inadequate. Even said, the home insurance industry, even excluding these losses, doesn't make a ton of money. It's not a super attractive business regardless. So if you were to try to put that on top of it, it would make it an even less attractive, less positive ROE business.
Things have changed a lot. Matthew, appreciate the updates. Good to see you. Thank you. Matthew Palazzolo there of Bloomberg Intelligence. Up next on the program, the second hour of Bloomberg Surveillance looks a little something like this. We'll catch up with Dan Greenhouse of Solace Alternative Asset Management, the Florida CFO, Jimmy Patronis, Holly O'Neill of Bank of America, and Claudia Sam of New Century Advisors. As we count you down to CPI in America, that data drops at 8:30 Eastern Time. Equity futures going into that just a little bit softer. We're down 0.2%.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
First of all, global trade, which had adverse consequences that we're learning about to this day, still unleashed an enormous amount of gain for humanity. And with the rise of global trade became the rise of information sharing around the world, which rapidly accelerated the trajectory of mankind. I mean, of note, the Chinese, for example, are leaders in solar. They're leaders in EVs. They're leaders in a number of emerging technologies. In a world which is more splintered, we'll see the gains that the Chinese have achieved in these important areas not shared by the Western countries. And conversely, The United States is a clear leader in AI, along with a number of the European countries, and those gains will not be shared with China and the countries in its sphere of influence. So it's a very clear-cut loss for all of humanity when we have the severing of ties between our countries.
On a practical level, is it getting harder to manage the risks you face?
I think that one has to be aware that there are more tail risks that are harder to ultimately manage.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
There's a lot of potential earnings upside ahead.
I'm probably more inclined to be adding risk than reducing it.
There's an opportunity cost to being underweight risk assets more broadly.
Overall trend of the market is still quite good as well from a technical perspective.
These markets are priced for perfection, but that's because the backdrop is quite nearly perfect. The question is, can it last and where does it go from here?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
It is CPI Thursday, that economic data 90 minutes away. The scores going into it this morning. Good morning. Look like this. Equity futures on the S&P 500 down by 0.2% after posting the 44th all-time high of the year so far in 2024. In the bond market, we hold on to 4 on a 2-year, a 10-year, a 30-year. The front end of the curve yields higher by almost a basis point. 4.03% at 8:30 Eastern, Lisa. It's the main event.
Yeah, we've got CPI, and whether we get a feeling that inflation truly is decelerating quickly enough. You said something earlier that I thought was really important, which is the bond market hasn't proven to be a problem for this equity market. If the bond market was going to be a reason for worry, one of the many that we hear about from people that's not being actually implemented in any sort of selling, then it cannot be right now, given how much of a sell-off we've seen there and the fact that we just had the 44th record high with credit spreads on investment-grade bonds, the tightest going back to 2021.
I can't get over the fact that CPI is actually important today, given how everyone was really just writing it off before the blowout jobs report. Bloomberg Intelligence says they think core print will actually be more robust than consensus expectations, but seasonal factors for the remainder of the year make it difficult to sustain deflationary momentum. So what does it look like from here to the end of 2024?
Jobless claims one to watch as well at 8:30 Eastern, and then we can get our teeth into the earnings. Out of Wall Street, from JP Morgan and Wells Fargo tomorrow morning. That'll be Friday's story. Earlier on this morning, Delta coming in just a little bit softer than expected in the pre-market, Lisa. That stock is down more than 6%.
Yeah, and it shows that the bar, you were asking how high is the bar? Pretty high, because they basically were in line, just slightly below expectations in terms of their forecast, but still showing revenue growth, still expecting to see that revive after a sort of sluggish period, a real question about overcapacity, how much they were going to bring back so that they didn't have to discount seats so much. Marginally, they're getting there, and oh my God, sell, sell, sell. You know, is this just because they had actually done pretty well, or is it just that expectations are a lot higher than we might have otherwise thought?
You said it earlier this morning. First name out of the gate for the industry, setting the tone for the industry in a pre-market going into the opening bell. Setting the tone for the next 60 minutes, here's the lineup for you. Dan Greenhouse of Solace Alternative Asset Management ahead of CPI data. We'll speak to the Florida CFO, Jimmy Petronas, on the aftermath of Hurricane Milton, and Claudia Saar of New Century Advisors on why she says the US job market is in the twilight zone. We begin this hour with stocks holding steady after posting the 44th record high of the year so far. Dan Greenhouse of Solace Alternative Asset Management saying the stock market still looks good to me. Broadening gains are encouraging, and despite all the worries over everything, market cap and equal weighted indices are each essentially at highs. Dan joins us now for more. Dan, good morning.
Good morning, sir. How are you?
It's good to see you. Why do you always act surprised?
Because I'm not listening to start.
Thanks. You're listening now?
Now that my name has been called.
Live on TV. Good. It's good to see you.
Dan.
Look, equities at record highs. Credit spreads are incredibly tight. I think we should start in credit.
Sure.
When you look at credit right now, how tight are things at the moment?
Yeah, listen, they are, I think, depending on your index, you're effectively at all-time tights. I mean, that's not exactly true. If you use the JP Morgan index, for instance, their IG index is called 10 or so basis points away from all-time tights. The high-yield index is 90 basis points away from all-time tights. Bloomberg obviously has an index that's similarly close to all-time tights. But I don't think in that sense the credit market tells you anything that the equity market is not. We're obviously, as we've discussed and you discussed with other guests, pricing in, for lack of a better word, a soft landing or just a continuation of the expansion, and risk assets in general are appreciating in that type of environment.
Is it sufficient that they're even talking about interest rate cuts? Is that just good enough? The fact that we've got this backdrop for growth and we've got a central bank that's even having a conversation about lowering interest rates more?
Well, to state the obvious, we're not just having a conversation about it. We've already realized a 50 basis point reduction. We're probably going to realize 2 more 25 basis point reductions this year. There's obviously a debate about whether that's completely necessary or not, but from a expected value standpoint, that's probably should be your baseline. And so it's, again, we're not just discussing it, it's happening. And so the more important thing for risk assets is not whether rates are going up or down, it's what's the broader economic and earnings backdrop. And in that sense, yes, rates are coming down, and that's an added benefit, certainly for companies that have to refinance and the maturity wall in the credit market, et cetera. But ultimately what matters is that cash flows still look pretty good and the economy still looks pretty good. And so from that standpoint, why shouldn't risk assets appreciate?
There's a question about whether the bond market, treasury market in particular, is increasingly kind of dancing to its own music. As long as good data comes out, even if yields go higher, it doesn't really matter for risk assets. At what point is that sort of a threshold that gets crossed as yields continue to grind upward?
Well, I think it's also important for investors to remember that the relationship between yields in the treasury market and risk assets is a moving target. And in particular, in the post-2000 period, roughly, higher yields, which are associated with higher growth and not necessarily higher inflation, have been a positive for risk assets. They can move in tandem. And I think you had a period of time, obviously, where inflation was spiking, where that relationship was inverted. People were concerned about inflation, but as we've moved now towards growth concerns, right now I think higher yields are not necessarily a problem for the equity market in the sense that if they are corroborating the idea that the economy is continuing to grow, maybe the Fed, a lot of what's happened obviously is the Fed can't cut as much as was originally priced in, stupidly I might add, but in that environment, why wouldn't equities appreciate even if the yield in the 10-year goes from 3.50 to let's say 4?
So to pair that with credit, is Solace thinking that structurally credit spreads are going to be tighter this time around relative to the higher benchmark yield, simply because the higher yield reflects how good the momentum in the economy is, which should, all things being considered, make a lot of the companies who even are lower rated look more creditworthy?
Yeah, no, that's 100% accurate. I would also add, and we've discussed this in the past, this is not your mother's credit market. It's a more highly, I don't know that
my mother had a really, really impressive credit market.
But I mean, it is true that the market is more highly rated. You have a higher proportion of debt at the top of the high yield structure than at the bottom. Companies have higher cash and lower debt to EBITDA ratios, leverage ratios. So there's all sorts of reasons why the market should be, in a sustainable way, tighter than what we've seen historically. And in conjunction with that, you have, to your point, the better economic backdrop, which improves the environment. Defaults are relatively constrained. So all of that together makes for a more attractive credit market and should, over time, obviously if you have a recession, this changes, but over time should support higher valuations in the credit market as well as the equity market.
Given everything we've said, what's your advice to people who have missed out on all of this and they're sat in cash? What do they do? Stocks at all-time highs, credit spreads very tight. Where do they go?
This is like the Sasquatch. I don't think those people exist.
You don't think they exist?
No, I don't think they're...
I know some personally.
Tell us what you mean.
Well, Lisa might know one person who has sat in cash for some time.
I think it's Lisa for what it's worth, but carry on.
But I don't think
Move on.
I don't think after a bull market, so to speak, in both equity and credit that has lasted this long, has not sucked in most investors at this point. And I think you're at a point in the cycle now where I don't think we should be having the conversation, is it a bull market, is it about to end, et cetera, et cetera. I think the conversation now should be considerably more nuanced than has been for some time, in the sense that, okay, things are doing okay, risk assets continue to appreciate, where's the outperformance going to come from? Is it still tech stocks? Should I rotate into energy? Is it defensives? What factors should I be overweighting, et cetera, et cetera? Where in the capital structure should I be positioned? Triple C's have had a very good year. Obviously, that's not a market so much as a bunch of idiosyncratic names, but those are the types of discussions that asset managers have all the time. But I think for a lot of viewers out there are watching should be happening to a greater degree today.
When you say that money doesn't exist, you're not saying that money's not real. You're just saying that that's not the kind of capital that's going to get deployed to risk.
Which money did I say doesn't exist?
Money market funds.
Oh, the 6 trillion, yes.
Sure.
No, well, listen, listen, this is a favorite topic of mine. That 6 trillion exists, but I think people come on television and write notes and talk about it as if it's this monolithic item which is going to spur equities higher as the cash goes from 6 trillion to 2 trillion. That's not how it works. First of all, a portion of that money is institutional, a portion of that money is retail. Some of it's in tax advantage funds. It's not like they're all comparable to NVIDIA. But the most important point I would make, and I've made repeatedly, and I will do it until I die, that 6 trillion needs to be scaled for something because number go up. So you can't compare today's 6 trillion to 6 trillion 5 years ago. What do you compare it to? My preference is the S&P market cap. How much is on the sidelines compared to the market cap? So let's do the math real quick. There's 6 trillion or so of money in market, there's 6 trillion of cash or so in money markets. Let's treat it like it's a monolithic total. Equity market cap, the S&P 500 is called 50 trillion or so. So that's, I don't know, 10, 12, something percent of the equity market cap. That's not out of step with what we've seen over the last 10 or 15 years. Yes, there's a lot of money on the sideline, but as a share of buyable assets in the S&P 500, if that's your argument, it's not necessarily high. That's not to say that it will not come down. It will. At some point, 6 trillion will go to 5 trillion, and some of that will go into the equity market. But do I think that is a reason for me to be even more bullish or bullish at all? No, I don't think so.
I can tell you that was such a much better answer than the first one. What doesn't exist?
Well, all I can say is, I love this. We should come up with clips.
I must have had a Will Ferrell moment. Okay, I don't remember saying the 6 trillion doesn't exist.
This is sort of a theme this morning, Dan.
Okay.
Honestly, to me, this we should get clips of everyone saying money on the sidelines is a reason to buy, and then all the people saying money on the sidelines is a fiction. Stop it already.
Next time, I'm sorry, go.
Okay, I am curious. I do want to get to this because Solis really specializes in distressed investing. Right now, the world that you just pictured, no distress there. What do you guys do?
Well, listen, distressed managers have been wrestling with this for many, many years, and I don't think Solis is any different in that regard. That is to say that when you, the traditional distressed manager in previous cycles probably doesn't exist much today. Solis does as much investing up the capital structure these days as we do down the capital structure. So we're capable and have owned, not Visa, but like we could own Visa and we could own Dish unsecured bonds. And when you have an environment like we've had for some time where the Dish unsecured bond equivalent is few and far between, as has been the case these days, there's not so much workouts, there's not so many restructurings, you have to find risk-adjusted returns elsewhere. And we've done that increasingly in the equity market and up the capital structure. And I think that's been rewarding for us over the last few years. I think we're pretty pleased with our performance. The way that I talk about it is we're taking what the market gives us. We're not. There might have been a time where we were trying to force the issue and saying, distressed managers, multi-billion-dollar distressed managers, this is the only sandbox in which we can play. We've traditionally played in that sandbox, we must stay there. I don't think we have that view, and haven't for a decade. We're all over the capital structure, and I would argue justifiably so.
Are distressed hedge funds being made out of business by some of the big private capital funds that are out there doing a lot of rescue finance?
That doesn't help, but I think the bigger issue for distressed investors in general is there's just not been very much distress. The maturity wall, which everyone keeps talking about, hasn't been binding. Restructurings get done, and the lack of covenants in the loan market and elsewhere make it easier for companies to go longer before they enter court restructurings, and when they do, there's fewer assets to fight over, which gave birth to LMEs, with this whole separate conversation. But yeah, listen, again, I think we're finding stuff to do. We've talked about the energy market. Oil is $20 off its highs, but a lot of those stock names are basically at highs. We talked about the consumer ad nauseum on here. There's any different number of ways you could play the consumer. We've talked about cruise lines. We've talked about in the media space where Solus has a history. It's well known that we were a large holder of MGM Studios, so we have an expertise in that area. There's stuff to do there. I don't think there's any shortage of stuff to do, again, if you don't sit here and say that's the only sandbox in which we can play.
Dan, this was great. It's good to see you.
My pleasure as always, guys.
It was
Thank
real.
you.
It happened. Dan Greenhouse of Solus Alternative Asset Management.
I'm going to have to watch the tape.
Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Eli Lilly is ramping up its legal campaign against companies that were temporarily allowed to sell copycat versions of its blockbuster weight loss drug. Lilly is sending hundreds of cease and desist letters to telehealth companies, pharmacies, and medical spas, demanding that they stop selling their products. The FDA had deemed Lilly's drug in short supply about 2 years ago, allowing compounding pharmacies to mass-produce copies. When the FDA removed the shortage designation earlier this month, compounders lost that permission. The Wall Street Journal reporting this morning that TD Bank is facing penalties of around $3 billion and restrictions on its growth in a settlement with U.S. regulators. They found that the Canadian bank failed to catch instances of money laundering and other financial crimes at several branches in New York, New Jersey, and Florida. Additionally, the U.S. Treasury is expected to impose a cap on TD's retail banking assets as part of the agreement. And sky-high resale prices for Oasis tickets have Live Nation's top executive calling for a change. During a Bloomberg conference, CEO Michael Rapino said that multiple billions of robots targeted the band's upcoming tour when tickets went on sale. He's urged government officials to regulate the business by capping ticket resale prices at a 20% markup. Live Nation is currently facing an antitrust lawsuit from the Justice Department, but Rapino believes that Live Nation will win that case. And that's your brief, John.
Danny, thank you. So the people buying Oasis tickets didn't actually exist. Robots.
Exactly. And that, I think, is going to be a key problem. Actually, I hate that about resale values, that if you don't get in on it, if you don't, it's basically like an allocation for a big bond offering that everybody wants.
Totally agree.
Yeah.
Robots or Dan Greenhouse, he does not remember. Up next, brace in for Milton's impact.
You need to prepare for catastrophic impacts. This is going to be a serious storm, one that could forever change communities that are still recovering from Helene.
The latest on Hurricane Milton up next on the program, live from New York City this morning. Good morning.
We spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
DOJ or other authorities
could face bigger
town Britain's next.
It was going to keep raining World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, welcome to the program. Equity futures on the S&P 500, just a little bit softer. We're down 0.2%. Under surveillance this morning, bracing for Milton's impact.
You need to prepare for catastrophic impacts. This is going to be a serious storm, one that could forever change communities that are still recovering from Helene. 2 massive storms have come our way in only a matter of weeks. But this is what we do. FEMA is ready. We are here to help people. We are here to save lives. And that is exactly what we are postured to do for these incidents.
So here's the latest this morning. Hurricane Milton battering the Tampa Bay area with heavy rainfall and 85-mile-per-hour winds after making landfall as a Category 3 storm, leaving over 3 million homes and businesses without power, according to Power Outage US. Joining us now is AccuWeather's Joe Lundberg for the latest. Joe, thanks for joining us this morning. What is the latest? Where are things at?
Jonathan, the worst of the storm is pretty much over with. The center of lowest pressure is now east-northeast of Cape Canaveral, Florida, and it's moving east-northeast and out to sea. There's still a couple of rain bands that are affecting the eastern portions of the state. Those will take another couple of hours to move offshore. Once they do, the worst of the rain will be done. Unfortunately, with all of the rain that we've seen over the past 24 hours, upwards of 18.5, 19 inches in the St. Petersburg area and a foot or more across the central counties of the state, there's flooding that's going to take days to recede, if not weeks.
We said it before, we said it again. It's the 1-2 punch no one wanted to see. Joe, we appreciate the updates, sir. Joe Lundberg there of AccuWeather. Hurricane Milton following Hurricane Helene. Joining us now is Florida CFO Jimmy Patronis. Jimmy, welcome to the program, sir. Thanks for taking the time. I think top of mind for you, for all of us, search and rescue. Walk us through how well prepared we are, how things are looking.
So we have 1,600 urban search and rescue first responders out all over the state of Florida right now. Teams were deployed last night into St. Lucie County. That's where we had all of the tornadoes that were spun off the backside of the storm. I know there was a lot of fixation on landfall, but the tornadoes off the backside are what really were, that caught a lot of our citizens off guard. Almost 30 tornadoes have been tracked, 128 warnings. So as those resources were waiting for sunrise today, we have got, look, it's hard to hold these men and women back. They're out there doing their jobs, even as the storm is still in the state of Florida.
Jimmy, what's going to be the biggest concern this morning?
So we want to get our citizens to take their time going back to their homes. I know everybody's been traumatized, those that had evacuated. Look, let our first responders get the community stabilized. There's down power lines. There's going to be broken utility lines. There's going to be intermittent cellular service. So if you're somewhere safe and comfortable, take your time. Be there, go into 24 hours, 48 hours. Let the dust settle, because right now, bringing a bunch of individuals back into their communities as their communities have not stabilized is just going to create for a longer duration of recovery.
So there's going to be a period of time where people are displaced, and then they're going to come back, and there's going to be a real question about rebuilding some of these areas, just how much damage there has been done. We were speaking earlier with Bill Waddell from AccuWeather, and he was saying that the first storm, Helene, probably caused somewhere between $200 and $250 billion in damages, not just in Florida, and that this one could cost something sort of in the same range. How are you prepared to manage all of this as you rebuild?
Well, the big difference between what happened in North Carolina and happened in Florida, Florida carries insurance. In the case of the state of North Carolina, Asheville alone only had 248 flood policies. But most people would think, why do I need to have flood insurance while I live in North Carolina? So in the case of the state of Florida, we're much better covered. We have much more of an insurance blanket over the state of Florida. So again, there will be challenges, there will be rebuilding, but to me, nobody does recovery better than the state of Florida. And this is what we'll do. We will take one foot in front of the other, and we'll continue to build back our cities and our communities.
Jimmy, of course, there will be some residents worried about their property taxes, worried about their finances. With the experience of Hurricane Ian, can you just walk us through, for the people who aren't aware of this, how the rebate system actually works down in Florida?
Well, I think the reality that people have to let sink in is look, it costs more per square foot to build a house today than it did 5 years ago. So the cost of construction is going to change when it comes to some people will be underinsured. Some people will sell their homes as is. They'll cash out. They'll move into another community. When Hurricane Michael hit my hometown, my neighborhood, everybody had aged out. So what a lot of them did is they cashed out, took their money, and they moved closer to their grandkids or their kids. So again, this will be some of the similar type of response we'll have of this. St. Lucie County, where one of the tornadoes hit, was a retirement community. I'm sure a number of those families will probably look at other alternatives as they receive a large payout from their insurance company, and they may just decide to pick a different place to live closer to family.
Jimmy, do you think that just in general, there is going to be kind of a migration in Florida away from some of these areas that have gotten hit, as you said, as people age out, decide to shift elsewhere?
On the contrary, it's amazing the type of land rush that takes place after a storm. You will have all of those that saying, you know what, again, I've aged out, I'm gonna move out, but there are people lined up down the street and around the corner that will buy back in those coastal communities. They will build up, they'll build to the higher building codes, and they will make the necessary investments to be able to enjoy what's beautiful about living on the Gulf Coast or the Atlantic coast. But you would think that, but it's amazing the type of land rush that happens immediately after a storm.
Jimmy, before the storm hit, you said the path it was going on could be something of 10, maybe $20 billion worth of insured losses. Did the path follow what you were expecting?
I wouldn't be surprised if the number exceeds that. We saw with Hurricane Ian, we saw almost 800,000 insurance claims, over $20 billion in insured losses. We did not have a type of an impact into a densely populated market like a Fort Myers and Naples did last time. It went into Sarasota, still heavily populated, but you know, it's not going to be, in my opinion, as impactful to that initial area. So now this storm crossed through Orlando, so it's still yet to be determined how much damage Orlando suffered for this, because again, Orlando is going to still receive 18 plus 10 to 12 inches of rain, and this is flash flooding. So, you know, those communities in Orlando, you know, hopefully they learned from Hurricane Ian. It's important to have flood insurance no matter where you live in Florida. And sometimes we have to learn the stove is hot in order to respect it in the future.
Hey, Jimmy, we respect you, sir. Thanks for your time this morning. Our thoughts are with you and the people of Florida. Jimmy Petronas there, the Florida CFO. The demand to live there. Did you hear that? That's what stood out for me there.
Yeah, at first I thought maybe people are saying we're not going to rebuild if it gets hit quite a bit, and instead it's quite the opposite, and there's a land rush. At a certain point, you do wonder exactly how the rebuilding is going to get financed. From a market perspective, you do get the sense people are kind of saying, if anything, this tends to be stimulative, because actually it ends up to spurring more spending. At some point, how does this get paid for, though, on the other side is sort of a key question.
A land rush. People want to go back. They want to rebuild their homes, and that's why there was so much concern from some people to actually heed those calls to evacuate and leave, because they wanted to protect their property. You have to think the cost of this, he's talking about maybe north of $20 billion just in uninsured losses.
There is going to be a huge rebuild effort following Hurricane Helene and then Hurricane Milton overnight. Up next on the program, we'll catch up with Bank of America's Holly O'Neill on their latest consumer report. Look out for that conversation on the other side. From New York, equity futures just a little bit softer. CPI data a little more than 1 hour away.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Earnings season picking up. We heard from Delta a little bit earlier this morning. You'll hear from JP Morgan and Wells Fargo tomorrow morning. Equity futures right now pulling back by 0.2% on the S&P 500. Delta in the pre-market down by more than 6%. The midpoint of the guidance, missing guesstimates. This one must have been a high bar because this one's getting punished.
Yeah, it came in below estimates in terms of the midpoint of the range that they came out. But there's also this, the revenue growth guidance came in at about 2 to 4% versus the 4.4% year-over-year expectation that was expected by analysts. The point here is Delta is the best of the best when it comes to resilience at a time where the lower income consumers are pulling back. And if they're having problems, what does that say for the rest of the industry?
Pulling down the rest of the group this morning, going into the opening bell. That's the story with equities. Here's the story with the bond market. Brief look at the picture for you. A snapshot, the 2-year, 10-year, 30-year. You'll notice one number down the left side. 4s and not 3s. Big change since we got payrolls last Friday. A blowout jobs report. Will we hold on to these levels? At least they're going into CPI 1 hour from now.
Yeah, does CPI matter, right? Basically, have we gotten enough of a sell-off where any kind of upside surprise will be tolerated just fine, and a downside surprise could bring in some buying? A real question here, can we ignore inflation the way that the Fed seems to be doing so? We started off the show with Brian Levitt saying, yes, you can. We talked about that with other people. They say, no, you can't. So we shall see at 8:30 a.m. this morning.
We won't be ignoring it at 8:30 when it drops. Let's turn to foreign exchange. I want to finish on this. Just want to watch through to the close today. DXY, the dollar index through yesterday, 8 consecutive days of strength. That is the longest winning streak going back to April 2022 when we had 9. We're looking to see if we can make it day 9. The dollar index this morning, just about unchanged. Under surveillance this morning, more than 3 million people across Florida are without power as Hurricane Milton barrels across the state. The National Hurricane Center continuing to warn residents of life-threatening storm surge, damaging hurricane-force winds and heavy rainfall.
Absolute devastation. When we look at these photos coming out of Florida, we're going to get an update from Florida Governor Ron DeSantis in about an hour's time. We heard from President Biden last night talking about the fact that they're basically pulling on every lever they can. The Department of Defense will be ready to provide active duty service members. Governor DeSantis talking about officials and law enforcement officials coming from outside the state to help them, and just the immediacy of making sure people are safe. And then, of course, it's that rebuild effort and the billions of dollars this is going to cost.
Expect plenty of updates throughout this morning. As we get them, we'll share them with you. An update on the latest in the Middle East. President Biden and Israeli Prime Minister Benjamin Netanyahu holding their first call in more than a month. Biden continuing to warn Israel against attacking Iran's nuclear sites in retaliation for last week's missile barrage. Israel's defense minister still saying they will carry out a deadly hit.
The Wall Street Journal has some insight into what's going on between Jerusalem and Washington. They say Israel has so far refused to divulge the Biden administration details of its plans to retaliate against Tehran. You only have a readout coming from the White House about what happened on this phone call. Karine Jean-Pierre said it was very frank. They haven't spoken since August. You could feel that they're potentially not on the same page right now when it comes to what Israel is going to do. And we don't know yet what Israel is going to do. We do know the United States, though, doesn't want them to hit nuclear facilities. And we definitely know they don't want to hit Iranian oil facilities as well.
There's a question about how much clout
President Biden has in the sort of last stages of his presidency at a time where Netanyahu has aligned himself more with Trump than the Biden administration and Kamala Harris, basically thinking that if he can withstand this, he has more free reign because no one's going to even try to rein him in later on. So that's sort of one overhang to this entire situation.
This story has whipsawed the commodity market over the last week or so. We are firmer this morning on Brent by 1%, 77.50 on Brent crude. WTI 74.14. Let's get you some Fed speak. San Francisco Fed President Mary Daly expecting 1 or 2 more quarter-point cuts this year as the central bank looks to protect the labor market. The minutes of the Fed September meeting showing there was debate about how far to go, with some officials preferring, Lisa, a 25 basis point rate cut.
Didn't you say something earlier? You said something like it isn't a one-mandate Fed, it is a one-man Fed. It was Fed Chair Jay Powell basically pushing everyone, look, we should have gone in July, just get on board. We're going now 50, but it's not going to basically mean anything. And that's the tone that you've heard from so many different Fed officials, one after the other, whether it's Mary Daly, whether it's Lori Logan saying a more gradual path back to a normal policy stance will probably be appropriate from here. Susan Collins echoing that. John Williams basically talking about that as well. Even Neil Kashkari. So where is the super hawk that's going to go by 50 basis points as a de facto move going forward?
Basically what the minutes have confirmed is what we've been speculating around this table for weeks, which is the fact that Powell was the one to nudge everyone along. And now in the blackout period, if potentially he has a change of mind, you need to make sure you're reading some of the pieces in the Wall Street Journal and the Financial Times, right?
Colby Smith, the FT. Stay tuned. Stay tuned. We're all going to be doing the same thing in the next couple of weeks. Let's turn to the state of the U.S. consumer and consumer spending. The Bank of America Institute publishing its latest consumer checkpoint just ahead of CPI, due out in just under an hour. The report pointed to modest forward momentum, with spending relatively steady as wage growth remains supportive. I'm pleased to say that joining us now is the Bank of America President of Retail Banking, Holly O'Neill. Holly, welcome to the program. We've got a lot to get through. I always say this every time we cover this report. It's one of my favorites to get a clean read on what's happening with the U.S. consumer. I think looking at the latest Hurricane Milton overnight and Hurricane Helene before that, can you give us an understanding of what card spending looked like in the states that were impacted by those weather events?
Sure. So spending in September, what continued good, positive momentum, as you said, but we did see a drop in spending as we saw that last week in September with the impacted areas of Helene. So spending for the consumer did come down in the impacted areas, but it was relatively small overall when you look at the whole U.S. consumer across the U.S.
We've been covering your story for a while. Median balances of consumers so much higher than they were pre-pandemic. There's another big bank balance, and it's called a house. And as rates come down, Holly, we're trying to work out how many people are going to tap home equity lines and what they'll be doing with that money. How much of that activity have you seen increase over the last month or so?
Sure. So there is undoubtedly value in homes, right? And you see that in home equity. But that value is skewed to the higher end. Not everyone owns a home. Not everyone has equity in a home. So as you read through the Institute report, you'll see some differences of opinion of what we could see there. I think there is some skepticism that home equity could really drive spending, given that it's only a subsegment of the population. And so we'll watch to see what happens. We have not seen a big jump in home equity spending to date. And I think there's some skepticism as whether that will really drive consumer spending as we move forward.
Holly, I love the fact that your report kind of puts some texture around choiceful and choosy and selective and some of these words that we hear from some of the CFOs and CEOs of retail companies as they deliver them on earnings. Is it basically we're not going to buy a refrigerator, we're not going to buy a stove, we're not going to fix our car, but we will go out fancy dinners? Is that basically what you're seeing?
That's exactly what we're seeing. So washers, dryers, dishwashers, those are not flying out the door. So the high-end durables still are very controlled from a spend perspective. Where we do see spend is in the experiences, and services continue to be strong. And I think we're still seeing the impact of the high durable spend that we saw through the pandemic, and that will work its way through. But you're exactly right.
Given this texture, Holly, there were a lot of questions with the labor market report that we got last week on Friday about whether it checked out through other forms of data or whether it was sort of a blip that was going to get revised significantly. How much do you see almost confirmation of the increases in wages and the continual employment of America through the consumer data that you're seeing?
Well, I think the wage growth and the labor market is supporting the continued spend. So, that spend, the forward momentum is still positive, right? It's slowed since the end of the pandemic. We saw a rise as the pandemic came to a close, a significant rise. And so that spend is still positive and it's good forward momentum. And I think that is supported by the wage growth and the strong job market.
When you see this spend, especially the persistent spend on services, is this across all income cohorts?
It is. So we see similar trends no matter what income cohort, high end or low end. Of course, in the high end, high income cohorts, you see more spend, but in the lower income cohorts, you still see the strong spend. Within the data, you do see them making some trade-offs with value, more white label spend perhaps, but it's strong throughout.
So when you look at services, is it going out to eat? Is it going on holiday and vacationing? Where is the money going towards?
It is across the board, going out to eat, although I will say within restaurants, we are seeing some shifting to more affordable restaurants versus very high end, but the spend in the category is still strong. We are still seeing spend in travel and experiences. So there is real consistency that we've seen here.
Holly, there are some people who are looking for something to worry about. A lot of people are looking for something to worry about, especially given how high equity market valuations have gotten and the fact that one person after another comes on and says, I just don't see it. Is there any evidence, anything that you're seeing in this report that gives you pause or that's something that you're watching?
There really is not. I mean, we are seeing and watching very closely that spend pattern and where consumers are making trade-offs. But I think those trade-offs are really good, right? They're looking forward, they're making some adjustments in their spending so that they can continue down a path of strength. And that's further supported by the job market and wage growth. So there really are no real problem areas underlying our data that we're seeing. And consumers still have a cushion in their deposit and savings accounts as you compare it to pre-pandemic. So that's another good sign that the consumer remains stable.
Holly, can you build on that just a little bit more? Tell us what the median balance looks like compared to pre-pandemic levels, and maybe throw in as well the read that you get on after-tax wages and salaries. Just how hot is this labor market still?
So from a savings and a deposit perspective, they are still 20+% higher than they were pre-pandemic. We have seen that come down over the last 12 to 18 months, very slowly. So they are spending through a little bit of that cushion, which was undoubtedly created by stimulus and changes in spending patterns when people were, at home during the pandemic. So we're seeing it come down slightly, but I would say it's fairly stable, and it's significantly higher than it was pre-pandemic, which again I think is a terrific sign for the U.S. consumer. In terms of the labor market and the wage growth and what we're seeing in their accounts, again, we are seeing inflows and outflows in the accounts at a very healthy level. So they're not spending more than they're taking in. So they're adjusting on their wages. So again, really strong signs by the consumer.
Holly, is there another period in financial history that this is analogous to in terms of the levels of both spending, of the cushion, of savings that you're seeing among consumers?
Looking back over the last several years, couple decades, I think the consumer is as strong as it's been. And I think we can attribute that to, great information. They're adjusting, and they're really thinking forward in terms of what it will take for them to maintain their financial health.
Holly, for next time, when Lisa says some people are looking for something to worry about, she just means Lisa is looking for something to worry about.
There are other people, too, who are looking for things to worry about. It's
Lisa
not
always
just
looking
me.
for something to worry about. Holly, we appreciate that. This was great. Really do. Let's do it again soon. Holly O'Neill there of Bank of America on the latest situation. I love this report every single time. It's not about what we feel. It's about what's actually happening, real numbers, in accounts, leaving accounts, and where that money's being spent.
I love it, too, especially because it gives you a sense that everyone already bought their refrigerators, they already bought their washing machines, they bought their stoves because they had nothing else to do during the pandemic. And now that shift has sort of stayed in place, but this doesn't represent anything to worry about, at least from that perspective.
The report has great charts, too, and you can see the service spending. It's just basically nonstop. It is persistent. You see this demand there for individuals that want to go out and travel in restaurants. The one thing she did say, though, is that people are starting to be a little bit more choiceful, maybe choosing a little bit more affordable restaurants to go out and dine in, but still, the spending, the appetite, it's there.
Next read on the economy, 8:30 Eastern Time, CPI and jobless claims. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. GSK shares rallying in the UK trade about 5%. The pharma company agreed to pay up to $2 billion to resolve about 80,000 U.S. court cases. The claims had alleged that a suspected carcinogen contaminated its old reflux medication, Zantac. According to people familiar with the matter, plaintiffs decided to settle the case. Delaware's Supreme Court signaled that it might walk back an earlier ruling that did go in their favor. GSK says settling is not an admission of liability. Bloomberg reporting that Bernard Arnault's family is nearing a purchase for a major stake, a majority stake, in second-tier football club Paris FC. According to people familiar with the matter, the Arnault family will initially take a stake of about 55% through its holding company. In 2027, the family plans to buy out club chairman Pierre Ferracci's 30% holding. Red Bull will invest alongside the Arnault family and acquire a stake of about 15%. And the Mets are headed to the NLCS for the first time in 9 years after an electric elimination game over the Phillies. Francisco Lindor smashed a grand slam in the 6th inning, sending Queens into a frenzy and securing the series win. Elsewhere, the Yankees took Game 3 in their series against Kansas City behind a monster home run from Giancarlo Stanton. The Yankees and the Detroit Tigers will both aim to close out their series later this evening. And that's your brief, John.
Almost had a fight around the table there, Danny. Did the Mets news and not the Yankees, just for a heartbeat. Anne-Marie was about to lose it.
I mean, honestly, stop it. Just stop. I mean, seriously.
It was my first request when I came in, because I knew John was going to want tennis. I knew you were going to want Mets, and I was like, make sure you put the Yankees in there.
You want it, all right?
And I'm a little bit annoyed because when they showed this home run on film, and I watched it this morning, they're just showing Giancarlo Stanton. You only know he hit a home run when he tosses his back because he's so excited. Okay. They don't actually show the ball. We didn't see the home run into left field.
The Mets had a grand slam. They are now through the next round. Stevie Cohen, who is basically persona non grata in so many sort of public circles, now suddenly is a popular hero and is basically, you know, the one that is being welcomed outside of Citi Field. I'm just saying, you know, it's a pretty interesting story.
This should be the show. You want to carry on or no?
We can stop.
Okay. Up next on the program, inflation in America.
Presuming that the inflation data comes in relatively in line, right? There's a pretty clear path for the Fed to cut, we think, to around maybe 3.5%, slightly higher in 2025. But then the conversations about the neutral rate of interest become that much more important.
The brilliant Claudia Sam up next on the program, live from New York. This is Bloomberg.
We invest in, buy,
and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Stocks pulling back just a little bit. The data 40 minutes away. We're down 0.1% on the S&P 500. Yields are higher by a basis point or two, getting closer to 4.1% on a 10-year. Under surveillance this morning, inflation in America.
Presuming that the inflation data comes in relatively in line, right? There's a pretty clear path for the Fed to cut, we think, to around maybe 3.5%, slightly higher in 2025. But then the conversations about the neutral rate of interest become that much more important. The mix shift of the economy is changing. The underlying kind of dynamics are different.
So here's the latest. Stocks sitting at all-time highs ahead of CPI, the Fed's next big data point after September's stronger than expected payrolls report. Claudia Sam of New Century Advisors keeping an eye on the labour market and writing the following. The strong gain of 254,000 jobs in September was a welcome surprise after months of cooling in the labour market. However, 1 month does not make a trend, and even with the Federal Reserve cutting interest rates, a sustained turnaround in hiring will take time. I'm pleased to say that a good friend of this programme, Claudia Sam, joins us now for more. Claudia, welcome back. Let's talk about Friday's labour market data and the increase in unemployment we saw through the summer. You came on the programme a number of times and suggested that maybe that increase in unemployment overstated some of the weakness that people might be thinking of. Do you think that maybe the report on Friday overstates some of the strength that people might believe there actually is in the labour market right now?
That's absolutely a possibility. Friday was a good day. Like, that was a good employment report. The only bad thing about it is we don't have two more in our hands, right? So if we continue to see strength, and not necessarily that strong, we don't want to get greedy here, but if we have it, that strong, then yes, we'll look back on the summer and say, yeah, we wobbled and like that was not good. Now, in the Bloomberg opinion piece that you pulled the quote from, I talk about the fact that the hiring rate, so the fraction like new jobs out of employment at firms, it is still very low, like 2013 low. And that, until that hiring rate comes up, I will not rest easy, nor do I think anyone else. And I think the Fed probably feels the same way, because if that continues to be low, we will see slower job gains, we will see higher unemployment, and nobody wants to see that.
There's a worry of yours that I think we all share and we should talk about: lost potential. Can you talk to us about the risk of lost potential and how bad this could ultimately be for a single generation, maybe even more people than that?
Right. So I've spent a lot of time talking about the SOM rules and my recession indicator and like why it would work and not work right now. And frankly, I'm a little disturbed that the discussion turns into the 0-1 of recession, not recession. It's like, no, we do better than this. We do full employment, right? So to me, every person who's out there looking for a job, whether they're an immigrant, whether they're a native born citizen, if they want to work, we ought to have them working. And if they're not, it's a lost potential. And we saw in this recovery our first job-full recovery in decades. And if we look back to after the Great Recession, when I was radicalized into fiscal policy, that was a bad recession, and it was most bad for people coming into the labor market. There were like years and years of a hit to income to some people, and that is absolutely unacceptable. And we don't have to do that again. And so to me, it's extremely important to keep the eye on the ball, which is our full potential.
Which is the reason why, Claudia, I think some people are talking about this Fed as a single mandate Fed. That's what Mohamed El-Erian called it, in terms of just focused on preventing further weakening in the labor market rather than focusing so much on the incremental moves in inflation. Do you think that structurally there should be more focus on preventing a real weakening in a labor market by the Federal Reserve rather than inflation, as long as it's below some point that may be a bit above 2%?
So the Fed has a dual mandate. It's the law. It's like, you don't like it, go to Congress, right? Like, they have price stability and maximum employment. Now, maximum employment means the most employment you can get without causing inflation. So it's still kind of like inflation is like center stage. But we are at a point, and Jay Powell, Fed chair, said very clearly multiple times, it is not necessary to have more unemployment to get inflation down. It's like, get a grip. Like, we're going to fight labor market because it needs a little support, or at least from the Fed, it needs them to stop like putting their foot on it, like pushing it down. And that, as far as I'm concerned, Jay Powell is well on his way to being the GOAT, the greatest of all time of Fed chairs, because this is the first full-on dual mandate Fed chair.
Claudia, do you think then that in about a half-hour time, what we get from CPI even matters?
It always matters. Data always matter. But 1 month does not change the narrative. As I said, if it's a good month, it doesn't change the narrative, just like if it's a bad month, it doesn't change the narrative. We are looking for a sequence. I mean, I would love owner's equivalent rent to actually look like something normal, like what we know is coming. That's what I'll be looking for. And, you know, we always want to look for signs. We want to look for risk, you know, of inflation coming back stronger. But it's really hard to imagine a scenario. Please don't do it to us, Bureau of Labor Statistics, but it's very hard to imagine a scenario today that's a game changer. But it's also hard to imagine a scenario today that brings us the full clarity that we all want.
Claudia, very quickly, will we get that full clarity? Will there be more hiring after the election?
I think we're going to see a very slow process of that uncertainty coming out, because at the end of the day, the details matter, and we are not going to know the details on legislation and regulatory policy until well into next year.
Claudia, thanks for taking the time to talk to us this morning. We appreciate it as always. It's good to see you. Claudia Sam there of New Century Advisors. Thank you. How concentrated the hiring's been in certain sectors. Healthcare, we've talked about that. Government hiring hasn't been that broad-based growth that we'd like to see in that 254,000 number we got last Friday.
There are still a lot of questions about how sustainable this is, which is the reason why people are looking for ongoing signs. And as Claudia said, maybe just don't put your foot on it.
Up next on the program, the third hour of Bloomberg Surveillance looks like this. Mike Wilson of Morgan Stanley, Erica Najarian of UBS, David Kelly of JP Morgan, and Craig Peters of PGIM. CPI in America just around the corner, 34 minutes away.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, you know, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, is emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon, in Sudan, and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Presuming that the inflation data comes in relatively in line, right? But there's a pretty clear path for the Fed to cut.
You're seeing inflation moving closer to the target. In that environment, you have to be closer to neutral.
They can continue a sequence of rate cuts, and they have a lot of room to cut interest rates here.
Inflation is really looking like it's getting back under control, that kind of the battle against inflation has been won.
The inflation question is back on the table.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Mohamed El-Erian said it on Friday, straight after the payrolls report. Inflation is not dead. It's alive and well. That number drops in 30 minutes' time. The scores going into it look like this on the S&P 500, pulling back from all-time highs, just a little bit softer on the S&P 500. We're down 1/10%. On the NASDAQ 100, we're down also by 1/10. On the Russell, just a little bit of underperformance, off by 1/4%. The scores in the bond market, a lot of fours. We had some weight to these yields. We're up by 3 basis points at the front end of the curve, getting closer and closer to 4.1%. Similar move on the 10-year, up by 2 basis points to 4.09%.
You put this all together, and I really want to go back to this. I know some people are going to groan. Good news, good news. Basically, good news for risk assets, even if you see bonds sell off around the margins. In other words, can you continue with this? The sense that bonds are kind of their own thing in isolation and aren't going to break out too much to really derail some of the joy that we keep feeling 44 times over again this year.
When Mohamed came on after that blowout report, he's talking also about the fact that this Federal Reserve has amplified market volatility, and basically the bond market is anchorless, moving from data to data point, and now CPI takes on this whole new focus following that report.
Once we get past CPI jobless claims, it's on to earnings from the likes of JP Morgan, from Wells Fargo. Earlier on this morning, we heard from Delta. Delta just missing estimates just by a tiny bit, and then getting punished. At the lows this morning, we were down by more than 6%. Right now, Lisa, we're down by 3.4.
Yeah, they just had a terrible experience. Their adjusted earnings, their expectation is $1.60 to $1.85 versus the expectation of $1.75. So basically, just, completely in range, just maybe a little bit, a touch on the light side with their revenue growth guidance coming in, a touch on the light side, and this is the response. To me, this highlights the dissonance between the expectations, which are pretty high, the ongoing resilience you see from consumers, and the fact that companies are dancing on the head of a pin to fulfill those expectations. And that, I think, is what's going to be most interesting to watch during this earnings season.
The other risk right now is the election. And I say this because the Delta CEO said the airline anticipates a slowdown around the upcoming U.S. presidential election, which led to a 1 percentage point reduction in its unit revenue guidance this quarter. The same way we're hearing from Claudia Sahm that potentially we will see some more hiring that's been pulling back on the sidelines once we get an election outcome.
And the hope is that we get that outcome and get it quickly. That's the hope. I'm not sure if that's the base case. Is that the base case? How long will it actually take to get an outcome from November 5th?
There is a feeling that probably what's going to happen is whoever wins, there will be challenges. It'll take a while to know who that is, and then who knows how long this goes on. Key question for this market, does it matter what the election outcome is going to be as long as we have a president? What is the market expectation for not necessarily knowing for a prolonged period of time? That risk scenario is not getting priced into this market, but that is something that people are looking at.
Just a bit softer this morning. We're down by 0.1% on the S&P 500. Coming up this hour, Mike Wilson of Morgan Stanley as the S&P 500 hits its 44th record high of the year. Erica Najarian of UBS looking ahead to this week's big bank earnings, and David Kelly of JP Morgan reacting to the latest inflation data. We begin this hour with stocks at all-time highs ahead of CPI, the next key data point for the Fed after September's blowout jobs report. Mike Wilson of Morgan Stanley updating his outlook, writing Friday's strong jobs data and our economists' call for a series of 25 basis point rate cuts from here lead us to upgrade cyclicals to overweight relative to defensive. Mike joins us now for more. Mike, good morning.
Good morning. How are you, John?
I'm good. It's good to see you. Let's talk about that overweight to cyclicals. Walk me through what's behind that and what kind of names you want to be behind at the moment.
Yeah, it's a very nuanced call, so I want to be crystal clear about what we like within cyclicals. Look, we're still not that convinced that there's going to be some big, robust recovery. That's when you really want to buy the early cycle kind of cyclicals, and we're not in that camp. We're still in the late cycle momentum here. But remember, this market has gone back and forth as the economic data has come in differently this year. Beginning of the year was a no landing scenario. Then we kind of reverted back to this sort of soft landing and then even a hard landing risk this summer. And now we're kind of back moving towards the no landing. So we're just trying to trade this back and forth. And we've been actually trading the rotations quite well this year. And so we're just taking we've had a great call on the defensives. We took that off 3 weeks ago. We neutralized that. And now we're just saying, look, you can step in a little bit more to the late cycle cyclicals. That's quality names, right? It's not buying the early cycle junky, bad balance sheet type names. This is materials, this is industrials, okay? This is some of the quality, maybe software names to some degree, because they're pro-cyclical. It's not a wholesale, go down and buy the junk. That's what we want to make clear here.
I've been through enough cycles with you now to remember that also you mentioned, I remember a long time ago, late cycle energy. You didn't mention energy this time. Why not?
Well, I didn't mention it, but we are overweight energy.
Okay.
Now, that's been more of a hedge for us on the geopolitical risk. And we, to be honest, we had a bad call on energy. We kind of upgraded in March. It worked really well until April. It's hasn't done well since then, but now it's having a little bit of a comeback. So for us, we like materials and industrials more than energy, but energy is a good hedge against what's going on in the Middle East and just the fact that maybe things do accelerate and maybe we do get better demand in the energy side. It is cheap, right? And that's the other reason we upgraded financials this past week is because as rates go back up at the back end, financials tend to do a little bit better.
Okay, that's where I wanted to go.
Yeah.
This question of the relationship between bonds and stocks, because we saw for a while there was a feeling that if yields went higher, that would be punitive for equity valuations. And then recently, that hasn't been the case. Mm-hmm. Has that been surprising to you?
Well, no, I mean, think about this, right? So the Mag 7 or, some of the expensive growth names since July have really underperformed. In fact, that group has not made a new high. So the market is sort of punishing the more expensive stocks for the higher rates. And that's part of our call, too, is that part of this rotation back towards, say, quality cyclicals or some of the other names that haven't worked so well this year is just money leaving the big winners as rates back up. So as we wrote in the note last week, the biggest confirmation to me that this data last week was somewhat real is that 2-year yields in particular really ripped, okay? And 10-year yields ripped at the same time. That's the bond market finally saying, hey, maybe there is something to this soft landing and maybe things can actually hold in here because the bond market's been very skeptical really up until last week. And that's a big deal.
So if I'm hearing what you're saying and taking it a step further, is it correct to say that the big tech companies, based on their valuations, are actually more highly levered to rates being somewhat lower, and that the cyclical companies are less sort of tied to that in terms of valuation. In other words, they don't need money to be cheap forever for them to maintain their valuation. Is that basically what you're looking at?
Yeah, and once again, we did neutralize our small cap versus large cap call this year. We don't want you buying small caps wholesale. Same thing, quality stocks do better, and that's not the low quality stuff. Because let's not forget, low quality, bad balance sheet, small cap companies are not going to do well until rates really come down. All we're saying on the big cap tech stocks is there's two things going on. Number one, yeah, they got a little expensive. They're probably overowned, but also the fundamentals are deteriorating a bit, right? Last quarter, the market wasn't that excited about some of the spending the hyperscalers were doing without showing the returns they're getting on the revenue side. So that group to me looks like it's just taking a break. It's not that it's going to, crash here and rates are going to ruin the whole story. It's just they got overcooked, and we wrote about that 2 months ago. And since then, that's exactly what's happening. But that's the fuel for some of these other underperforming areas to work. Even China, quite frankly. I mean, part of the reason why China ripped so much, was because there's so much money looking for a new theme. And it was like, oh my goodness, here's a new shiny toy, jumped in there, popped up, and now we're selling off again. And that's actually been our view too, is that we're not buyers of the big China stimulus. However, it can cause 20 or 30% moves because the market is desperate for a new theme.
Well, the new theme of the year so far, before October 2nd, were utilities. Utilities absolutely ripped. They topped October 2nd, 2 days before we got the payrolls report. As you pointed out, yields ripped, utilities have suffered. I want to talk about how timely that removal of that defensive overweight actually was with regards to that. Yeah. Were utilities a part of that call for you?
Well, it was. We basically, the whole defensive sector, we just said, look, you can fade it here. We definitely want you adding more risk within defensives. Utilities is definitely part of that. Now, utilities is interesting this year because it's a defensive play because of, it's always defensive, but it also has this power story. And so we kept that one as an overweight, but we're not adding to it here because of that secular growth sort of story. Now, it did sell off more than other defensives earlier this week because I think it's crowded. We showed in our 100th percentile of ownership within our institutional base of clients. So it's crowded. I think it can hang in here. The one thing about utilities that people don't appreciate is if we go back into a kind of hard landing scenario, I'm not predicting that right now, but if that were to happen, utilities tend to do poorly because their balance sheets are actually not particularly good. So it's going to be interesting to see if it can hold up into that. It should do better, though, in the no landing or kind of re-acceleration story.
Where do financials fit in? Why the upgrade going into earnings season?
It's similar to our call on the group, the quality cyclicals. So we were very distinct about this, too. We don't want to own the low-quality financials. We want to own companies that have the ability to see NIM expansion, can monetize that, or have capital markets activity. So those are generally your larger cap financials, your higher quality financials. And I think that's sort of been showing its hand. The other thing you have to keep in mind is earlier in September, there was an industry conference for the financials, and they did lower the bar quite a bit. So the expectations in that group going into this earnings season, I think, look particularly good.
You talked about the shiny new toy. I want to talk about the shiny new toy and the sort of rolling ball of cash that just is looking for a new theme. When will that rolling ball of cash not be a rolling ball of cash? When will we not feel like there's this glut of money looking to go somewhere? Why is that such a prevalent theme in all of market action so far this year?
I think it's just a classic late cycle phenomena, right? I mean, things are expensive, right? I mean, the Fed is cutting, but they're cutting because growth is now the worry. And that's what stocks need growth. We need, for a big sort of broad rally in the small caps, lower quality areas, we need either rates to come down in a more meaningful way to kind of jumpstart that recovery, or we need, a reacceleration from a new source of growth, and we don't have that right now. So instead of having that rising tide, what the market's doing is it's looking for individual themes. Last year was GLPs, it was AI, of course. Now maybe it's China. There's some industrialization theme that's been pretty exciting. We've been on that top of that one. But these are temporary, right? And the market is fickle. It will basically throw the shiny new toy into the dustbin as soon as it doesn't perform anymore. And we see that too. So you just have to be very, willing to be flexible. And we've adjusted our forecast this year for that same reason. You have to be flexible. You have to adjust what the market's giving you.
How flexible do you need to be after the election? I'm thinking of corporate tax rates. That's going to be a huge debate, as well as tariffs.
Yeah, so tariffs is the one that's easier because it doesn't need congressional support. I think the baseline view from most clients we speak to in our house view is that probably the most consensus thing is that we're going to have gridlock in Congress, right? It's going to be hard for one party to get a full sweep. So if that happens, then taxes is kind of off the table for higher taxes. You could maybe see an extension of the tax cuts from 2017, so that's possible with congressional gridlock. The tariffs, though, can be enacted at the presidential level. So obviously in the Trump scenario, that's probably a worse scenario than it is with Harris. But I do think both administrations have shown their hand on that. I don't think tariffs are going away if Harris gets elected. I mean, I think the penchant there will be to kind of continue what the Biden-Harris regime has done for the last 4 years.
Do you buy into this narrative that maybe Kamala Harris is good for the bond market the way Donald Trump might be good for the stock market?
That's the way we've been talking about it for the last several months, is that Trump is probably not as favorable for the bond market because he's more of an inflationist, and the tariffs, of course, are part of that story, but also he wants to cut taxes. But the stock market may like that more, okay? And if you get a blue sweep, that's probably the worst case scenario for stocks, because then the risk of tax becomes legitimate.
How difficult is it to come up with an index level call for 12 months' time?
Well, it's always difficult. I mean, but I would say we've said this for a long time. I mean, this is the most difficult part of the cycle if you're true to your work. I mean, late cycles are always like we were just talking about. The market starts to rotate around because the opportunity set is less when you get into the later part of an economic expansion. So, I mean, 12 months is difficult. I would say the easiest time frame is 7 years. And we've talked about this before too, right? I mean, the only thing that you have over 7 years is valuation. And that's what we keep harping on. Valuations are expensive, okay? I don't care how you shake it. I'm not in this camp that, oh, it's different this time. So if you're investing right now, you have to be with the mindset that you're probably not buying and holding for 7 years at these prices, right? You're going to have to be moving it around across sectors, across individual themes. And then we've also been very focused on stock picking. There's always stocks that work. And that's why I think, now the focus, CPI, I'm not that focused on the CPI today, to be true.
I don't think we asked you about it, to be honest.
Because I just think that's yesterday's news in many ways. And unless it's a 0.4 or higher, I think it's going to be a non-event for the most part. What's focused now for the market is going to be earnings season, right? And so idiosyncratic opportunities for clients, that's how they've been focused, institutional clients, that's where they've been focused, that's where they should be focused. And it's a great stock picking market right now.
Can you share a single name? And if you can't, can you describe it?
Well, I would say the way I would describe it is that the factors that are really continuing to work are quality and earnings revision breadth, or earnings revisions, to the upside. So 3-month earnings revisions, and that's how we're positioned. That's the quality cyclical trade. That's where the earnings revisions are now in the better mode. I would say some of the growth stocks, the big large cap growth stocks, their revision factors are starting to fade, right? Because they just got too extended. So that's the key. You got to focus on good is good, right? Bad is bad, and that's the main thing. There's no more of this bad is good. I think that party is over.
We're happy to leave that party behind. Mike, It's good to see you. Thank you, sir. Michael Wilson there of Morgan Stanley. Let's give you an update on stories elsewhere this morning with CPI 15 minutes away. We'll be watching it. Here's your info brief for Danny Berger. Hey, Danny.
Hey, John. The National Hurricane Center says that the center of Milton is pulling away from the coast of Florida after making landfall near Tampa last night. Florida Governor Ron DeSantis says that Milton's storm surge was actually less than that from Helene. Still, more than 3 million homes and businesses in Florida are without power. Delta shares still falling in the pre-market trade, down 3.4%. The airline reported third quarter profit that narrowly missed analyst estimates and gave a downbeat revenue forecast for the final month of the year. The report coming after Delta and other big airlines complained about a glut of seats in the U.S. this summer. Delta was also hurt by a technology-related system breakdown that led to thousands of canceled flights over several days in July. The government agency overseeing climate and weather research has issued a severe geomagnetic storm watch for today into Friday. An outburst from the sun was detected earlier this week. NOAA has notified FEMA that the solar storm could temporarily disrupt power and radio signals. Experts are concerned about potential effects this could have on power grids that are already impacted in areas by Hurricane Helene and Milton. The agency told operators of power plants and orbiting spacecrafts to take precautions. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. I'm next on the program, The Morning Calls, plus Erica Najarian of UBS as we look ahead to big bank earnings kicking off tomorrow morning from New York. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power. This is Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching the close. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The open in about 1 hour and about 12 minutes away. 12 minutes away is CPI. So you've got all of that still to come. Let's get you some morning calls. First up, Truist upgrading Nike to buy, highlighting confidence in the company's new CEO. Next up, Morgan Stanley sticking with its overweight rating on Delta after earnings, recommending investors buy the stock on today's weakness. We're down by more than 3% in the pre-market. And finally, Bernstein downgrading PayPal to market perform, pointing to competitive pressure and valuation risk. Turning to the financials, big bank earnings kicking off with JP Morgan and Wells Fargo tomorrow morning, followed by Citi and Bank of America next week. We've got Erica Najarian of UBS around the table with us to break it down. Erica, good morning to you.
Good morning.
It's good to see you. Good to have you here in New York City with us. Let's talk about JP Morgan first of all.
Yes.
Dan Pinto came out and suggested that maybe we're a little bit too optimistic on earnings. Have we priced that in now?
I think so, and I think he's right. But here's the real rub about JP Morgan. With all that capital, they can earn whatever they want. So we have an estimate of $86 billion for net interest income for next year. When Pinto said that, net interest income was at 90. But they could buy Apple Card. They could, grow faster than you think because they have, so much capital. So he's right, but I'm not sure it's going to matter for the stock beyond Friday.
I want to ask you a question that you asked yourself in your own research. What do long-only PMs own? If they own JP Morgan and no other banks, what do they swap it out for?
Yeah, so they're not looking to swap it out. They are, in favor of the long-term story at Wells. They do think that there's going to be upside if rates are going to be lower on Bank of America. But the one stock where they're really sharpening their pencils because they think it's going to be, a transformational next 5 years for the company is Capital One, should the deal for Discover close.
Interesting. I thought you were going to say Citigroup, given the fact that there's been this whole transition going on over there. Capital One, though, is actually even more fascinating because of what we saw in terms of some of the fear around credit deterioration. How much is that something that's spooking people going into this, given some of the warnings that we heard in the last couple of weeks?
Yeah, I actually think the market is a little bit complacent on credit, Lisa. I think that what they're pricing into bank stock is this perfect manifestation of a steep yield curve where deposit costs are coming down, loan growth is going to come back, and then there's going to be very quiet credit. I think the consumer data is going to be pretty quiet over the near term, but I'm a little bit nervous about 2025. I feel like spend is maxed out. I always joke with my clients, how many times can you go to Europe? How many $3,800 Bottega bags can you post on Instagram, right?
That's true, which is maybe what you're seeing in terms of discretionary. They only need one of those, evidently. Yeah. But there's this question about consumer finance. We heard from Ally Financial, you talk about Capital One. Yep. We're not hearing the same thing from Bank of America earlier this morning. We're not hearing the same thing from JP Morgan. How much is this a tale of two banking systems? Basically, those that were trying to pick up the dregs during the go-go days for a lot of consumer credit, at the same time that the Bank of Americas and JP Morgans were consolidating their power over anything that was creditworthy.
Yeah, so that's a great question. Look, I think that given the nature of regulation, B of A and JP Morgan have always focused on the prime consumer, and the prime consumer is quite healthy right now. That being said, Ally could be a canary in the coal mine, right? So everybody has said, oh, it's going to be just the lower income consumer, just the subprime consumer. And again, if the Fed sticks the landing perfectly, great, right? You're not going to see that bleed up. But I think that, it always starts with spend. So for me, the first sign is spend slowing down significantly in 2025. We're coming upon holiday season, so we could have continued, strong spend on card. But as I think about next year, as I think about the savings dwindling, as I think about, wage growth not keeping up, as I think about prices still being high, I think you will see a slowdown in spend.
Which large banks are most vulnerable to that at a time where it feels like in the popular zeitgeist, there's a feeling that interest rate risk is really the one to watch with the big banks and the credit providers like Capital One and Ally Financial, it's credit risk. Is that accurate, or is it actually the big banks are going to start to feel the credit risk too?
Look, I mean, if the normal U.S. consumers stop spending, and if we have a little bit of blip in unemployment, you have the big card portfolios at J.P. Morgan and Citi. They're going to feel it too, right? So they're not going to be spared. They just have more diverse sources of revenue, especially J.P. Morgan, way more so than Citi.
There's a name we haven't mentioned, Wells Fargo. Lifting the asset cap. Just run through the last few years over at Wells Fargo and how revolutionary that could all be, how big a change we might see.
It all doesn't happen like this, right? Let's say they announce that the asset cap is lifted today. They're not just going to turbocharge the growth on their balance sheet, but a couple of things can happen. Number one, Wells has this great market share in terms of providing credit for corporates. They can now get even bigger in terms of, helping them with their investment banking and capital markets needs. They could be bigger in terms of helping institutional investors with their needs. That usually needs a lot of balance sheet. And so I think that could be the most immediate thing that you could see. And look, net interest income is balance sheet times net interest margin, not loans times net interest margin, right? So their ability to gather deposits, grow balance sheet, it was the institutional money that they sort of said, we don't have room on the balance sheet for you under the asset cap. I think eventually that could be a big deal for the stock. And it could be, pave the way to, mid-teens return on tangible common equity and $6 plus of earnings.
So with the 30 seconds we have left of the major financials, the report tomorrow and through next week, top pick. What is it right now?
I don't love the setup for any of them, but if I had to pick, I would pick Wells. I think there's a lot of concern over the near term on net interest income, but at the end of the day, it's always going to be regulatory. Is it a turnaround story? Is it a credible turnaround story? And I think that is going to be way more important than near-term gyrations on net interest income.
You're one of the best. We appreciate it. It's good to catch up. Thank you. Erica Najarian of UBS on the bank earnings tomorrow morning. JP Morgan and Wells Fargo, then on to next week where you get all the rest. In just a moment, about 5 minutes away, we get CPI data in America. We'll be catching up with David Kelly of JP Morgan and Greg Peters of PGIM right here around the table to react. Equity futures on the S&P 500 negative by about 0.1%. In the bond market, we're holding on to 4. Let's see if this sticks at the other side after we get the CPI data in just a moment. The 2-year yields are higher by 2 basis points. On a 10-year, we're up by a single basis point, approaching 4.1%. From New York City, your CPI data up next.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
20 seconds away from the economic data in America, a focus on two things, CPI and, Mike McKee walks in, don't forget jobless claims. Jobless claims just moments away. The scores going into this, just about negative by 0.1% on the S&P 500. Likewise on the NASDAQ, down by a little more than 1/10. In the bond market, a lot of fours over the last week. At the front end of the curve and the long end, the 2-year, 4.04%, yields higher by 2 basis points, up a single basis point on the 10-year to 4.08. With the data, here's Mike McKee.
All right, let's take a look at CPI. Comes in a little bit hotter than anticipated, up 0.2%, same as last month. Forecast was for 1/10. The core comes in up 0.3. That is also a little bit hotter than forecast. 0.2 was the belief. 0.3 was what we saw in August. The year-over-year numbers, 2.4% for the headline, not as good as anticipated, and for the core, 3.3%, not as good as anticipated. So maybe this will catch a little bit of wind, given the fact that we had seen the big, strong jobs report last Friday. Now, jobs, speaking of jobs, we get a big jump in jobless claims, 258,000. Now, that's up from 225 the month before, but caution on this one, this follows the hurricane. And so we are probably seeing a lot of people in North Carolina, Tennessee, Georgia, who are filing initial jobless claims. We'll take a look at that, but I wouldn't connect the dots between the CPI, the jobs report, and jobless claims.
Well, it's certainly a struggle to respond to it, Mike, and I can tell you that struggle's playing out in the market. Initially, after you saw those jobless claims number, this bond market rallied pretty hard at the front end of the curve, even though CPI came in a bit harder than expected. Right now, we're down about a single basis point on a 2-year, just in and around 4%. In the equity market, we were bouncing all over the place as well on the S&P 500. Futures stay negative by just about 0.2%. But I'd characterize this morning, Bramo, just looking at that on the surface, as a bit of a tug of war between a hotter than expected CPI and a worse than expected jobless claims rate.
Yeah, just to give the jobless claims a little bit of perspective, it's the highest jobless claims amount that we've gotten since August 2023. We're also seeing the biggest pop in a percentage basis going back to December 31st of 2021 when it comes to jobless claims. So taking a look at that, it's either an aberration to his point or it's something else that people have been looking for. And that, I think, is really important to watch.
Mike, we've got one more payrolls report, and that payrolls report could be pretty messy based on some of this.
Well, definitely. We're anticipating a lot of jobs lost to the hurricane. Before we even get to Milton, Hurricane Helene, and I know David's with us, folks at J.P. Morgan had made an estimate looking back at previous hurricanes, just based on Helene, that we could lose 120,000 jobs during the month of October, could come off of the payrolls report. Throw in 38,000 people who were on strike against Boeing, and you could end up with a negative print. Now, it wouldn't affect the unemployment rate, but it would be something really hard for the markets to digest, a market that isn't sure what the Fed needs to do here.
David Kelly at JP Morgan Asset Management with us around the table. David, I think we have to start with the jobless claims number, and welcome to the program. What do you do with that 258? I'm sure clients are going to ask you about that throughout today. What do you tell them?
Well, we're obviously going to look at the states and just see, was this weather? But I'm not too worried about it. I mean, the way I look at it is, right now, the Atlanta Fed is looking at a 3.1% GDP growth rate for the third quarter. And we did 3.0 in the second quarter. That is a lot of momentum. And we know that employment follows GDP with a lag of 1 or 2 quarters. So we know that the broad mosaic of jobs is we're creating jobs. The economy is still motoring along. And so we'll figure out what's causing the aberration. We'll try to. But we do think it's basically an aberration. There's no sign that the labor market's strengthening much, but it's no sign that it's weakening either.
But does this basically underscore why, even though CPI, which evidently we've all but forgotten, the fact that it came in hotter than expected doesn't really matter, that essentially this is a Fed that's going to be more focused, whether it's an aberration or not, on those jobless claims?
Well, I think we've got to reconcile ourselves to the fact that we've now got a normal, good economy. It's not so much a late cycle or an early cycle, it's a post-cycle. We've got an economy which is motoring along with inflation at 2 point something and unemployment at 4 point something, and that combination's pretty good. And it looks like it's going to keep on doing this for some time to come here. There's nothing endogenous within the economy that is going to make this economy tip either hotter or cooler. It's just going to trend along at a steady growth pace. So from the Fed's perspective, look, if the economy's in good shape, we can just gradually bring rates back to a normal level, and rates are still too high. So I think that they will gradually bring rates back to a normal level.
When would you get nervous about jobless claims? Because a lot of people are saying those are the highest frequency item to look at with the labor market. What kind of tick up would get you worried?
I'd get nervous if I saw other things going on in the economy also. I mean, obviously if we saw a few weeks of this, and we saw it show up in continuing unemployment claims. We saw it in layoffs. We also saw it in terms of corporate behavior or some of the earnings reports of the third quarter. If we saw a general sign that everybody's pulling back, then I get nervous. But it's hard for me to get nervous in an economy which will naturally chug along at 2%. I mean, that's what it's going to do. The population grows every year. The working age population grows. We're running at productivity growth, 1.5% to 2%. It's going to chug out twos. And if we were a little short one quarter, we're going to be higher the next quarter. So the thing that gets me really worried is what could change that narrative? What big shock, really big shock, could hit this economy and just take us out of these lanes? Because we're basically in a soft landing lane, and it's just continuing.
You say one of those big shocks could be fiscal policy.
Yes, that's right. I mean, one of the things, obviously, it's a very, very tight election. We're less than a month away. I'm particularly worried about tariffs, actually, because that's, it looks to me like most likely we're going to end up a divided government. I mean, of course, we might not, but that looks most likely. And then you don't get big fiscal policy change because one House of Congress tries to, offset what the administration is doing. But on tariffs, the president has control. And if we engaged in a big tariff war and we sort of put 10% tariffs on everybody and then they retaliate and we say, we're going to go 20%, that's the kind of thing that could actually cause a stagflation recession. I mean, it is a stagflation elixir. You can then cause inflation to bounce up, and those unemployment claims, they're going to start bouncing up too, because what you're going to do is lose manufacturing jobs in the export sector. So that's one big shock that we could impose upon ourselves in the short term. If we get into a tariff war or a trade war because we decide to try and fix our fiscal problem with tariffs, that's a potential own goal.
Absent that risk, how vulnerable are we to a stagflationary shock? Some people might look at this number on the surface, claims have broken out, inflation's still sticky. They might be throwing around the S word this morning. Would you throw around that word?
No, just the opposite. I mean, if you add up a 2.4 on inflation and a 4.1 on unemployment, that is a 6.5. That is better than those numbers have been 89% of the time in the last 50 years. We are in the opposite of stagflation right now. We've got motoring along with low inflation. It's actually a good economy.
At what point does inflation come back onto your agenda, given the fact that just looking in this, energy was actually lower? It was actually a negative influence on CPI. It was the other factors that are seeing price increases. And what we're seeing with companies is they're maintaining margins because they have been able to raise prices on consumers.
Well, but they're also maintaining margins because they're able to beat back on wage demands, which I think is another part of the story. I would get worried, apart from what I just said about tariffs, if we had a broadly expansionary fiscal policy, we did a lot of, suppose we threw money at lower middle income households in America next year for whatever reason. If we do that, the problem is already at full employment. And so if you put a lot of money into lower middle income households, either through tax cuts or checks for whatever reason, then you can cause inflation. Or we could have something terrible happen in the Middle East. I mean, if you have a problem which causes a hot war in the Strait of Hormuz and tankers literally can't get out, you got a problem. So there's always something that's going to go. It's hard to see what that thing is. But the reason you diversify is not because of what you expect. It's because of stuff that you don't expect that ends up biting you.
David, it's wonderful to catch up, sir. It's good to see you. I know you've got to run. David Kelly there of JP Morgan Asset Management on the latest economic data. If you are just joining us, CPI out just moments ago, 8 minutes ago, coming in just a little bit hotter than expected. Core CPI, excluding food and energy, coming in at 3.3% year over year against an estimate of 3.2. Month over month, that came in at 0.3 against an estimate of 0.2. Jobless claims came in at 258. The estimate in our survey was 230. Mike McKee, have you got a state breakdown now? Could you tell us state to state where some of the weakness came from?
Well, the interesting thing is the state by state data are a week behind, but the states that saw the biggest declines in jobless claims 2 weeks ago were Georgia, Florida, Texas, Virginia, states where, with the exception of Texas, the hurricane hit. And so people couldn't file because probably a lot of the offices were gone and nobody could get to them. So next week, watch for those states to bounce up again. Unadjusted claims up 53,000. I mean, clearly this is something happened in the economy, and it's likely the hurricane. Interesting thing with CPI, though, the things that went up were the things that have been going down, and vice versa. We have the best housing numbers we've got in about 6 or 8 months, with owner's equivalent rent up just 0.3 and rent of shelter up just 0.3. But food at home goes up 0.4.